Please like, share, and subscribe. Wishing you happiness and good luck every day.
So here's a puzzle for you, one of the great paradoxes in the world of finance. We're going to look at two absolute legends of investing, Warren Buffett and George Soros. They seem like complete polar opposites, but somehow they both achieved nearly identical, world-beating success. How? Well, that paradox reveals a hidden truth about what it really takes to win in the markets.
All right, so on one hand, you've got Warren Buffett, right? The sage of Omaha. His game is famously straightforward. Find a fantastic business, buy it at a good price, and then just hold on, basically forever. And then on the complete other side of the universe, you have George Soros. This is the guy famous for making these enormous, high-stakes bets on currencies, breaking the Bank of England. Their styles couldn't look more different.
But here's where it gets wild. Despite those wildly different approaches, just look at the results. From when they started up to 2003, Buffett pulled in a 24.4% annual compound return, and Soros, 28.2%. I mean, they both just completely demolished the S&P 500. To put that into perspective, if you'd put $1,000 with Buffett back in '56, it would have turned into over 29 million. That same 1,000 in the S&P 500, just under 74,000. The results are just unbelievably similar.
So that's the big question, right? How is that even possible? How can you have two masters playing completely different games, on different fields, with different rules, and they end up with almost the exact same legendary score? It really is a puzzle.
And here's the answer, at least according to the research from author Mark Tier. It's not about their strategies. It's not about stocks versus currencies. Their incredible success is built on something deeper, a shared foundation. A hidden architecture of 23 identical mental habits that they both follow, almost like a religion. This is the real secret.
All right, so let's dig in. We got to start with the absolute bedrock of their thinking. This isn't just one habit among many. This is the one that everything else grows from.
And this right here shows the huge mental split between the greats and everyone else. The master investor, your Buffett, your Soros, their number one priority is always the preservation of capital. Put simply, don't lose money. The losing investor, they're laser-focused on the complete opposite, make a lot of money. And ironically, that obsession with big gains is exactly why they so often fail to keep what they have.
Of course, Buffett has the most famous way of putting this. Rule number 1, never lose money. Rule number 2, never forget rule number 1. I mean, how great is that? It's not just a cute little saying. It is the entire operating system behind every single decision he makes. And Soros says the same thing, just in his own way. Survive first and make money afterward.
And look, if you ever need a reminder of what happens when you forget rule number 1, just look at this. Long-Term Capital Management, a fund run by Nobel Prize winners, lost $4.6 billion in 6 months. Victor Niederhofer, he lost his whole $130 million fund in 1 day. It's a brutal, brutal lesson in how much easier it is to lose money than it is to make it.
So what's the big takeaway here? Because their first priority is not losing money, these master investors are, get this, passionately risk-averse. Now that might sound crazy, right? We think of a guy like Soros as the massive risk taker, but in their own minds, they are doing everything they possibly can to avoid risk. They're not gamblers. The average person thinks you have to take big risks to get big rewards. The masters know that's just a recipe for disaster.
Okay, so if your number one goal is not losing money, how in the world do you actually invest? Well, that leads us right into the next cluster of habits, the idea of building your own personal intellectual framework, a shield to protect you from the chaos of the market. And this shield is made of a few interlocking pieces. It all starts with developing your own investment philosophy, not just borrowing someone else's. Then you have to brutally define what you're actually good at, what Buffett famously calls your circle of competence, and you never, ever step outside of it. It means you do your own deep, original research, and then, this is crucial, you follow your system with total discipline. You don't second-guess it just because the market gets scary. It's a whole system for making decisions.
And the key word here is own. This philosophy has to be an expression of who you are, your personality, your unique knowledge, your abilities. It's custom built for you. The losing investor, on the other hand, is usually just reacting to headlines and hot tips. Or they try to copy someone like Buffett, but it never really works because it's not authentic to them.
Buffett just cuts right through it all with this quote. You have to think for yourself.
The whole point of building this philosophy is to force yourself to think independently. It's the thing that lets you stay calm and rational when everyone else is either panicking or getting greedy. It's your anchor in an emotional storm. All right, so once you have that philosophy, it gives you something incredible, a kind of superpower that almost nobody else has, the power to say no and to do absolutely nothing. This is such a huge difference. A master investor is like a patient hunter. They can wait for weeks, for months, even for years for the perfect opportunity. If nothing shows up that meets their very strict criteria, they just sit on their hands. The losing investor, though, they feel this constant itch, this pressure to always be in the market, always doing something. They mistake all that activity for actual progress.
I mean, really let that sink in for a second. The incredible discipline it takes to just sit on cash, to watch all these tempting but not perfect ideas go by, and to just wait. That waiting is a form of action. It's the most important action of all.
But here's the thing about all that patience. It's not passive. It's like coiling a spring. All that waiting builds up this incredible potential energy for the exact moment when everything finally lines up. It's the explosive other side of patience, absolute decisiveness. Because when that one perfect opportunity finally shows up, the one that checks every single box on their list, they don't hesitate. They don't dip a toe in. They swing for the fences instantly. All the hard work, all the research is already done, the decision is clear, the time for waiting is over. Now is the time for bold, massive action.
And this is where they just flip the script on what most of us are taught. They do not believe in diversification. Why would they? When they find that one golden opportunity, they want to bet big. To them, diversification is just protection against ignorance. But since they've done the work and they only operate inside their circle of competence, they concentrate their bets. They go all in.
There's this great Mae West quote that the book uses, and it just perfectly sums up this whole attitude. When you find something truly undeniably great, why would you only want a tiny little piece of it? The masters get it. Legendary returns don't come from owning 50 different things. They come from owning a huge piece of a few truly extraordinary things.
Okay, so we've talked about preserving capital, building a philosophy, being patient, and then acting with massive conviction. The big question now is, what do you do with all this? How do you take these ideas and actually make them your own? Right? It's easy to sit here and admire what Buffett and Soros do, but how do you actually start to rewire your brain to think more like them? Where do you even begin?
Well, the book lays out a pretty clear path to get started, just 3 steps. First, take an inventory. Be brutally honest with yourself about your current habits. Are you a losing investor? Are you chasing hot stocks? Be real. Second, define your niche. What do you understand better than almost anyone else? What's your real circle of competence? Specialize there. And third, start actually building your philosophy. Write it down. What do you believe about how markets work? What makes a great investment for you? Make it real.
And that really is the whole secret. The paradox of Buffett and Soros isn't a paradox at all once you realize they're just playing a different game. They aren't playing make the most money. They're playing never lose. And because they focus on that, they end up winning bigger than almost anyone in history. So the question I want to leave you with is pretty simple. What game are you playing?
So what if I told you that the real secret to becoming a world-class investor has almost nothing to do with what you think it does? Predicting the market, diversifying your portfolio, or even how smart you are. Nope. Today, we're going to pull back the curtain on the hidden psychological key, these incredibly powerful mental habits that are shared by 2 of the world's absolute greatest and most wildly different investors. All right, so here's how we're going to break it all down. First, we'll kick things off with a pretty fascinating puzzle, a real paradox between 2 investment titans. Then, we're going to uncover their surprising shared secret. To make it all click, we'll use a super simple analogy about spelling. From there, we'll dissect the anatomy of any mental habit. And finally, we'll tie it all together and see how this applies to your mind and your money.
All right, let's jump right into the central mystery. We are talking about 2 absolute legends of the financial world. And on the surface, you couldn't find 2 people who are more different in how they approach the whole game of making money. Okay, so in one corner, you've got Warren Buffett, right? The sage of Omaha. His whole game is long-term value investing. He finds these amazing businesses, and as he famously says, his plan is to own them forever. Now, on the complete flip side, you have George Soros, the man they call the man who broke the Bank of England. His world is all about fast-paced, high-stakes speculation. We're talking huge, leveraged bets on things like currencies. I mean, their methods are truly night and day. But here's where it gets really interesting. Despite these polar opposite strategies, their results, well, they're just undeniable. Both of them have track records showing decades of absolutely phenomenal, market-crushing returns. It's kind of staggering, really. And it just makes this whole paradox even deeper. And when I say phenomenal, I mean the numbers are just insane. Let's take Buffett. His average annual compound rate of return, a massive 24.4%. Now, to put that into perspective, if you had invested just $1,000 with him back in 1956, by 2003, it would have grown to nearly $30 million. Just, wow. That's one way to get to the top for sure. But then you look at Soros and get this, his number is even higher, an incredible 28.2%. $1,000 with him starting in 1969 would have turned into almost $6 million. So the evidence is just undeniable, right? Two totally different roads, and yet they both lead to the absolute pinnacle of financial success. So that brings us right back to the million-dollar question, doesn't it? With such wildly different methods, what on earth could these two giants possibly have in common? What's the secret sauce? What's that one unifying thread? So where do we even start to look for the answer? Well, it turns out it's not in their strategies, or their spreadsheets, or any of their market analysis. No, the secret is buried way deeper. It's inside their own psychology. See, it's not about what they do, it's all about how they think. You know, when you actually peel back the layers and look past their surface-level tactics, some really surprising similarities start to pop up. For starters, they share the exact same fundamental beliefs about how markets actually work. And get this, they're not even primarily in it for the money. What they are obsessed with is not losing money, way more than they care about making it. And you can forget everything you've ever heard about diversification. These guys do the exact opposite. They concentrate their investments. And their success? It has absolutely nothing to do with predicting the market. So here's the absolute crucial point. Their incredible success is built on a shared foundation of something we call mental habits. Now, these aren't just, good ideas they have. They are learned responses that have become so automatic, so deeply wired into their brains through repetition, that they're basically running on autopilot. It's subconscious. These habits are guiding their conscious decisions without them even having to think about it. It's like breathing for them. I know, mental habits can sound a little abstract, right? So to make this powerful idea really hit home and be super easy to grasp, let's use a simple, everyday example. Let's talk about spelling. Okay, think about this for a second. The real difference between someone who's a great speller and someone who struggles, it isn't intelligence. It has nothing to do with their IQ. It all boils down to the internal mental strategy they use without even realizing it. This is such a brilliant way to understand the core idea. So, good spellers, they have this automatic subconscious habit. They visualize the word. They literally see it in their mind's eye and just kind of copy it down. But poor spellers, they often use a totally different strategy. They try to sound it out, phonetically. It's a conscious auditory thing that, let's be honest, just doesn't work very well in a quirky language like English. And that right there is the key. A tiny shift in an invisible internal strategy creates a massive difference in the results you get. Okay, so now we get what a mental habit is and the huge impact it can have. So let's break down the how. What's the universal structure? What are the building blocks that hold any mental habit in place, whether we're talking about spelling or, yes, investing? It turns out every single mental habit is held up by 4 pillars. Think of it like a 4-legged stool. First, there's a core belief. This is the idea that drives everything. That belief then triggers a mental strategy. That's the little movie or voice inside your head. That strategy creates a sustaining emotion, a feeling that reinforces the whole thing. And finally, you need the associated skills to actually pull it off. All right, to really see this 4-part framework in action, let's step away from the markets for just a second. Imagine we're at a party. We're going to watch 2 very different people and break down their mental habits. Let's call one the icebreaker and the other the wallflower. So the internal programming, that mental habit we've been talking about, for an icebreaker is just fundamentally different from a wallflower. And this is huge. It's not about their personality. It's not that underlying structure of belief, strategy, and emotion that's driving how they act in that room. So let's look at the icebreaker first. Their core belief is simple. people are interesting. This belief kicks off a mental strategy where their internal voice says something like, I wonder what their story is. This creates an emotion of curiosity, maybe a little excitement, and that positive feeling makes it super easy for them to use their skills, making eye contact, listening, building rapport. See how it's a positive feedback loop? Now let's flip it and look at the wallflower. Their habit might be built on a totally different self-limiting belief, like I'm not good enough or people will just reject me. That belief triggers a mental strategy of replaying past failures or rejections in their head. The emotion that comes from that? Hurt, fear. And what does that do? It completely shuts down their ability to use any social skills they might have. The habit itself is the very thing stopping them from even trying. Okay, so what in the world does a wallflower at a party have to do with investing like Warren Buffett or George Soros? Well, everything, actually. Let's bring this all back to the world of finance and see exactly why this framework is so critical for your own success. The connection is incredibly direct and powerful. See, just like that wallflower is paralyzed by their beliefs, an investor with a deep-seated, self-limiting belief will find that that belief completely overrides any skill or strategy they try to learn. You can read every book, you can go to every seminar, but if that underlying mental habit, that internal programming is flawed, you're just not going to succeed. And this quote from the source material just says it all perfectly. An investor who subconsciously believes that I don't deserve to make money or I'm a loser cannot succeed in the markets no matter how many skills he learns or how hard he tries. I mean, let that sink in. They're basically programmed for failure. Their own mental habit will sabotage every move they make. At the end of the day, your internal beliefs are the ultimate gatekeeper to your success. But here's the most important and honestly the most empowering part of this entire discussion. These mental habits, these core beliefs, they're not fixed. They're not set in stone. They aren't just who you are. Remember the speller? They learned a new strategy. And just like them, you have the power to look at your own habits and actively choose to learn and install the kinds of mental habits that the masters use. And this all leads us to one final pretty provocative thought. Turns out there are very common, very destructive beliefs that are behind most investors' losses. The author actually calls them the 7 deadly investment sins. And that really just leaves us with a critical question to ask ourselves, doesn't it? What self-limiting beliefs might be quietly, subconsciously shaping your own financial reality right now? All right, let's dive right in. We're about to tackle one of the biggest questions in finance, a real mystery that gets even the absolute pros turned around. You know the feeling, right? You've done the homework, you've read the reports, you're following everything like a hawk. But when you look at your account, the results just aren't there. It's maddening. So what is going on? Why does this happen over and over again? Well, here's the secret. The problem isn't that you don't know enough. The problem is that a lot of what you think you know is just plain wrong. There's a set of mistaken beliefs, almost like mental viruses, that infect our decision-making. And today, we're calling them out. The 7 deadly investment sins. So let's start with the big one, the fallacy that almost every other mistake is built on. I'm talking about the myth of prediction. This is deadly sin number 1. It's this idea that to win at investing, you need some kind of crystal ball. You have to know what's coming tomorrow, next week, or next month. But here's the thing. The legends, guys like Warren Buffett and George Soros, they'd be the first to tell you, if their success relied on predicting the market, they'd have gone broke a long, long time ago. And check out this quote from Soros himself. This isn't just him being humble. This comes from a place of painful experience. Back in October 1987, Soros was absolutely convinced the Japanese market was about to crash. He was so sure he wrote about it in the Financial Times. Well, a week later, a crash did happen, but it was on Black Monday in the US. His fund lost over $350 million in a flash. That single mistake wiped out all his profits for the entire year. So yeah, he means it. Okay, so if we admit that we can't see the future, what's our next move? Well, for a lot of people, it's to find somebody who can. And that leads us right into our next couple of sins. This brings us to the guru belief, the idea that there's a financial wizard out there who has it all figured out, and if you can just find them and listen to them, you'll be rich. But let me ask you a serious question. If you could actually reliably predict the future, would you be selling your secrets in a newsletter for $99 a year? Or would you just keep quiet, open a trading account, and become the richest person in human history? Let me show you a textbook example. Meet Elaine Garzarelli. In 1987, she absolutely nailed one huge call, predicting the Black Monday crash. Boom! Overnight, she's a media superstar. By the next year, people are throwing money at her fund, which balloons to $700 million. But then what? Well, by 1994, the fund was quietly shut down because it just wasn't performing. And by 1996, her public track record was frankly terrible. Out of 14 big predictions, she only got 5 right. That's a 36% success rate. You would have literally done better just flipping a coin. And here's the cost of believing in the guru. Look at this chart. Over the entire time her fund existed, you would have made less money with her than if you had just put your cash in a simple, boring S&P 500 index fund and gone to the beach. And believe me, she's not alone. History is just littered with these one-hit wonder gurus. You had Joe Granville, who famously screamed, "Sell everything," right before one of the biggest bull markets in history took off. You had Robert Prechter predicting a catastrophic crash in the 90s while the market just kept soaring. It's a pattern, and it's a dangerous one.
Now, this sin is basically the guru's cousin. It's this myth that the key to getting rich is getting a hot tip or some secret piece of inside information. You know what Warren Buffett says his #1 source for investing ideas is? The company's annual report, something that anyone can download for free, no secrets required.
And that's why this quote from Buffett is so brilliant. Chasing secrets and rumors isn't a shortcut to wealth. In fact, it's usually a shortcut to making panicked, terrible decisions based on incomplete noise. It's a distraction, not an advantage. Okay, let's move on to the next section, sins of strategy and risk. Here, we're going to blow up a couple of the most common pieces of advice you hear from Wall Street, ideas that the true masters of the game just flat out ignore. So deadly sin number 4 is one you've heard a million times. Diversify, diversify, diversify. But what this often turns into is the sin of over-diversification. Wall Street sells it as safety. Spread your bets across tons of tiny holdings. But you know what that really does? It pretty much guarantees you'll get a mediocre return. The master investors do the exact opposite. They don't plant 100 tiny flowers. They find a half-dozen giant oak trees and they water them. A lot. They find their best ideas and they concentrate their bets. All right, this one is a huge one. It's the core belief that to make big money, you've got to take big, flashy risks. That investing is about gambling and going for broke. This is probably one of the biggest misunderstandings about how real wealth is actually built. This quote just nails it. It comes from a story about a successful entrepreneur at a conference. The academics on stage kept going on and on about how entrepreneurs are risk takers. Finally, the guy stands up and says, "What are you talking about? My entire job is to find every possible risk and eliminate it." And that's the mindset. Successful investors aren't risk takers, they are obsessive risk managers. Let that one really sink in for a second. The #1 rule isn't how much can I make, it's how do I make sure I don't lose the money I already have. Preserving your capital is the name of the game. Big profits are the byproduct of not losing money first. We've now come to the final act, and these last sins, these are the most dangerous of all, because they don't have to do with the market or gurus or strategies. No, these ones live inside your own mind. These are the psychological traps we lay for ourselves. This is the hunt for a magic formula, the system belief, the idea that there's some piece of software or some secret indicator that just works, no questions asked, a holy grail that will just print money for you. As Buffett once said, people are looking for a formula, and it's a total trap. They want to turn off their brain and let a system do the work. It never ends well. And here we are, the deadliest sin of them all. This goes beyond just trying to predict things. This is the absolute bone-deep certainty that you know what's going to happen and that the market has no choice but to agree with you. It is pure arrogance, and it makes you blind to any evidence that you just might be wrong. And history is practically screaming at us about this one. Every single market bubble, right before it bursts, is filled with this kind of absolute certainty. Right before the 1929 crash, a famous economist said stocks had reached a permanently high plateau. During the dot-com bubble, the mantra was, profits don't matter. Absolute certainty is the final warning sign before the cliff. So, after all that, after tearing down gurus, predictions, and systems, what's left? Where do we find the real Holy Grail? Well, it turns out the answer isn't out there somewhere. It's a lot closer to home.
This says it all. The author of the book this is all based on had this huge realization. The enemy wasn't the market. It wasn't a lack of information. The enemy was himself, his own biases, his own impatience, his own poor mental habits. The key wasn't to find a secret. It was to fix himself.
And so that's the question I want to leave you with. As we've gone through these 7 sins, the need to predict, the search for a guru, the myth of risk, the danger of certainty, be really honest with yourself. Which one of these is living in your head right now, quietly costing you money? Because seeing it, truly seeing it, is the first and most important step to getting rid of it for good.
Okay, let's just jump right in. What if I told you there's a fundamental rule that separates the world's greatest investors from everybody else? It's not about finding the next hot stock. It's not about timing the market just right. It's something way more elemental, and honestly, it's kind of counterintuitive. Today, we're going to unpack the one single principle that legends like Warren Buffett and George Soros built their entire empires on. You have to start with this one, right? It's probably the most famous quote in all of investing. It sounds so simple, almost like a joke. But Warren Buffett is dead serious. This isn't just some clever little phrase. It is the absolute bedrock of his entire philosophy.
And just to show you this isn't some one-off idea, here's George Soros saying the exact same thing, but with a totally different, almost primal energy. Survive first. Think about that. The implication is that the market can be a battlefield, and your number one job is just to live to fight another day. And finally, investor Larry Hite just boils it all down into an analogy anyone can get. This is brilliant. It lays out the core logic so clearly. See, it's not about being afraid to take risks. It's about making sure you can stay in the game. Once your capital is gone, it's game over. No more bets, no more wins. Simple as that. So this is the fundamental split. This is the fork in the road. On one side, you've got the master investor. Their top priority, always, is preserving capital. On the other side, you have the losing investor, who's just driven by one thing, make a lot of money. And because of that, they usually fail to keep the money they have. This one difference in mindset, it changes everything. All right, so here's our game plan. We're going to start with 2 incredible stories of survival. Then we'll decode the strategy that they both stumbled upon. After that, we'll get into the painful, brutal math of what happens when you lose. And finally, we'll see how you can use all this to build your own foundation for wealth. First up, George Soros. You know, to really understand his obsession with survival in the markets, you have to go back to a time and place where survival was literally the only thing that mattered. The scene is Budapest, Hungary, 1944. George Soros is just a kid, 14 years old, and his entire world is about to be completely shattered. So, the Nazis invade. For a Jewish family like the Soroses, being discovered, well, that meant certain death. But his father, Tivadar, he was something else. He'd already survived the Russian Revolution as an escaped prisoner of war. Soros called him a grand master in the art of survival. He'd already sold his assets, and he got false papers, hiding his whole family under new identities. Their entire existence was boiled down to a single goal: just survive. And this is the critical lesson Soros learned from his dad. In extreme situations, the old rules don't just fail you, they can actually kill you. He saw firsthand that sometimes breaking the rules is the only way to survive. That mindset, that ability to adapt to a dangerous changing reality, would directly shape how he attacked the financial markets decades later. And here's the real kicker. That experience was so deeply ingrained in him that even as a billionaire investor, Soros felt that any loss in the market was a step back towards that life-or-death struggle. It wasn't just numbers on a spreadsheet. For him, it was a visceral, real threat to his very survival. Okay, now let's travel halfway around the world, where another investing legend was being shaped by a totally different kind of crisis. Our story shifts to Omaha, Nebraska, 1930, the very same year Soros was born. But this wasn't a world of invading armies. It was a world of collapsing banks and financial ruin, right at the height of the Great Depression. Buffett's father was a stockbroker, and he lost everything when his bank went under. That early raw experience with financial disaster left a mark on young Warren. It gave him a deep, deep hatred of losing money. His goal wasn't just survival. It was to build a fortress of wealth so strong it could never be knocked down.
He famously told his friends he'd be a millionaire by 35. For him, the fun wasn't in spending the money, but in the pure joy of making it. And this is key, watching it grow.
This anecdote just says it all, doesn't it? It perfectly captures how Buffett's mind works. When his wife spent 15 grand, he didn't see a one-time purchase. No, he saw the millions of dollars that money could have become through the magic of compounding. For him, spending money wasn't just spending. It was murdering its future potential. And losing money, that was the ultimate crime against compounding. So you have these two totally different origin stories, one forged in the fires of war, the other in economic collapse, and yet both men arrived at the exact same conclusion. And that conclusion completely demolishes one of the biggest myths in investing. This is what almost everybody believes, that risk and reward are symmetrical, a perfect balance. To get a big win, you have to be willing to take a big loss. I mean, it sounds logical, it even sounds fair, but it's a mindset that leads so many investors straight to ruin. So let me just ask you, what if that core belief, that big rewards demand big risks, is just fundamentally wrong? What if it's not a rule but a trap? And this right here is the secret. This is the game the masters are playing. See, they aren't looking for a 50-50 coin flip. Their entire process, their whole system, is built from the ground up to find these asymmetric opportunities, what Buffett calls high-probability events. They're hunting for deals where the potential upside just massively outweighs the potential downside. They want the bets where they can make $1,000 while only risking 100. You know, think about it like driving a car. Your conscious goal is to get to the grocery store, right? But your unconscious, fundamental rule is survival. You're not sitting there thinking, don't crash, don't crash, don't crash. No, you just automatically do the things that ensure survival, like keeping a safe distance from the car ahead. Well, master investors do the exact same thing. Keeping their capital safe is built so deeply into their process that it just becomes automatic. Okay, so let's shift from the strategy to the stakes. Why are these legends so completely fanatical about not losing money? Because they understand the brutal, unforgiving, and frankly terrifying math of recovery. Let's walk through this slowly because it is so important. You start with $100. You lose 50%. Easy math, right? You've got $50 left. But here's the trap. To get back to your original 100, you don't need a 50% gain. You need a 100% gain. You have to double your remaining money just to get back to even. The hole is always, always deeper than it looks. And look, this isn't just some classroom theory. This happens in the real world. Check out these massive wipeouts. Long-term capital management, a fund run by Nobel Prize winners, took 4 years to make $5 billion, and they lost $4.6 billion of it in just 6 months. Or take Victor Niederhofer, 20 years to build a fortune of $130 million, and he lost it all in 1 day. Their systems were great at making money, but they forgot the first rule: keep it. And in the end, the brutal math just destroyed them. So what's the big takeaway here? It's that avoiding the big, catastrophic loss isn't some defensive, scared little strategy. No, it is the only foundation upon which real, lasting wealth can possibly be built. It's the first habit you have to learn because every other habit depends on it. And that really brings us to the final question, the one you have to ask yourself. As you go forward from here, what's your true North Star? Is it the thrill of making money, or is it the discipline of keeping what you have so you can stay in the game and let the awesome power of compounding work for you for years and decades to come? Today, we are going to tear apart one of the biggest myths in investing. You know the one, high risk, high reward. We're all taught that to make big money, you've got to take big chances. But what if I told you that the absolute legends of the game, people like Warren Buffett and George Soros, built their massive fortunes on the exact opposite idea? They don't just manage risk, they run from it. You know, think about the last time you talked to a financial advisor. They probably use some fancy term like, what's your risk profile or what's your risk tolerance? But let's just cut through the jargon, right? What they are really asking you is, hey, how much money are you okay with losing? The whole conversation starts with the assumption that losing is just part of the deal. And right there, that's the trap. This idea, this belief that you have to risk a big chunk of your cash just for the chance of making another big chunk, that's the conventional wisdom that sinks most investors. But the masters? Well, they're playing a completely different game with a completely different rule book.
And look, the difference couldn't be more stark. It's not some subtle little thing. The average investor, the losing investor, accepts that risk-reward trade-off like it's a law of physics. But the master investor? Oh, they are passionately, fundamentally, almost obsessively risk-adverse. Their number one job before anything else is to not lose money, period. That's not just a strategy for them, it's their entire philosophy. So how are we going to unravel this whole paradox? Well, we're going to do it together, step by step. First, we'll absolutely demolish the risk-reward myth. Then we're going to redefine what risk even means. After that, we'll walk through the 4 stages of learning that every master has to go through. Then we'll get into the nitty-gritty of how they avoid risk. And finally, we'll wrap it all up with the one big idea you need to remember. All right, let's get into it. First up, the risk-reward myth. This is the big one. We're about to see exactly why the giants of the investing world just shake their heads at what most of Wall Street considers common sense. And this quote from Warren Buffett, it just says it all, doesn't it? For him, investing isn't about balancing some scale of risk versus reward. It's about one thing: certainty. If you're certain about an outcome, the whole idea of risk just, poof, it disappears. He's not looking for a coin flip on a huge payday. He's hunting for what he calls high probability events, situations where the odds are so stacked in his favor, it's almost a sure thing.
So that leads to a really important question. What even is risk? We think of it as something out there, like this stock is risky or this market is risky. But what the masters understand is that risk isn't a property of an investment. It's a property of the investor. It's not absolute. It's all about context. Just think about it. Imagine a construction worker casually walking on a steel beam 60 stories up, or an Olympic skier bombing down a mountain that looks like a cliff. To you and me, that's terrifying. It's the definition of risk. But to them, it's just Tuesday. Why? Because they have knowledge, experience, and a deep, deep competence. The risk isn't in the beam or the slope, it's in the gap between what the situation demands and what the person can do.
And here's the crazy thing. You're already a genius at managing this kind of risk, and you probably don't even know it. Every single time you get behind the wheel of a car, your brain is doing this incredible dance, subconsciously processing tons of data and making 1,000 tiny judgments a minute. You're constantly calculating probabilities without ever thinking, what are the odds here? This state has a name. It's called unconscious competence. Just think about it. The simple act of changing lanes on a busy highway is a complex physics problem, a multi-body problem that could literally stump a physicist with a supercomputer. And yet, you just do it. You see the gap, you check your mirrors, and you go. That's because your experience is so baked in that the complex stuff feels simple. That is the zone where the master investors live and breathe.
So, the big question is, how do you get to that zone? Well, there's a roadmap. This next part lays out the path that everyone, and I mean everyone, has to travel to get to that state of effortless mastery, whether you're learning to drive, to ski, or, yes, to invest.
And here they are, the 4 stages. You start at stage 1, unconscious incompetence, which is a fancy way of saying you don't even know what you don't know. Then reality hits, and you move to conscious incompetence. Now you know you're clueless. Stage 3 is conscious competence. You can do the right thing, but man, it takes a lot of focus and effort. And finally, you arrive at stage 4, unconscious competence. You're in the flow, it's automatic, you're a master. Now, we have to talk about stage 1, because this is without a doubt the most dangerous place to be with your money. This is the beginner who gets lucky on their first couple of trades and suddenly thinks they're a genius. They mistake luck for skill. And that false confidence is an absolute killer, because it leads them to take wild, stupid risks that eventually blow them up. The source material tells this perfect, chilling story about this. A company president got stuck in a bad trade. All the experts told him to get out, but he held on and got lucky. He made a tiny profit. But here's the problem. He learned the absolute wrong lesson. He basically decided that if you ever find yourself in a minefield, the best strategy is to just close your eyes and run. Well, less than a year later, that firm was totally broke. Now, let's jump ahead to stage 3, conscious competence. This is where you know what to do, but it's not second nature yet. You could follow the exact same steps as Warren Buffett to analyze a company, but what takes him 10 minutes running numbers in his head might take you 10 weeks of building spreadsheets and double-checking everything. You have the knowledge, but the execution is still clunky and slow. It really is the difference between knowing the path and having walked it 1,000 times. Okay, so once someone actually reaches that level of mastery, what do they do to avoid risk? This brings us to our next section, the practical, repeatable strategies that the pros use to just take risk right out of the equation. So, the source lays out 4 main strategies. First, and maybe most important, is the discipline to simply not invest if you can't find a sure thing. Second is to reduce risk by buying things for way, way less than they're actually worth. Third is to actively manage risk. That means cutting your losses fast and without emotion when you realize you're wrong. And the fourth is to manage risk like an insurance company, making a lot of small bets where you have a statistical edge. Let's dig into a couple of these. Strategy number 2, reducing risk, is pure Buffett. Just look at when he bought the Washington Post back in the 70s. Wall Street was in a full-blown panic. The market was crashing. The stock was tanking. They were terrified. But Buffett, he ignored all that noise. He looked at one thing, the actual business. And what he saw was a fantastic $400 million company being offered to him for just $80 million. For him, buying $1 for 20 cents isn't a risk. It's the safest thing in the world. Now, for a totally different tactic, let's look at strategy number 3, actively managing risk. And this is George Soros' turf. His ultimate test came on Black Monday in 1987. Soros was betting heavily that the Japanese market would crash, but instead, the US market fell off a cliff. His whole theory was instantly wrong, and his fund was hemorrhaging money. Its very existence was on the line. So what did he do? Did he wait and hope? Did he double down? No way. He lived by a simple rule, survival first. He just got out. He liquidated his positions, took a massive hit, but he saved the fund. He lived to fight another day. And because he was so quick to admit he was wrong and cut his losses, he was actually back in the market a few weeks later. And get this, he ended 1987 with a profit. Incredible. Finally, there's the actuarial strategy. And to get this, you have to see the huge difference between a regular gambler and a professional one. The amateur is all about hope, emotion, and swinging for the fences. The pro couldn't care less about hope. They are cold, calculating machines. They play the odds, they have a system, and they follow it without emotion, knowing that over hundreds or thousands of bets, their tiny edge will make them a fortune. This is exactly how an insurance company works, right? They have no clue if your house is going to have a fire this year, but they know with almost perfect certainty how many houses out of 10,000 will. Benjamin Graham, Buffett's teacher, did the same thing with stocks. He'd buy dozens of cheap companies, not knowing which one would be a home run, but knowing that as a group, the winners would more than make up for the losers. It's just a numbers game. Which brings us all the way back around to our ultimate takeaway, and it's summed up perfectly by Buffett himself. Risk comes from not knowing what you are doing. That's it. That's the whole secret. The market isn't risky. Stocks aren't risky. Ignorance is risky. The masters aren't better at handling risk. They're just so good at what they do that for them, the risk just isn't there. So I want to leave you with this question to think about. What's an area in your life where you've already achieved that unconscious competence? Maybe it's a sport, a hobby, your job, whatever it is. That feeling you have, that effortless control where you just know what to do, that's mastery. So the real question is, how can you take that same mindset, that same dedication to learning, and apply it to your money? How can you move from being a dangerous novice to a true risk-averse master? Have you ever wondered what really separates legendary investors, guys like Warren Buffett and George Soros, from, well, everyone else? It's not some secret stock tip or a magic algorithm. Nope, it's something much deeper. It's a hidden blueprint, a personal philosophy that guides their every single move. And today, we're going to pull back the curtain on that blueprint and show you how to start building your own. This quote from Bertrand Russell, wow, it cuts right to the bone, doesn't it? Because in investing, and maybe in life, the absolute hardest work, and the most profitable, is just thinking for yourself. It's the one skill that truly separates the masters from the masses. So before we jump into the minds of these legends, let's just pause for a second. Think about it. What really drives your financial decisions? Is it a headline you saw this morning, a tip from a buddy, or is there something more to it? Because understanding your own starting point is the first step to getting where they are. All right, here's our game plan. First, we'll lay the foundation with this idea of an investor's blueprint. Then we'll introduce you to a very, eccentric character who actually unites our two masters, the one and only Mr. Market. From there, we'll go deep into the detective work of Warren Buffett, then the philosophical world of George Soros, before we finally reveal the ultimate edge that they both share. You know, every single decision an investor makes, whether they buy, sell, or just sit on their hands, It all comes from their investment philosophy. But here's the catch. Most people don't even realize they have one. They've just kind of absorbed a mishmash of ideas from the world around them, and a lot of those ideas totally contradict each other.
This slide, right here, draws a perfect line in the sand. A master investor puts in the hard work to build their own unique philosophy, one that fits their personality like a glove. A losing investor, on the other hand, either has no real philosophy at all, or, and this is just as dangerous, they just borrow someone else's without ever truly understanding why it works.
So, what is this philosophy we keep talking about? Well, think of it as your personal rulebook. It's your core set of beliefs about how the game is played. It's the mental fortress that protects you from the market's endless emotional storms, stopping you from getting swept up in the hype of a boom or the sheer panic of a crash. Now, this is where things get really fascinating. Buffett and Soros, they have these wildly different approaches, right? But they both start from the exact same radical idea. They share one core belief that puts them completely at odds with most of Wall Street. The market is fundamentally irrational. They both looked at the market and said, you know what? This thing is nuts. And to really get this, we have to meet a character created by Buffett's mentor, the great Benjamin Graham. Just imagine for a minute that the entire stock market is a single person. He's your business partner, and his name is Mr. Market. Every single day, he shows up at your door and offers to either buy your shares from you or sell you his. And as Buffett explains so brilliantly, this partner of yours is, well, he's not exactly stable. Mr. Market is a textbook manic depressive. One day he's euphoric, convinced your business is the greatest thing ever, and he offers you a ridiculously high price. The very next day, he's terrified, seeing nothing but doom and gloom, and he offers to sell you his stake for pennies on the dollar. So here's the secret to dealing with Mr. Market, and it's absolutely crucial. 1, he is there to serve you, not the other way around. 2, his wild mood swings are his problem, not a true reflection of your business's value. And 3, this is the best part, you are totally free to either ignore his crazy offers or, when he gets particularly manic or depressed, you take advantage of his foolishness. Okay, let's dive into our first master, Warren Buffett, and see how he built an entire empire around this idea of Mr. Market. His journey wasn't a straight line, though. It was an evolution, a transformation from being a pure number cruncher into a kind of business detective, always searching for the clues everyone else overlooks. See, Buffett started out as a pure disciple of Benjamin Graham, who was all about the numbers. His whole thing was finding what he called cigar butt companies, businesses that were so cheap they had one last free puff of value in them. But Buffett was also deeply influenced by another thinker, Philip Fisher, who was all about the qualitative stuff, finding truly outstanding companies and holding them pretty much forever. Buffett's genius was in merging these two opposing worlds. And this new blended philosophy was put to the ultimate test back in 1963. A subsidiary of American Express got caught up in this massive fraud. It was called the salad oil scandal. A company was using Amex receipts to get loans for giant tanks of salad oil that turned out to be mostly seawater. Amex was on the hook for a potential loss of $60 million, which was a mind-boggling amount of money back then. Wall Street completely panicked. So instead of just looking at the numbers like his mentor Graham would have, Buffett put on his Philip Fisher hat and asked a totally different question. Has the brand, the actual franchise of American Express, been damaged? And to find the answer, he literally became a detective. He went to his favorite steakhouse and just watched people, and they were still using their Amex cards. He talked to banks, travel agents, even competitors, and the evidence was overwhelming. Mr. Market was panicking, but the actual business was perfectly fine. So Buffett bought big and made a fortune.
All right, now let's pivot to our second master, George Soros. He reached the exact same conclusion, that the market is always wrong, but from a completely different universe. While Buffett became a detective of business value, Soros became a philosopher of market behavior. And his secret weapon was this powerful theory about how our beliefs can literally shape reality itself.
Soros's big idea is called reflexivity. Now, it sounds complicated, but the core concept is actually a feedback loop. See, in most of life, our thinking and reality are two separate things, but in financial markets, they're tangled together. What investors believe about a stock can actually change the facts about that stock, which then circles back and changes what investors believe all over again. Let's just walk through this loop. Imagine investors start to perceive that a stock is a winner, so they buy it, which pushes the price up. Now that rising price is a new fact. This new fact makes investors feel richer, so they spend more money in the real world. that extra spending actually boosts the company's profits, improving the fundamental facts of the business. Analysts see these better facts, change their perceptions, and recommend the stock even more. The belief literally created its own reality. It's wild.
And Soros used this theory to see entire boom and bust cycles like a four-act play. Take the real estate investment trusts, or REIT, boom in 1969. He saw it all in advance. Act 1, the new trend begins. Act 2, that self-reinforcing loop kicks in and creates a massive boom. Act 3, the cracks start to show. And Act 4, the inevitable, dramatic collapse. Seeing this pattern allowed him to profit on the way up and on the way down.
Here is a fantastic way to think about it. Soros basically sees the market as being like the women's fashion industry. There's no objective, fundamental reason why one style is in this year and out the next. It's all driven by a constantly changing set of beliefs about what's cool. And just like in fashion, in the market, perception is reality. So we have two masters who took two completely different paths to get to the top of the same mountain. Buffett looks for timeless business value that our crazy friend Mr. Market gets wrong. Soros looks for flawed beliefs that create these powerful reflexive trends. But what is the ultimate edge they both share? It's not the method, it's the mindset.
This slide just sums it all up perfectly. Buffett's goal? Buy $1 of value for 50 cents, using his manic depressive partner to get that price. Soros's goal? Find a trend that will turn $1 into $3, using his understanding of the fashion-like nature of markets. Two totally different games, both played at the absolute highest level.
And this quote right here, it gets to the absolute heart of it. The single biggest factor that sets these investors apart is the sheer amount and quality of their thinking. For them, wealth isn't about luck. It's the direct result of their ability to think independently and rigorously when everyone else is following the herd. But even the greatest philosophy in the world is useless without the right psychology to back it up. And deep down, both Buffett and Soros share these core beliefs. They genuinely believe they deserve to succeed. They take absolute 100% responsibility for their results. They know that they, not the market, are the cause of their profits and losses. And that gives them the unshakable confidence to act, especially when everyone else is running for the hills. So we've seen how Buffett became the detective and Soros became the philosopher. They both did the incredibly hard work to build a framework that gave them a unique edge. They rejected the noise and they found their own signal. So the question we're left with is, what's yours going to be? What unique lens will you build to see the market not just for what it is, but for what you know it to be?
All right, let's get right into it. What makes an investor truly successful? It's not some secret formula or a hot stock tip. Not at all. It really comes down to their system. And what's so fascinating is that the best systems, they're deeply personal. What you decide to measure, that's what ends up defining everything. The legendary trader Ed Sikota just hits the nail on the head here. The secret isn't finding the one perfect system out there. It's about building a system that's perfect for you. It has to match your personality, right? Your temperament, how you see the world. Because if it doesn't, you're never going to have the conviction to stick with it when the chips are down.
And this image, well, it perfectly captures the core difference. You see, the master investor has put in the work. They've built, and this is the important part, they've tested their own system. The losing investor, they just try to copy someone else's. And when it doesn't work, which it won't, because it's not a personal fit, they just jump to the next hot system, making the same mistake all over again.
So this really brings us to the big question, doesn't it? What is it that truly separates these two? It's not just having a system, it's about what that system is built on, what it actually measures, and how it's a true reflection of the person behind it.
And to really dig into this, we're going to look at two of the absolute titans of investing, Warren Buffett and George Soros. I mean, these guys are masters, but their playbooks could not be more different. And the key to unlocking how they think is to ask a simple question. What does each of them choose to measure?
And here it is right here in a nutshell. Buffett is obsessed, and I mean obsessed, with the quality of a business. Is it built to last? Does it make good money? Is it run by smart people? Soros, on the other hand, he's a grand chess master. He's not measuring the business, he's measuring the quality of his hypothesis about the market. He's looking for cracks in the system that he can exploit. Totally different yardsticks for success.
But here's where it gets really interesting. If you actually break down their systems, you find something amazing. Even though their core beliefs are polar opposites, they both have answers to the same 12 critical questions. Things like, what to buy, when to sell, how to handle mistakes, how to use leverage. They both build a complete system. It's just that their answers are wildly different. So, let's see these systems in action.
We're going to start with George Soros, and maybe his most legendary trade ever. The one that got him the name, the man who broke the Bank of England. This is a true masterclass in measuring a hypothesis as world events unfold around you. So here's the setup. You have all these huge geopolitical events creating this massive contradiction. Britain pegs its currency to Germany's, but then the Berlin Wall falls and German reunification forces Germany to jack up interest rates to fight inflation. This happens at the exact same time Britain is stuck in a recession and desperately needs to lower rates. You see the problem? The whole system was being pulled apart. It was a ticking time bomb. And Soros, he actually has a name for this kind of situation: dynamic disequilibrium. He saw that this system, the ERM, which looked stable on the surface, had been totally broken by a huge event: reunification. He knew the German central bank, the Bundesbank, had one job: protect its own currency, even if it meant blowing up the whole ERM. For Soros, this wasn't just chaos. It was a crystal clear, massive opportunity.
And this was the light bulb moment. The president of the German Bundesbank gave a speech and hinted that, some of the currencies in the system were weak. For almost anyone else, it would have gone unnoticed. But for Soros, it was a massive signal. The Bundesbank wasn't going to bail anyone out. His hypothesis was just confirmed by the most important source possible. He got the message.
And when Soros has that kind of conviction, he doesn't just dip his toe in. He goes all in. He built a mind-boggling $10 billion bet against the British pound. Now, to put that into perspective, his entire fund was only worth about $7 billion at the time. He was using incredible leverage because his measurement, his hypothesis, told him the odds were just stacked completely in his favor. But this wasn't just some simple bet. This is where you see the genius of Soros. He understood the domino effect. So yeah, he shorted the pound, but he also bought the strong German mark. He shorted other weak currencies he knew would also be under pressure. And then he bought British stocks, figuring they'd rally once a cheaper pound made British exports more competitive. It was a complex, beautiful trade built on one single, powerful idea. The result? It was historic. On September 16, 1992, a day now known as Black Wednesday, the Bank of England gave up. They just couldn't defend the pound anymore and had to pull out of the ERM. Soros's fund reportedly made $2 billion. His measurement of his hypothesis was proven right in the most spectacular way possible. Okay, now let's do a complete 180. We're going from Soros's high-speed global chess match to Warren Buffett's slow, methodical hunt for a business goldmine. His target was Coca-Cola. And for Buffett, it's all about one thing: measuring the quality of the business itself.
Buffett's system seems so simple on the surface, right? First, he has to understand the business. No crazy tech he can't get his head around. Second, it needs a deep, durable moat to protect it from competitors. And for Coke, that's its unbelievable brand. Third, and this is so important, it has to have rational management. And finally, he's got to buy it at a good price so he has a margin of safety. For decades, Coke failed one of these crucial tests, so he never touched it.
So why did he wait so long? Well, because for years, Coke's management was not rational. They were taking all this cash from their incredible soda business and buying shrimp farms and wine companies. I mean, can you believe it? The return on their capital was a pathetic 1%. It wasn't until a new CEO, Roberto Goizueta, came in and said, nope, we're focusing on our gold mine, that Buffett finally got interested. That management test was everything.
And this right here, this shows you exactly why that change in management was the magic ingredient. Under Goizueta, Coke's return on equity shot up to an amazing 33%. Now, just look at this math. A company that's compounding its value at 33% a year is worth 8 times more after a decade than a company earning a decent but not great 8%. This is the powerful engine of value creation that Buffett looks for. This metric, return on equity, that was the ballgame.
So we've seen two masters run their personal playbooks to perfection. One, a lightning-fast currency trade, the other, a patient, decade-long investment. Okay, so now let's put their systems right next to each other and see how what they measured drove every single one of their actions. I mean, this is just incredible. Look at how they react to the same event. A stock price drops. For Buffett, it's a sale. A wonderful business just got cheaper, so he wants to buy more. For Soros, a price drop means his hypothesis is wrong, so he sells immediately. He cuts his losses and moves on. Buffett sells when the business itself changes for the worse. Soros sells when the trade is over. And you know what? They're both right, because their actions are perfectly in line with what their systems are designed to measure.
Even the way they use leverage, what Buffett calls rocket fuel, is perfectly tailored to who they are. Soros uses direct borrowing to be fast, to be agile, and to amplify his big bets right now. Buffett, the patient value guy, uses this really innovative form of leverage, the float from his insurance companies. Think about it. We pay our insurance premiums up front, but Berkshire doesn't pay out claims until later. That giant pile of cash just sitting there, he gets to invest it for Berkshire's benefit. It's stable, long-term leverage for a stable, long-term investor.
And yet, with all these huge differences, there is one surprising thing they totally agree on. Both of them think broad diversification is, well, kind of for amateurs. They believe in concentrating their money heavily in their absolute best ideas. When they find an opportunity that perfectly fits their system, whether it's a fantastic business or a flawed currency, they bet big.
Okay, so we've seen these two masters at work, we've taken apart their systems. Now comes the most important part of all. It's time to turn that lens back on ourselves.
Look at how it all connects. This whole complex system, your entry strategy, your exit strategy, how you deal with mistakes, all of it flows from one single place right at the top, your personality. Your goals, what you know, your temperament. You just can't copy and paste Buffett's system and expect it to work for you because, well, you aren't Buffett. Your system has to be a true expression of who you are.
And that, right there, is the ultimate takeaway. Buffett built a system to measure durable, long-term business value. Why? Because it fits his patient, analytical personality. Soros built a system to measure dynamic, systemic change. Why? Because it fits his agile, philosophical mind. They became what they measured. So the question I want to leave you with is a simple one, but it's also a profound one. What will you measure?
Hey everyone, and welcome to The Explainer. Today, we're going to take a hammer to one of the most sacred rules in all of finance, diversification. We're going to dig into a really powerful and, kind of contrarian idea from some of the world's greatest investors, that the safe advice you've always been told might actually be the very thing holding you back from some serious success.
And we're kicking things off with a total bombshell from the Oracle of Omaha himself, Warren Buffett. I mean, just read that again. He's basically saying diversification isn't a strategy for winning, it's just a helmet you wear because you don't know what you're doing. This one idea completely flips conventional wisdom on its head, and honestly, it's the key to understanding a whole different way of thinking about building wealth. And to really see this mindset in action, you gotta hear this legendary Wall Street story. It's got everything: a mentor, a brilliant protege, and a single, four-word question that would become absolute folklore in the financial world.
Okay, so picture this. You've got Stanley Druckenmiller, this brilliant guy managing the legendary quantum fund for his boss, the one and only George Soros. He spots this massive opportunity and takes a huge position shorting the US dollar, which is basically a giant bet that its value is about to tank. He's feeling good, he's in the trade, and it's already making money. So Soros walks over and asks him a pretty simple question. How big is your position? Now, you can imagine Druckenmiller's probably feeling pretty proud of himself, puffing his chest out a bit when he answers, $1 billion. I mean, for just about anyone on planet Earth, that is an absolutely colossal, high-stakes bet.
And this is where the legend is born. Soros looks at this billion-dollar bet, and without missing a beat, he drops this iconic, almost dismissive line. He wasn't knocking the idea. He loved the idea. He was knocking the size. Soros saw the same thing, but he was thinking about its potential on a completely different level.
Soros didn't just question him. He told him to basically risk it all, to double down. Druckenmiller later said that this moment taught him the single most important lesson of his entire career. When you have that tremendous conviction, when you know in your bones that you are right, you don't just dip your toe in the water, you go for the jugular.
And that story just perfectly highlights the two opposing philosophies, right? On the left, you've got conventional wisdom, which tells you to be like a gardener, carefully watering 100 little plants, just hoping a few of them grow. But on the right, you have the Soros and Buffett mindset. Find the one giant oak tree with the most potential and pour all your water there. Because like Soros famously said, when you're right on something, you just can't own enough of it.
Now, if this whole idea still feels a little, reckless to you, let's just take this logic out of the world of investing for a second and see how it holds up in another field where genius is an absolute must.
Just imagine for a second, a financial advisor sits down with a young Bill Gates.
And Bill is pouring every single ounce of his time, his energy, and his money into this little startup he has, a software company. What would that conventional, safe diversification advice sound like? It would sound completely ridiculous, wouldn't it? Whoa, Bill, this software thing is way too risky. You've got all your eggs in one basket here. You need to hedge your bets, maybe make some computer hardware on the side, or, invest in a nice, safe power company. We just know instinctively that this advice would have completely crushed his potential. Or imagine telling the great Luciano Pavarotti, "Hey, Luciano, my friend, this opera business is a tough racket. You should really diversify. Sing some rock and roll. Maybe take a few cooking classes so you have something to fall back on." It's absurd when you think about it in art, and it's just as absurd in business.
You see, people like Bill Gates and Pavarotti became masters for one simple reason: single-minded focus. Spreading your energy and your talent too thin makes you a jack of all trades, but a master of none. This is obviously true in business and art, and what the great investors are arguing is that it's just as true for your money.
The legendary investor Bernard Baruch, the guy who famously sold everything right before the 1929 crash, he put it perfectly. You only have so much time and so much brainpower. You can become a true deep expert on a few things, but it is literally impossible to be an expert on 100 different things.
Okay, so we've talked about the philosophy, we've heard the analogies, but what about the cold, hard math? Let's take a look at exactly how diversification can seriously dilute your returns and basically suffocate your best ideas.
So let's set up a really simple comparison. On one side, we have Portfolio A. It's super diversified, 100 different stocks, and each one makes up just 1% of the total pot. On the other side, we have Portfolio B. It's highly concentrated, only 5 stocks, with each one representing a full 20% of the capital.
Now let's say you do your homework, you find an absolutely amazing company, you buy the stock, and it doubles in price. A home run! A huge 100% win. So what happens in Portfolio A? Well, your total net worth goes up by just 1%. All that work, all that incredible insight, and it barely moved the needle. But in the concentrated portfolio, that exact same winning idea launches your entire net worth up by 20%. Now that is a life-changing return. I mean, think about it. To get that same result, the diversified investor would need to find 20 different stocks that all double. So I gotta ask you, what do you think is more likely? Finding 20 great ideas or finding just one?
And this really gets us to the core psychology of it all. See, concentration isn't just a strategy you pick. It's the natural result of a completely different way of thinking about risk and knowledge.
This table from the source material just lays out this psychological divide perfectly. It says the master investor does not believe in diversification because when they find something that checks all their boxes, they buy as much as they can. But the losing investor lacks the confidence to take a huge position. It's not about the spreadsheet. It's about pure, unshakable conviction. So here's the crucial takeaway. Diversification is a strategy that's ultimately rooted in fear, the fear of being wrong. But master investors, they don't fear risk, they work obsessively to eliminate it. Their concentration isn't reckless gambling. It's the ultimate expression of confidence that's been earned through intense, passionate, deep research. They only bet big when they believe they've stacked the odds so overwhelmingly in their favor that it's barely a bet at all.
And that brings us to the final piece of the puzzle, how these incredible investors decide how much to bet. Because it's all about making sure that when you win big enough to actually matter.
You've probably heard this old Wall Street saying before, right? It's basically a warning against getting too greedy, suggesting that being a pig and taking too big of a position is a fatal mistake.
But our source text offers this absolutely brilliant amendment. It says it's not greed that's the problem. It's ignorant greed. The pig who hasn't done the homework gets slaughtered for sure. But the pig who knows exactly what they're doing, well, as Druckenmiller learned from Soros, sometimes it takes real courage to be a pig.
So how do they decide how big to go? They use a pretty simple rule, expectancy of gain. All this means is they weigh the potential profit against the probability of it actually happening. The higher their confidence and the bigger the potential upside, the bigger the position they take. It's that simple. They're not playing for small wins, they are swinging for the fences, looking for those home runs that can truly change their entire net worth. They buy enough to make a real meaningful difference. And that really brings us to the final question, the one I want to leave you with. When you look at your own investments, or your career, or even just how you spend your time, ask yourself this: are you diversified as a protection against ignorance, Or are you concentrated for success, focusing all your best efforts on the very few things that you know can truly make all the difference?
All right, let's talk about a habit that's, well, it's often overlooked, but it's absolutely what separates the good investors from the truly legendary ones. We're going to pull back the curtain on this hidden force, a relentless, almost obsessive focus on after-tax returns. You know, the money you actually get to keep. Because it's not just about making money, right? It's about keeping it. And that's a total game changer.
You've probably heard about the magic of compound interest. People call it the eighth wonder of the world for a reason. It's the engine that builds fortunes. But, you know, for every hero, there's a villain. And there's a powerful one working silently, tirelessly, to undermine this wonder. And in this explainer, we're going to unmask that villain.
So here's how we're going to break it down. First, we'll identify the enemy of compound interest. Then, we're going to look at a common trap with dividends. After that, we'll see the insane power of deferring taxes, learn how to win just by shaving a few costs, and then wrap it all up with the one metric that truly matters.
Okay, let's get right into it. The first thing you have to understand is the battleground itself. See, it's not just about what you pick to invest in, but how you think about your money. And there's this huge fundamental difference in mindset between two very, very different kinds of investors.
And this is really what it all boils down to. And it's surprisingly simple. The master investor obsesses over minimizing every little cost. Taxes, fees, you name it. They basically arrange their entire financial life to legally pay as little as possible. The losing investor? Well, they often just ignore these costs or figure they're just part of the game. But that's a silent killer for your long-term returns. It all comes down to focusing on what you actually keep, not just the headline number of what you make.
So how does this hidden enemy, taxes, really work in the real world? Let's look at a perfect example from one of the greatest to ever do it, Warren Buffett and his company Berkshire Hathaway. You know, since Buffett took over, Berkshire has paid a dividend in only 1 year. And he jokes about it, saying, "I must have been in the bathroom at the time." And there's a brilliant reason for this, and it has everything to do with avoiding something called the dividend double tax trap.
See, the big problem with dividends is they get taxed not once, but twice. And you have to get your head around this because it perfectly shows how your slice of a company's success just gets whittled down, step by step, before it even has a chance to hit your bank account. So let's follow the money.
So it all starts here, with a nice, clean $1 of profit that a company earns. This is the whole pie, before anyone even gets a whiff of it.
But before that dollar can go anywhere, boom, the first slice is taken. The company has to pay its corporate income tax. So right off the bat, that dollar shrinks to just 65 cents.
Okay, so that 65 cents is paid out to you as a dividend. But the tax man isn't done with you yet. Nope, now you have to pay personal income tax on that money. After federal taxes, you're down to maybe 55 cents. And if you happen to live in a high-tax state like New York or California, that original dollar has now shrunk to a measly 44 cents. I mean, think about that. More than half of your profit has just vanished into thin air.
And this is the whole point. This is Buffett's genius. He knows that if the company just keeps that money instead of paying it out, it can reinvest and compound the full 65 cents at a really high rate of return. But if you get the dividend, you're stuck trying to get that same growth with only 44 cents. He'd much rather let that bigger chunk of pre-tax money keep working and growing inside the great businesses he already owns.
Now, this idea of keeping your money working for you before it gets taxed, it leads us to an even more powerful concept, tax deferral. And honestly, there's no better way to explain this than with Buffett's famous Rip Van Winkle story. It's a really simple tale, but it reveals the absolutely staggering power of just being patient with taxes.
The bad guy in this story is the capital gains tax. That's the tax you pay on your profit when you finally sell an asset. And this is exactly why Buffett's favorite holding period is, and I quote, forever. By just not selling, he puts off paying that tax indefinitely. It lets every single penny of his capital keep working, keep compounding year after year after year.
So back in his 1989 letter to shareholders, he laid out two scenarios to show just how devastating it is to pay taxes every year versus just paying them once at the very end. Both scenarios start with $1. In the first one, you double your money. You sell, you pay your tax, and you do that every year for 20 years. In the second, you find one fantastic investment that doubles 20 times, and you go to sleep on it.
So what happens? Well, after 20 years of doubling your money, selling, and paying that 34% tax bill every single year, your $1 grows to a very respectable $25,250. Hey, not bad at all, right?
But what if you took that other approach? The patient investor, the one who took a 20-year nap and let the entire amount compound without being taxed, ends up with $692,000 after paying taxes just once at the very end. That's almost 27 times more money. I mean, just let that sink in for a second. 27 times more.
And this just brilliantly illustrates the magic. The only difference between these two massive outcomes is the timing of the tax payments. Every single dollar you pay in tax today is a dollar that can't grow, it can't double, and it can't compound for you tomorrow. It's a worker you just fired from your financial army.
Now, this whole principle of minimizing what you give away, it's not just about taxes. It's about all the little costs that can silently eat away at your returns. It's like a death by 1,000 cuts from transaction fees. We're talking brokerage commissions, bid-ask spreads, all those little charges that seem small but really add up. Let's see how this plays out for a trader.
Okay, so imagine we have a commodity trader. They've got a solid system that's kicking out a 34% annual return. And it's not about winning all the time. In fact, they only have a winning trade 1 out of every 7 times. But that one big win more than covers all the small losses. So the question is, how do you improve this? Most people would start trying to find more winning trades, but a master investor knows there's a much easier way.
See, a master investor knows it's way easier to control your costs than it is to predict the market. So by just negotiating a tiny 5% reduction in brokerage fees per trade, this trader's annual return jumps from 34% to nearly 36%. Now, that might not sound like a huge leap, but because those fees are paid on every single trade, that little shave compounds. And over 10 years, that tiny change adds over $20,000 to their net worth. That's almost triple their starting capital just from shaving a few costs.
So when you put this all together, it leads to one crucial idea. A master investor obsesses over the final number, the only one that really, truly matters, the return after all the taxes and all the costs have been paid.
The legendary George Soros took this to its absolute logical extreme. He set up his quantum fund in a tax haven, which let it compound its profits completely tax-free. Now, if his fund had been based in the US and paid taxes, his incredible 28.2% annual return would have been slashed to below 20%. So what was the result of that one decision over the long run? Well, it was the difference between turning his investment into $500 million and turning it into a staggering $7 billion. I mean, that is the mind-boggling power of focusing on after-tax returns.
But here's a funny little counterintuitive twist to end on. A really successful investor once said, "I like to pay lots of tax." And you might think, why on earth would anyone say that? Well, think about it. You only pay a lot of tax when you've made a lot of money. The goal isn't to never pay taxes. I mean, the easiest way to do that is to have no profit, and nobody wants that. So the ultimate measure of your success isn't your gross return, it's your after-tax, after-cost, what's left in my pocket return. The real goal is maximizing what you actually keep over the long haul. And that one simple but profound shift in focus from what you're doing on your next trade to what your final return is, that can make all the difference in building real, lasting wealth.
Let's kick things off with a pretty heavy truth from one of the greatest investors ever. This line from Warren Buffett, it just nails it. It's a stark reminder that in the world of investing, good intentions, well, they just aren't enough. Knowing what you're doing is your only real safety net. Hey, welcome to The Explainer. Today we are diving into what might be the single most important rule for finding success in investing. You should only invest in what you truly understand. Now, it sounds almost too simple, right? But as we're about to see, ignoring this one little rule can be a monumentally costly mistake. So, here's our game plan for today. We're going to start with a story I call the dinner party dilemma. Then we'll get to that aha moment when the penny drops. After that, we'll talk about finding your niche. And then we'll tackle the dangerous investing is easy myth. From there, we'll introduce a really powerful tool called your circle of competence. And finally, we'll break down the crucial difference between knowledge versus true understanding. So let's dive in. All right, so picture this. You're at a dinner party. You know the kind, right? The food's good, the conversation is flowing, and then, eventually, the talk turns to money, and someone drops a tempting hot tip. This, right here, is where so many investment journeys go off the rails. So at this party, there's a guy named Larry, and Larry is, for all intents and purposes, a one-man venture capital fund. This guy came to New York with basically nothing. And through just insane focus, he turned himself into a multimillionaire by specializing in one single thing, biotech.
He lives it, he breathes it. The guy literally reads scientific journals for fun. He doesn't start with the companies, he starts with the science. Larry has found his niche, and he just completely owns it. And then, sitting nearby, you've got Mary. Now, Mary is also super successful, a total pro in the real estate world. But as she's listening to Larry go on and on about these huge profits in biotech, you can just see the gears turning. She starts to think, maybe I should be looking into biotech. She's feeling that classic pull, that feeling that the grass is always greener somewhere else. But here's the wild part about Mary. A few years back, she made this incredible investment. She bought 2 condos that literally everyone was telling her to stay away from. The Buildings Association was a complete disaster, tangled up in lawsuits, bleeding money. So the prices were dirt cheap. But Mary, with all her years of experience, she saw something nobody else did. She knew these were just surface problems, things that would eventually get fixed. She knew the condos were an absolute steal. And guess what? She was totally right. Their value more than doubled. She was already a master investor in her own world. So, as Mary is telling this story and she's kind of brushing off her own amazing success while being totally captivated by Larry's, we get to the absolute turning point of the whole night. This is the moment of profound realization. Someone just asks her this simple question. Why are you even asking about biotech? You already know how to make money. Why not just do more of the thing you already know how to do? It's so incredibly simple, but it hits her like a ton of bricks. And just like that, boom, the penny had dropped. For a second, she was just speechless. You could literally see it on her face. This massive light bulb just switched on in her head. She realized she'd been looking for some secret to success everywhere except the one place it was guaranteed to be, right in her own backyard. She didn't need Larry's secret. She just needed to finally see her own. Okay, so Mary's story is the perfect example of this universal principle: specialization is everything. Every successful person, no matter the field, has a clearly defined niche. Let's dig into this a little more. I mean, just think about it. You don't even need to be a sports fan to know what these people are famous for. John McEnroe, tennis. Michael Jordan, basketball. You just know that if you put Babe Ruth on a tennis court, it would be a complete disaster. They're masters of their own domain, and all their success comes from that laser focus. And as you can see here, it's the exact same principle for the titans of the investing world. You've got Benjamin Graham, the father of value investing, Warren Buffett, who thinks like a long-term business owner, George Soros, who plays in global macro trends, and of course, Peter Lynch, famous for his whole invest in what you know philosophy. Each one has a niche they absolutely dominate. So here's the bottom line. Your niche isn't something you just randomly pick. It's defined by what you genuinely, deeply understand. You know, it's like how a whale's niche in the ocean is determined by the food it can actually eat. An investor's niche is determined by the kinds of investments they can actually wrap their head around. All right, so if finding a niche is so important, why do so many people have trouble with it? Well, the answer comes down to this really dangerous and widespread myth, the idea that investing is supposed to be easy. This is probably the biggest trap out there, this belief that there's some secret shortcut to getting rich. And this belief, oh man, it sends investors down some seriously distracting rabbit holes. They waste tons of time and money trying to predict what the market will do next. They get hypnotized by complicated charts, momentum indicators, weird cycle theories. I've even met people who swear by financial astrology. Seriously. All of these things are just different flavors of the same poison, the search for an easy out that lets you avoid doing the real work. And here's the psychological trick it plays on you. If you believe there should be an easy way, you'll automatically dismiss the real secret, which is understanding. Precisely because getting that understanding takes effort and hard work. It's this subtle way of sabotaging yourself, where you end up overlooking all the amazing expertise you've built up in your own life, just like Mary almost did. Okay, so how do we fight back against this myth? How do we actually put all this into practice? Well, the solution is a really powerful mental model made famous by Warren Buffett and Charlie Munger. It's called the Circle of Competence. This image just lays it out perfectly, doesn't it? On one side, you've got the master investor who sticks to what they know. On the other, you've got the losing investor who, just like Mary at that dinner party, is overlooking the gold mine sitting right in front of them. So let's define this thing. Your circle of competence is just the area of business and finance that you genuinely understand. It might come from your job, your hobbies, your passions, whatever. Just think about your own career for a second. What are the things you get paid to know? The subjects you know so well you could teach them to a total beginner? That's the beginning of your circle. And playing inside that circle gives you a huge advantage over everyone else. And this quote from Buffett is everything. He says the size of your circle doesn't matter one bit. You don't have to be an expert in everything. What really matters is that you know exactly where the edge of your circle is. You have to know what you know, but even more importantly, you have to know what you don't know. Being honest with yourself about your own limits, that's the whole key to the game. Now, to really define that circle, we have to get clear on the difference between knowledge and understanding. They sound similar, but they are not the same thing. And confusing the two, well, that's where a lot of really smart people get into a lot of trouble. Let's just look at the dictionary. Knowledge is about having a range of information, right? It's a collection of facts, it's passive, it's basically trivia. But understanding, that's a whole different animal. It's active. It's about getting the meaning, the significance of something, why it happens. It's about seeing how all the pieces connect. Okay, here's the perfect analogy to make this super clear. If we say, Marian has a good knowledge of Greek, it means she can list a bunch of facts about it. The grammar rules, the history, whatever. But if we say Peter understands Greek, we mean he can actually use it. He can read it, speak it, have an argument in it. He can apply it in the real world. One is just a pile of facts. The other is a usable skill. In investing, you want the skill, not the trivia. So here's the formula you can take away from all this. Real understanding equals knowledge plus your own personal experience. You can't just get it from a book or a video. It has to be earned by actually doing things. It means you've achieved mastery. Mary didn't just have knowledge about real estate. She had understanding that was forged in the fire of years of deals, mistakes, and big wins. That's what gave her an edge, and that's the only kind of edge that actually lasts. And that brings us to the final and most important question, the one this entire explainer has been leading up to. I want you to take a serious, honest look at your own life, your career, your hobbies, your passions. Forget all the hot tips and the market noise for a minute. Where have you put in the 10,000 hours? What do you truly understand? Not just know about, but understand better than almost anyone. What is the perimeter of your circle of competence? Because finding that and then having the discipline to stay inside it, that's the real secret to winning this game. All right, let's jump right in. Today, we are digging into one of the most powerful rules for making smart decisions, not just in investing, but in life. And the title says it all. If you don't know when to say yes, the answer should always, always be no. So here's how we're going to break this down. First, we'll start with a great story that really highlights a super common mistake. Then we'll define the big idea that can stop you from making it. After that, we're going to see what happens when the entire market goes crazy and forgets this rule, look at a really painful cautionary tale, and then we'll wrap it all up with a simple way for you to put this into practice. Okay, first up, a tale of two investments. This is a story about a guy named Andrew, and it is the perfect example of how you can be an absolute genius in one area of your life and a complete train wreck in another. Now, just take a second and really think about this question. It's a heck of a thought experiment, right? When Andrew was asked this, he said, well, he'd be much worse off. And that was kind of strange, because everybody knew he'd been getting hammered in the stock market for years. And this is where the light bulb really went on. See, when the question was changed just a little bit, what if you'd only put money into your own businesses and real estate, his answer completely flipped. He'd be way, way richer. All of his success, all of it, came from the things he knew inside and out. And all of his losses, they came from dabbling in things where he was basically just gambling. Now this slide, this is the whole story right here. Look at the difference. In real estate, Andrew had a system, a simple, crystal clear rule. If it didn't hit his number, he walked away. No questions asked, and what happened? Success. But in the stock market, he had nothing. No rules, no criteria, just vibes and a prayer. The result was a 4-year pileup of losses. It wasn't about real estate being better than stocks, it was about having a system versus having no system at all. So Andrew's story perfectly sets the stage for the main event here. This is the big idea, the mental model that truly separates the masters from the amateurs. It's called the circle of competence. This quote just nails it. Andrew's big mistake was thinking he could just take what made him good at real estate and apply it to the stock market. But it doesn't work that way.
A beautiful, powerful forehand in tennis will make you lose a point in squash. He was playing a totally different game with the wrong playbook, and he had no idea. And this image, well, it just lays it all out, doesn't it? On one side, you've got the master investor. They have a clear checklist, and more importantly, they can say no to 1,000 things without a second thought. It's easy for them. But on the other side, you've got the losing investor. They have no criteria, or they're just borrowing somebody else's, and they just can't say no, especially when everyone else is excited about something. So what exactly is this circle of competence? It's really just the areas where you have genuine, deep knowledge. But here's the secret, the thing Buffett figured out. Success doesn't come from having a massive circle. It comes from knowing, with brutal honesty, exactly where the edge of your circle is. The boundary is way more important than the size. Okay, so we've seen how this plays out for one person, but what happens when it's not just one guy, but millions of people, an entire market, all ignoring their circle of competence at the exact same time? Well, you get a full-blown mania, like the dot-com bubble in the late 90s. This timeline is like a psychological horror story. It shows you how even smart, skeptical people get sucked in. At first, they're like, this is nuts. These companies don't make any money. But then prices keep going up, and their friends and neighbors are getting rich. Doubt creeps in. The fear of missing out becomes unbearable. And finally, they give in. They capitulate, buy in right at the very top, and get absolutely annihilated. Now contrast that madness with the master. Decades before the dot-com bubble, back in 1969, Warren Buffett saw a similar frenzy taking hold. And what did he do? He did the unthinkable. He just shut down his fund. He said, I don't get this game and I'm not going to play. Imagine the discipline that takes. That is the circle of competence in action. But there's actually something even more dangerous than knowing you're outside your circle. It's what's called unconscious incompetence. It's when you think you're an expert, but in reality, you haven't got a clue. And that brings us to Stewart. Oh, Stewart. He was the poster child for this trap. He was so sure that this time was different, that the internet had changed everything. He was literally telling his friends that Warren Buffett was a has-been who just didn't get it anymore. So what did he do? He jumped in with both feet, putting a massive $400,000 into the hottest tech stocks. He wasn't just testing the waters, he was betting the farm on this new paradigm. In his mind, the old rules were for suckers. And for a while there, it looked like he was a certified genius. That 400 grand exploded. It quintupled. It turned into $2 million. Can you even imagine how that felt? Every dollar he made just reinforced the idea that he was brilliant and the old guard was clueless. This is the most dangerous part of any bubble. But then, of course, the bubble burst. And as his stocks were crashing, he made another terrible mistake. He got a margin call from his broker, basically a demand for more cash. And instead of cutting his losses, he threw more good money after bad. In the end, after all the smoke cleared, he had managed to turn about $600,000 of his own cash into just $200,000. Just a total disaster. So after hearing those stories, the obvious question is, how do we avoid being an Andrew or a Stewart? Well, it all comes down to being honest with yourself and defining your own circle of competence. Let's walk through a super simple way to do that. The best investors in the world, guys like Buffett and George Soros, built their entire fortunes by answering these 3 simple questions. First, what are you actually interested in? Second, what do you really know right now? Be honest. And third, what are you willing to put in the real work to learn about? And the payoff for doing this is huge. Once you're clear on your boundaries, you know your limits. It suddenly becomes easy, effortless even, to walk away from those shiny opportunities that are outside your circle. You stop the bleeding and you can finally focus on the areas where you have a genuine advantage. I absolutely love this analogy. Your investment approach has to fit you. It has to match your personality, your knowledge, your temperament. Trying to copy some super successful guru's strategy is like wearing an expensive suit that's 3 sizes too big. You're just gonna look foolish. So as we wrap things up, I want to leave you with this question. Just think about it. What is one area where you are a true expert? And maybe more importantly, what's one area where you know you're a total beginner? Because knowing the difference between those two, well, that's everything. All right, today we're going to talk about a core idea, a super simple phrase actually that comes from some of the best investors on the planet, and it tells you pretty much everything you need to know about how real wealth is built. It all starts with the letter A. This quote, it just nails it, doesn't it? When it comes to investing, winning isn't about some secret handshake or hidden information. Nope. It's about looking at the exact same stuff everyone else is looking at, the same reports, the same numbers, but having the guts and the framework to think about it in a way that nobody else has. I mean, this is the billion-dollar question, right? We all see the headlines when folks like Buffett or Soros make these huge winning bets. But what's really going on behind the scenes? What's the actual process? Is it some crazy complex computer program, just a gut feeling, or is it something else? Well, the simple answer is this. They do it on their own. That's it. That's the big secret. The heart of their strategy has nothing to do with who they know or what fancy software they're using. It's all about one thing: a crazy, relentless commitment to doing their own research. They just refuse to let anyone else do their thinking for them. And that brings us to the title of this whole explainer. There's this great story where someone asked Warren Buffett how on earth he could analyze, 27,000 public companies. And his answer was dead serious. He just said, start with the A's. And that one little phrase, it sums up his entire philosophy. The work is hard, it's personal, and you can't skip steps. You start at the beginning and you do the work. All right, so here's how we're going to break this down. First, we'll look at the two different roads every investor has to choose from. Then, we're going to dive deep into how Buffett and Soros do their thing. After that, we'll talk about something most people forget, the work that happens after you've already bought the stock. And then, we'll wrap it all up with how you can start using this thinking yourself. So, let's talk about these two paths. Because when you strip it all away, investing really just boils down to one choice: how you decide to do your research. And listen, this isn't about having a 200 IQ. It's all about the habits you form. And believe me, this one choice is what separates the winners from the losers over the long haul. Okay, so this table lays it out perfectly. It really shows the two completely different mindsets. On one side, you've got the master investor. They're proactive, they have a system. And on the other side, you've got the losing investor. Their strategy is basically just reacting and hoping for the best. Let's dig into what that actually looks like. So, here's the real difference, right? The master investor, they're like a detective. They're actively building a case, finding clues, and putting the pieces together one by one. They're building their own conviction. But the losing investor, they're just a passenger along for the ride. They're waiting for someone, a broker, some guy on TV, a headline, to give them a hot tip. They're basically handing over the keys to their own financial future. It's the difference between making your own luck and just hoping you get lucky. Okay, let's make this real. Our first case study, the man himself, Warren Buffett. And his method is all about one thing: doing the boring, unglamorous, roll-up-your-sleeves kind of work that nobody else wants to touch. So, you know that Buffett loves reading annual reports. That's his jam. But what do you do when the one piece of information you absolutely need just isn't in the report? Do you just throw your hands up and say, oh well? Or do you get a little creative? Get this, back in 1965, Warren Buffett spent a month counting tank cars in a railroad yard in Kansas City. And no, that's not a typo. One of the greatest investors ever is out there doing manual labor. Why? Well, he wasn't interested in the railroad. He was trying to figure out what was going on with Studebaker and its super popular gas additive, STP. See, the company was being cagey about its sales numbers, so Buffett decided to find out for himself. And this is just a perfect example of his whole process. It's not some kind of magic trick. It's just good old-fashioned, logical detective work. He figured out, okay, the main ingredient for STP comes from Union Carbide. He knew how much of that ingredient went into one can of STP. So all he had to do was count the tank cars coming from Union Carbide to get a pretty good idea of their sales. Think about that. While everyone else on Wall Street was reading the same boring analyst reports, Buffett was out in the real world, getting his own data. Now, you're probably not going to go hang out in a rail yard, but the idea is exactly the same. Find a clever way to get information that no one else has. That's how you build real, unshakable conviction. And this quote from him just says it all, doesn't it? You have to think for yourself. He's basically saying he trusts his own homework more than he trusts the smartest guys in the room. Real breakthroughs don't come from groupthink. They come from thinking for yourself. All right, so that's Buffett. Now let's pivot and look at George Soros. He used the exact same core principle, do your own research, but his approach was totally different. If Buffett's all about digging deeper, Soros was about seeing the world from a completely different angle. So, picture this. It's 1959, and George Soros shows up on Wall Street. He quickly realized he had this incredible, unique edge. See, back in London, knowing about European stocks was no big deal. But in America, almost nobody knew anything. He saw this massive gap, an opportunity. He understood a market that Wall Street was curious about, but fundamentally clueless.
And look at the skills he brought to the table. It wasn't just one thing. He spoke German, French, English, and Hungarian. That meant he could read foreign tax returns and find hidden assets that were invisible to everyone else. And then, he did something that was almost unheard of for an American analyst back then. He actually got on a plane, flew to Europe, and sat down with the people running these companies. This wasn't just being an expert, this was original, boots-on-the-ground research.
And here's where it paid off big time. He uncovered the situation with a bunch of German insurance companies. Their ownership structures were this crazy, tangled web. But what he figured out was that the stocks they owned were actually worth more than the entire companies themselves. It was an incredible find. He took this idea to JP Morgan, and get this, they started buying the stock before he even finished writing his report. Now, that's the power of having a truly unique, well-researched idea.
Okay, so finding the investment is one thing. But what happens next? This is a part of the process that so many people just completely ignore. The work doesn't stop when you click the buy button. In fact, a lot of times, that's where the real work and the real money begins.
So let me tell you a story about an investor named Harold. He found what he thought was the perfect buy-it-and-forget-it stock. It was this boring little company, Paperforms Inc., but it had this incredible hidden asset. It seemed like a total slam dunk. I mean, what could possibly go wrong, right?
So Harold's whole idea was pretty simple. The company had these old leases on its factories with options to buy the land at crazy cheap prices from the 1950s. That was the entire reason to own the stock. But then, disaster strikes. The founder dies, and this super conservative bank takes over. And the bank looks at these valuable options and just sees risk. They decide they're not going to exercise them. And just like that, Harold's entire investment was about to go to zero. If he'd just bought it and forgotten about it, he would have been totally wiped out.
But Harold didn't just panic and sell. No way. He took action. He managed to get a meeting with the president of the bank, and he basically put it all on the line. He asked him one simple, direct, and very powerful question, letting the guy know he wasn't backing down. In that moment, he went from being a passive investor to an active owner of the business.
And what happened? The bank completely folded. They changed their minds. Pretty soon, a takeover offer came in, and Harold, who'd bought his shares for maybe $2 or $3, got cashed out at $21 a share. Think about that. Almost all of that profit wasn't made the day he bought the stock. It was made because he kept watching and because he was willing to step up and fight for it.
So when you look at all these stories, what's the one thing they all have in common? You've got Buffett in a rail yard, Soros digging through German documents, Harold staring down a bank president. The common thread is crystal clear. The work that really matters, the work that creates life-changing value, is the work you do yourself. Look, you don't have to be Warren Buffett. You don't have to be a billionaire. But this principle is universal. If you just rely on hot tips and what other people are saying, you're signing up for mediocre results. The real edge, the real conviction, comes from rolling up your own sleeves. So I'll leave you with this question. You don't need to analyze 27,000 companies, but what's the first A on your list? What's that one thing you're willing to really dig into for yourself?
Welcome to The Explainer. Today we're diving into something that sounds, well, a little weird, right? It's a paradox, but it just might be one of the most powerful habits in all of investing, the art of doing absolutely nothing. Let's kick things off with a feeling I bet it's super familiar to a lot of you. It's that constant, nagging pressure to do something, to buy, to sell, to rebalance, just to be busy. It's this idea that if you're not making moves, you're somehow falling behind. But is that actually true?
Well, what if the real secret to success, according to one of the greatest investors to ever live, isn't about all that frantic activity? What if it's about mastering strategic inaction? I mean, this one idea, it's a total cornerstone of how the legends play the game.
Okay, so here's how we're going to tackle this. First, we'll look at that pressure to act. Then, we'll pull back the curtain on the secret weapon of the world's best investors. After that, we'll dig into the big trap that Wall Street sets for itself, rethink what doing nothing really means, and finally, show you how to make this your most powerful move. Sound good? Let's go.
Right, first up, let's really get into that fundamental problem that, honestly, almost every investor faces. It's this deep-seated, almost gut-level pressure to always be doing something. It's really the core challenge we've got to get over.
And this is where you see the big split, the huge divide. On one side, you've got the typical investor, just feeling this constant need to be active. But on the other side, you've got the master, the one who has the patience to wait, maybe even forever, for an investment that checks all their boxes. And believe me, this isn't just a small difference in style. It's a completely different mindset.
So this brings us to the secret weapon itself. Let's really look at how legends like Warren Buffett and George Soros operate. They don't just put up with waiting, no, they turn it into their greatest strength. They totally accept that sticking to their guns means there are going to be long, quiet periods of inactivity.
I mean, just listen to that quote. How amazing is that? Buffett isn't just, okay with waiting. He flat out calls it the cornerstone of his entire investment style. He has zero fear of just letting cash pile up while he waits for that perfect pitch to come right down the middle of the plate.
And believe me, he is not exaggerating one bit. He told his shareholders, point blank, that they'd wait indefinitely. He literally said, "We're not going to buy anything just to buy it." But here's the kicker. When they do see that one-in-a-million opportunity, they are ready to act incredibly fast and go incredibly big.
And this, right here, gets to the absolute heart of it. It's all about the quality of your decisions, not the quantity of your trades. It's such a simple idea, but it's what separates the everyday professional from the true master. You don't get paid for activity. You get paid for being right. Period.
And hey, it's not just Buffett. George Soros is right there with him. He sees these quiet periods as absolutely essential. For him, that downtime isn't frustrating at all. It's where the magic happens. It's the space he needs to think, to really build a solid thesis, and to figure out the why behind a market trend before he ever puts a dollar to work.
And here's a perfect story that shows his patience in action. For one of his most famous trades ever, the seed of the idea was planted way back in 1987. But a real, solid hypothesis, that didn't even take shape until 3 years later. And even then, he had to wait another 2 years for that perfect moment to pull the trigger. Think about that. That's a 5-year wait from the first glimmer of an idea to actually making the move.
So what was the reward for that incredible, almost inhuman discipline? A $2 billion profit. I mean, let's break that down. It's like he made $400 million for each one of those 5 years he was patiently waiting. It's pretty clear, right? For a master investor, waiting doesn't just pay off, it pays off big time. Okay, so this begs a massive question, doesn't it? If waiting is so ridiculously profitable, why isn't everyone doing it? Why does Wall Street look like a beehive that's been kicked over, just buzzing with constant activity?
Well, the answer really comes down to a fundamental conflict of interest that's baked right into the system. See, while the master investor gets paid for being right, your typical Wall Street pro, they get paid for activity, for showing up every day and just doing something.
There's a name for this. It's called the institutional imperative. Think about it. Analysts have to write reports, even when there's nothing to report on. Pundits on TV have to have an opinion, even if they have to make one up on the spot. And here's the big one. Fund managers are paid to manage a fund full of stocks and bonds, not a big pile of cash, even when sitting on cash is the absolute smartest move they could make.
Soros told this great story once about a Wall Street strategist. He said, "The trouble with you is that you go to work every day and think you have to do something. I don't." Soros explained that he only really goes to work on the days when it makes sense, what he called the special days. And on those days, he makes a move that really counts.
So this leads us to a really important shift in thinking. The phrase doing nothing, it sounds so passive, right? Kind of lazy even. But for a master investor, it's the exact opposite of lazy. It's about adopting a totally different mindset.
So instead of just passively waiting around, I want you to picture yourself as a gold prospector, a real old-timer. You know exactly what gold looks like. That's your investment criteria. You've got your pan and your pickaxe. Those are your tools for analysis. And you are on a constant active hunt. You never stop searching until you strike it rich.
See, this is what that waiting period is really all about. It's filled with the daily, disciplined work of searching. It's a non-stop hunt for those incredibly rare opportunities. All that time between big moves is spent digging, researching, preparing, with your capital parked safely on the side, ready to go the instant you shout, "Eureka!"
Jimmy Rogers, who used to be Soros's partner, put it just perfectly. He said the rule is simple. Doing nothing is your default setting. You do absolutely nothing until there's actually something worth doing. Until that true opportunity, the one that checks every single box, just lands in your lap.
Okay, so let's bring this all home. What's the big takeaway here? How can you actually use this in your own investing? It all boils down to one thing: making patience the absolute cornerstone of your entire strategy.
So how do you do it? How do you build these habits? Well, it starts with getting crystal clear on what you're looking for, your criteria. Then you have to not just accept, but actually embrace the fact that there will be long, quiet periods. That means you shift your energy away from pointless trading and toward the hunt, toward research and learning. You start to see cash not as a failure, but as a powerful, strategic weapon you're keeping dry. And the whole point of all this is to build the discipline to act only on your absolute best ideas. And that leaves us with one final, kind of provocative thought. We live in a world that is just screaming at us 24/7 to do something. But maybe, just maybe, the most strategic, the most powerful, and yeah, the most profitable move you can make right now is to have the courage and the patience to do nothing at all. And the real question is, what amazing things might you discover in that quiet?
You know that feeling? You're right on the edge of a huge decision, and then you just freeze. You hesitate. Well, today, we're talking all about the art of pulling the trigger, that critical moment of action that really separates the masters from everyone else. And we're going to start with a legend. For Warren Buffett, it's simple. When all the homework is done and the opportunity is staring you right in the face, the action that comes next isn't just fast, it's decisive. And it's big. But, this isn't just some investing secret. It's a fundamental truth of life, right? That window of opportunity, it's often gone in a flash, and it absolutely does not pause for our indecision. And hey, if you want it said a little more bluntly, Mae West really hits the nail on the head. Hesitation isn't just a missed opportunity, it's a critical mistake. So, how do we get from one side to the other? Well, here's our game plan. First, we're going to unpack that psychology of hesitation, that paralysis of what-ifs. Then, we'll dive into what makes up the master's mindset. After that, we've got some incredible stories of instant action. And finally, we'll talk about how you can apply all these lessons to go from hesitating to acting with real conviction. All right, so why do we get so stuck? Doesn't matter if it's our careers, our personal lives, or our money. Let's really get inside the head of the person who hesitates, the person who is just tormented by that one simple question, what if? What's so powerful about this is just how brutally simple it is. It boils everything we're talking about down to one single habit. The master investor acts the second a decision is made. The losing investor procrastinates. That right there is the fork in the road we're exploring today. I mean, think about it. When you decide you want to go out for dinner, what do? You just pick up the phone and make the reservation. It's totally mechanical. You don't agonize over it, you just do it. But when it's a high-stakes decision, an investment, a career change, anything big, that same simple act of just doing the thing gets completely bogged down with anxiety and a hurricane of self-doubt. So what's the difference? It's because of this. This is the game that the procrastinator's mind plays. It's just an endless, vicious cycle of what-ifs. What if a better opportunity is right around the corner? What if I'm totally wrong? What if the whole thing goes south the second I commit? These questions, they create this thick fog of uncertainty that makes taking action feel almost impossible. And really, all of those what-ifs just boil down to this one, single, paralyzing question. For anybody who doesn't have a clear system, there's just no way to answer this with any certainty. So you stay stuck, caught between wanting to act and being terrified of getting it wrong. There's no finality. And here's what that actually looks like in the real world. This doubt, it leads to these timid, half-hearted moves. An investor does all the work, convinces themselves to buy 10,000 shares. They feel right about it, right up until the moment they have to actually put money on the line. And then that doubt just creeps in. They tell themselves, okay, I'll just dip a toe in. I'll buy 2,000 shares and just see what happens. And you know what happens next. They never buy the rest. The opportunity is lost, not with some big dramatic failure, but with a quiet whimper of indecision. So how do the masters avoid this trap? Well, it's not about being reckless. It's not about being blindly confident. No, it's about something way more powerful: relentless preparation. The secret weapon is having a clear, predefined set of criteria. For an investor, that's their investment criteria. For a big life decision, it might be your core values and goals. Think of them like filters. When a new opportunity pops up, you don't have to start your thinking from square one. You just run it through your filters. Does it fit? Yes or no? It's black and white. And that right there is what gets rid of the gray area where all the doubt and hesitation lives. So by the time a master is actually ready to pull the trigger, they've already gone through this checklist. They 100% understand the commitment. They've confirmed it meets every single one of their criteria. They know exactly what they're doing, how much, and why. The money, the resources, they're all ready to go. And maybe most importantly, they have a deep, earned trust in their own system. There is literally nothing left to think about. So for them, pulling that trigger is no different than you calling for that dinner reservation we talked about. It's just a routine, mechanical step to finalize a decision that was made ages ago. While the procrastinator is still sweating, staring at the buy button, the master's mind, it's already moved on to the next big idea. Now, this isn't just theory. Let's see this exact mindset in action with some pretty incredible real-world stories. We're going to look at two legends who have built absolute fortunes on this very principle of instant, decisive action. Okay, picture this. It's 1974. George Soros is in the middle of a tennis match. The phone rings. It's his broker calling from Tokyo, telling him the Watergate scandal is starting to spook the Japanese markets, where Soros has millions and millions of dollars invested. Now, he didn't ask for a detailed report. He didn't say, let me think about it and call you back. With everything on the line, his response was immediate and it was absolute. Get me out. That decision took a fraction of a second. That is what conviction born from preparation sounds like. All right, now for another legend. Warren Buffett is out doing some Christmas shopping at a jewelry store called Borsheim's. And as he's looking at a ring, one of the owners jokingly shouts out, "Don't sell Warren the ring, sell him the store." Well, that joke sparked an idea. After the holidays were over, Buffett made one phone call. The entire core discussion, where he asked just 5 key questions, lasted 10 minutes. A little while later, a handshake sealed the deal to buy the second largest jewelry retailer in America. 10 minutes. That is the speed of clarity. And this speed, it's not a one-off thing. Buffett is dead serious when he promises to respond to investment offers, as he once wrote to his shareholders, customarily within 5 minutes. And he can do that because his filters are so clear, so well-defined, that he knows almost instantly whether something is even worth his time. So what's the big lesson here? What do we take away from all this? How do we actually bridge that gap between being the person who freezes up and the person who acts with total conviction? Okay, so the crucial point is this. The instant action of a Soros or a Buffett is not reckless. It is not a guess. It is the final, logical, almost boring step in a long process of intense preparation. The speed comes from the clarity they already had, long before the phone ever rang. Remember this. Decisiveness isn't some personality trait you're born with. It's a skill you earn through homework and discipline. And that brings us right to the final question, a question for you. And it doesn't have to be about investing millions of dollars. It can be about anything in your work, in your life. What is that one thing you know deep down you should do, but you're still waiting? What preparation would it take to give you the clarity you need to finally pull the trigger? Let's talk about the one question that probably causes more anxiety for investors than any other. It's not about what to buy. That's the fun part. It's about when to sell. Gosh, that decision is just loaded with emotion, second-guessing, and way too often, a whole lot of regret. So let's just put it out there. When is the right time? Seriously, is it when your money doubles, when a stock is hitting all-time highs, or maybe it's when you just get that pit in your stomach? You know, if you don't have a solid answer for that, you are definitely not alone. But not having one is probably the biggest thing that separates winning from losing in the market. And this image right here, it just gets to the heart of it all, doesn't it? You've got the master investor on one side, just calm, collected, working from a plan. And on the other side, you've got the losing investor riding this wild roller coaster of fear and hope. The master investor stays in a winning position until a pre-planned reason to sell comes up. But the losing investor, they're terrified that a small profit is going to vanish, so they sell out way too soon. And they're the ones who are constantly missing out on those monster, life-changing gains. So in this explainer, we're going to show you exactly how to build that plan. We'll kick things off with the psychological trap of the selling dilemma. Then we'll get into the master investor secret, see it in action with giants like Buffett and Soros. We'll lay out 6 solid exit strategies you can actually use. And finally, really drive home why a system will beat pure emotion every single time.
So why is selling just so much harder than buying? Well, it's because for most of us, it is an emotional battlefield. When a stock is up, you feel that greed, right? That FOMO, the fear of missing out on even more gains. And when it's down, you feel fear, but also this stubborn hope that it's got to come back. It leads to total paralysis. This is the world the losing investor lives in.
Now, this slide just maps out that cycle of self-sabotage perfectly. It starts right here. An investor makes a little profit but gets scared it's going to disappear. So they sell early, lock in a tiny win, but miss the massive run that happens later. Then, with another stock, they have a loss. And you see the next point? They just hang on, telling themselves, oh, it's just a paper loss. It'll bounce back. Well, as that loss gets bigger, hope turns to pure panic. And they finally sell out of fear, usually right near the bottom. And the result is this last brutal point. A portfolio of tiny profits that get completely wiped out by a few huge, devastating losses.
So how do the masters avoid this trap? Well, the secret, it's not some magic formula, it's not a crystal ball, it's actually shockingly simple, but it is incredibly powerful. They know exactly how they're getting out before they even get in.
This quote from the legendary trader Bruce Kovner just says it all. I know where I'm getting out before I get in. The decision to sell is not made in the heat of battle. It's not based on some scary news headline or a gut feeling. The exit is a built-in part of the original investment plan. The conditions for selling are set from day one. And T. Rowe Price gives us the key to actually building that plan. Your reason for selling should be a perfect mirror image of your reason for buying. So if you bought a stock because of its great management, its innovative products, and its huge competitive advantage, you sell it the moment any of those things just aren't true anymore. It becomes a logical, system-based decision, not an emotional reaction.
Okay, this all sounds great in theory, but let's see how it actually works in the real world. We're going to look at 2 of the greatest to ever do it, Warren Buffett and George Soros. They have totally different styles, but they are both united by this exact same core principle.
All right, first up, Warren Buffett. You know, his favorite holding period is famously forever, but that does not mean he never sells. And a perfect case study is when Berkshire Hathaway sold off most of its Disney shares way back in 2000. I mean, why on earth would he sell a beloved American icon like Disney?
It's because the company simply didn't meet his strict buying criteria anymore. The fundamental business itself had changed. You know, management at the time seemed to have lost its focus. The company's moat, that competitive advantage that was once thought to be unbeatable, was starting to show some serious cracks. And crucially, they were just wasting money on trendy .com ventures, like a search engine called Goto.com. It just wasn't the same magical kingdom that he had originally bought into.
And here it is, straight from Buffett himself at a 2002 shareholder meeting. He didn't say, oh, we thought the market was too high or we were worried about a recession. Nope. He said the competitive characteristics of the company changed. His reason for selling was a direct result of his original reason for buying. That is pure system, zero emotion.
Now let's totally switch gears and look at George Soros. Soros is a very different kind of operator. He's not looking for companies to hold forever. He makes these huge, bold bets based on a specific idea, a hypothesis, about where he thinks the market is wrong. But his discipline on selling is every bit as rigid as Buffett's. Soros basically has 3 crystal clear exit triggers. 1, he sells when his thesis plays out successfully. He did this when he famously broke the Bank of England by shorting the British pound. Once the pound was devalued, the game was over. His thesis was complete and he took his profits. 2, he takes a loss the second the market proves his idea is wrong. No waiting around, no hoping. And 3, if his capital is ever seriously threatened, he gets out immediately, just like he did when he dumped everything during the 1987 crash. So we've seen the principle in action with the legends. Now let's get practical and start building our own toolkit. The source material breaks down 6 core exit strategies that master investors use. And these are really the building blocks for your own emotion-proof system. So these are the 6 big ones. We're going to walk through what each of them means so you can see how they all fit together. It all starts with your original criteria break-in, then it moves to specific events, system-generated targets and signals, purely mechanical rules, and, yeah, finally, just admitting when you made a mistake. Let's break them down.
Okay, strategy 1 is the Buffett rule we just talked about. Before you even click buy, you literally write down exactly why you're buying. Is it the genius CEO? Is it a patent that locks out all the competition? Is it that incredible brand loyalty? Then you regularly check back on those reasons. And the moment one of them isn't true anymore, a new CEO tanks the company, the patent expires, you sell. It's that simple and that disciplined.
The second strategy is all about events. This is the Soros model. Let's say you buy a small biotech company because you think their new drug is going to get FDA approval in 6 months. Well, your sell trigger is that event. If the drug gets approved, your thesis was right, and you sell to lock in your profits. If the drug gets denied, your thesis was wrong, and you sell to cut your losses. The outcome of that one single event dictates your action.
Now, strategies 3 and 4 are all about letting your system make the call for you. For some folks, like the legendary investor Benjamin Graham, this means you calculate what a company is really worth, and you set a very specific price target. Once the stock hits that number, the system says, sell. You sell. It doesn't matter how hot the stock is. For other people, the system might flash a sell signal based on technical indicators, price movements, and trends. Either way, the decision is made by the system you built beforehand, not by your gut in the moment.
And this brings us to strategy 5, purely mechanical rules. And this little anecdote is just fantastic. A friend's grandfather made it through the great crash of 1929 with all his money intact by using one simple rule: sell any stock that moved 10%. Didn't matter if it was up or down. That was it. This is the whole idea behind a stop loss. It's not about being a genius. It's about mechanically managing your risk and just saying, this is the most I'm willing to lose on this idea. Full stop. It's like an automatic circuit breaker for your money.
So, as we start to pull all this together, the main point is this. All of these strategies, they're designed to do one thing: to help you defeat the enemy inside. Because the biggest obstacle to your success as an investor isn't the market. It's your own emotional reaction to the market.
And this slide just lays out the two mindsets perfectly. You've got the emotional investor who's stuck in this loop of anxiety, hope, fear, and just putting things off. They're always reacting. But the systematic investor, they operate with clarity, discipline, logic, and decisive action. They have a plan, and they just calmly follow it.
And really, that's the whole game right there. When you build this system, you're not just making up some rules. You are externalizing the decision. You're taking that tangled, emotional mess that's in your head and turning it into a clear, simple checklist. Your focus shifts away from the gut-wrenching ups and downs and moves to just executing the plan that the calm, rational you already made. So, I'll leave you with this question to really think about. Look at every single thing in your portfolio right now. For each one, do you have a clear, pre-planned reason to sell? Or are you like the losing investor, just kind of hoping for the best? Because having a plan, that's the difference between investing and just gambling. You ever do this? You create the perfect plan, a system you just know is going to work, and then at the very last second, you just abandon it. For an investor, that one little moment of doubt can be the single most expensive mistake you ever make. So why on earth do we break our own rules? And, maybe more importantly, how do we stop? Well, it turns out you're not alone. I mean, even legendary traders like Ed Sykota admit they struggle with this. That feeling that you can suddenly, magically outsmart the very system you spent all that time building, well, it's a powerful and, as he points out, a very expensive illusion. And that's really the core conflict we're going to dig into today. So here's our game plan. First, we'll look at the real-world cost of all this second-guessing with a quick case study. Then, we're going to diagnose the root cause, something called the personality mismatch problem. From there, we'll unpack 3 investor types so you can figure out where you fit, how to build a system that works for you, and finally, uncover the master investor secret. Okay, let's dive right in. I want to tell you about a stock trader we'll call Joel. Now, Joel had a winning system, but he also had a very, very expensive habit of, well, not following it. Now, let's be clear, Joel's system wasn't the problem here. In fact, it was totally proven. For more than 5 years, his computer-generated signals had a solid track record. On paper, this thing was a money-making machine. So that brings us to the big question, right? If the system was so good, if it had a 5-year winning streak, why was Joel struggling? Why was he consistently losing money when he had a winning formula sitting right in front of him? Well, the answer boils down to one simple word: discipline. Or, in Joel's case, a complete lack of it. He admitted that he was constantly overwriting his system's sell signals. And when he finally sat down and analyzed his trades, he realized this one little habit cost him, in his own words, a hell of a lot of money. And this is where it gets really fascinating. When his system flashed a buy signal, he'd go and double-check the company's fundamentals, to make himself feel confident. But when that same system flashed a sell signal, he'd look at the fundamentals again, say, well, nothing's changed, and just ignore the signal. He was mixing two totally different strategies, and this internal war was just sabotaging his results. Joel's story, it isn't unique. It's actually a perfect example of a much deeper problem that affects tons of investors. This is what we call the personality mismatch problem. So what is a personality system mismatch? It's when your natural way of thinking, your gut instincts, your whole temperament is basically in a cage match with the investment strategy you're trying to use. It creates this constant friction, and it makes being disciplined feel like an impossible uphill battle. Let me make this super concrete for you. Imagine someone who's just naturally impatient. They want action, they want results now. So what happens if they try to use a long-term value strategy like Warren Buffett that might mean waiting years for a stock to pay off? They're going to be absolutely miserable. They'll be tempted to sell early all the time, completely destroying the entire strategy. Or let's take the opposite. You've got the quiet thinker, the person who loves to analyze and study every single possibility. Now you throw them into the fast and furious world of foreign exchange trading, which demands split-second decisions based on gut feel. It's a recipe for total paralysis and ultimately failure. And one last one to really drive it home. Think about an investor who likes things they can see and understand. Real estate, a manufacturing plant. Now, what if their system tells them to invest in some abstract biotech startup that's still just an idea on a piece of paper? They're never going to feel confident in that position, and that lack of conviction is just going to lead to them second-guessing every single move. So, okay, if a mismatch is the problem, the solution has to be finding the right match. And to do that, we need a way to understand our own investing personality. So let's explore 3 basic archetypes. So, which one of these sounds like you? Broadly speaking, we can break them down into 3 types. Are you the analyst, like a Warren Buffett who has to think through every little detail? Or are you the trader, maybe like George Soros, who acts decisively on gut feel and experience? Or maybe you're the actuary, like Nassim Taleb, who is just obsessed with the numbers, the probabilities, and the long-term statistical edge. And this explains Joel's problem perfectly. His natural instinct was to be an analyst. He wanted to dig in and understand the fundamentals. But he was using a system built for a pure trader, one that relies only on technical signals with no fundamental reason why. His personality was literally at war with his system. So, this diagnosis leads us right to the solution. How do we get from that state of internal conflict to a state of perfect harmony, where following our system actually feels natural? The legendary trader William Eckhart had such a brilliant insight on this. He said, if you're constantly overriding your system, it's not a failure of your willpower. It's a failure in the system's design. It's a massive, flashing red light telling you that your system is missing something that your personality desperately needs. And this really highlights the fundamental difference, right? The losing investor is always in a state of reaction, always second-guessing, changing the rules, making excuses. But the master investor, they operate from a place of deep conviction. They follow their system religiously because they know that discipline is the absolute foundation of any long-term success. This brings us to the ultimate goal. What truly separates the good investors from the great ones isn't just a better system. It's a completely different relationship with their system. Let's talk about the secret to what we could call effortless discipline. Just look at this comparison. Joel literally has to force himself to follow his system. He's in a constant battle against the temptation to break his own rules. The master investor, on the other hand, they follow their system effortlessly, 100% of the time. For them, there's no temptation to fight because the thought of second-guessing doesn't even enter their mind. So what's the secret? How do they reach that state of effortlessness? It's because the system isn't just some tool they use, it's an extension of who they are. For a master investor, their system fits them like a tailor-made glove. It's a perfect, seamless match for their personality, their philosophy, their entire way of seeing the world. But here's the catch. You don't just find this perfect fit, you have to build it. Master investors construct their own methods from the ground up.
It starts with their core investment philosophy, their deepest beliefs about how markets really work. And only then do they translate that philosophy into a detailed, mechanical set of rules for buying and selling. The system becomes a true expression of their worldview. And so we'll end with a big question for you to really think about. Take a hard look at your own approach. Is your investment system truly designed to work with your natural tendencies? Or are you, like Joel, stuck in a constant battle, trying to force your personality to fight against the very rules that you've set for yourself? The answer to that question could be the key to unlocking your own version of effortless discipline. So let's just jump right in. What if I told you that the secret to winning, I mean really winning, in investing, in your career, and pretty much anything, isn't about making these brilliant, genius-level moves? What if instead it's about doing the one thing that we all kind of hate doing, admitting we were wrong? I know it sounds totally backwards, but as we're about to see, it might just be the most powerful strategy out there. I mean, listen to this from George Soros, a legendary investor. This is a wild thing for a billionaire to say, right? He's not saying his secret is some complex algorithm or that he can see the future. Nope. He's saying his actual superpower is being really, really good at recognizing when he's messed up. That one idea is the foundation of everything for him. Pretty powerful stuff. And look, he's not the only one. You've got Warren Buffett, another icon, saying basically the same thing, just in a slightly different way. For Buffett, the game isn't about hitting home runs all the time. The real game is playing defense. It's about avoiding those huge, catastrophic errors that can completely wipe you out. Just focus on not making the big blunders. And then you have Buffett's right-hand man, the brilliant Charlie Munger, who just boils it all down to the essentials. He's basically saying it's a simple two-step process. First, see the mistake. Second, and this is the crucial part, do something about it. Right away. No hesitation. This isn't about feeling bad for yourself. It's about swift, decisive action. And that's exactly what we're going to unpack here. So, here's a quick look at where we're headed. We're going to start with this weird paradox of success. Then we'll get into the jaw-dropping cost of ignoring it. After that, we'll explore this incredible strategy of winning by not losing, see how the absolute masters of the game use it, and finally, we'll talk about how you can turn your own mistakes into your greatest strength. All right, let's get into our first section, the success paradox. And it really is this kind of backwards idea that the people at the very top of their game aren't always obsessed with winning. Instead, they're obsessed with avoiding screw-ups and, more importantly, fixing the ones they inevitably make, like the second they spot them. It's all about playing defense, not just offense. Which, leads us to a really important question. What happens when you do the opposite? What's the danger when your only focus is on chasing profits, on trying to hit that next big win, and you completely ignore the mistakes you're making along the way? Well, the answer can be, frankly, devastating. Okay, let's do a little thought experiment here, and I want you to be really honest with yourself. Think about all the investments you've ever made, stocks, a business venture, whatever. Now imagine if, instead of doing any of that, you had just parked all that cash in a boring old savings account. Would you have more money right now? For a lot of people, the answer to that is a really painful yes. For one guy mentioned in our source material, let's call him Jeff, the answer was just staggering. When he actually did the math, he realized that his relentless chase for big wins while ignoring his mistakes had cost him $5 million. Think about that. He would have been $5 million richer if he had just done nothing. And just so you don't think Joff was a one-off case, another client, Jack, ran the same numbers and came to an even more gut-wrenching conclusion. For him, the total cost was $7 million. Now, what's fascinating is that both of these guys had the exact same problem. They were so focused on the potential profits that they were completely blind to the mistakes that were killing their returns. And this slide just lays it out perfectly. You've got two completely different mindsets. Over here, the master investor. They start from a place of humility. They know they can be wrong. They're fallible. So the moment they spot an error, they fix it. But over here, you have the mindset that cost Jeff and Jack millions. The losing investor. They hang on to bad decisions, praying they'll just break even. Their entire strategy is built on hope, and hope is a terrible strategy. So, if that's the problem, what's the solution? Well, to really get our heads around this, we're actually going to step outside of finance for a minute and look at this incredible story from the world of elite sports. We're going to call it the Jonah Barrington method. First, you gotta understand the game of squash. It is just brutal.
It's played in this little glass box, and it is physically punishing. You're sprinting and stopping constantly. A big match can last for hours, longer than a tennis final. The physical toll is so insane that, yes, players have literally had heart attacks on the court. It is a pure war of attrition. Now, Jonah Barrington was a squash champion back in the day, and his strategy sounds almost too simple. He wasn't trying to hit these spectacular, fancy, match-winning shots. His entire focus was on one thing: make no mistakes. That's it. Just get the ball back. Keep it in play. Every single time. And the result of this relentless, boring consistency was amazing. Barrington, who was in superhuman shape, would just grind his opponents into dust. After hours of these non-stop rallies, his opponent would eventually get tired. They'd hit the ball into the tin or hit it out of bounds. They would be the one to finally crack, to make the mistake, and they would lose. And this right here is the punchline. This is the key to the whole thing. Barrington's strategy was designed so that he would never beat himself. He put all the pressure on his opponent. He forced them to be perfect, and eventually, nobody can be perfect forever. He won by creating an environment where his opponents couldn't help but lose. So how in the world does a squash game from the 1960s relate to investing? Well, the greatest investors on the planet, people like Buffett and Soros, are basically playing their own version of Jonah Barrington's game every single day. Let's take a look. Let's look at this classic story about a young Warren Buffett. He bought a company called Dempster Mill. Now here's his mistake. He thought he could personally turn the business around. But he realized pretty quickly he was in way over his head. In his own words, it just wasn't his cup of tea. But here's the brilliant part, the correction. He didn't just cross his fingers and hope for the best. He took immediate action. He hired a turnaround expert to come in and fix the business. And what was the result? He sold it a few years later for a nice profit. He saw the mistake, he admitted it, and he corrected it. And now let's go back to George Soros. The entire foundation, the absolute bedrock of his whole system, is this one concept: fallibility. He starts with a basic assumption that he will be wrong. It's not a question of if, it's a question of when. And by just accepting that from the get-go, he strips out all the ego and emotion that makes the rest of us cling to our bad decisions for way too long. So how does he actually do this? Well, Soros has a simple, unemotional trigger. He doesn't sit around trying to decide if he was right or wrong. He lets the market tell him. If he takes a position and it immediately starts moving against him, that's it. That's the signal. The market is screaming, "You're wrong." And what does he do? He beats a hasty retreat. He sells first and asks questions later. The number one priority is to stop the bleeding and correct the mistake. Okay, so this brings us to our final and honestly the most important part of all of this. How do we take these lessons from legendary investors and squash champions and actually apply them to our own lives? How do we start looking at our own mistakes not as these terrible failures, but as the actual path to getting smarter? There's this great old parable that just sums it all up perfectly. A young person asks a wise old bank president, "What's the secret to your success?" The president says, 2 words, right decisions. They ask, "Okay, and how do you make right decisions?" He says, 1 word, experience. And then they ask the final question, "And how do you get experience?" And his answer is simple, 2 words, wrong decisions. That's it. That's the loop. You can't get to wisdom without making a whole lot of mistakes first. And this is really the core idea I want you to walk away with. We have to completely change the way we think about messing up. A wrong decision is not a final verdict on who you are. It's not a failure. It is quite simply the price of admission you pay to get real, valuable experience. Every single master of any craft was once a total disaster, and they got to where they are by learning from everything that went wrong. So, I'll leave you with this question to think about. Look at your own life, your investments, your career, a project you're working on. Based on everything we've talked about, what is the one wrong decision? The one thing you're hanging on to out of hope that you can finally admit to yourself isn't working and correct starting today.
All right, let's talk about something that trips almost everyone up, not just in the world of investing, but in life. And that's the fear of making a mistake. Today, we're going to break down how the world's greatest investors don't just put up with their mistakes. They actually hunt them down, they dissect them, and they turn them into the very building blocks of their success. So yeah, let's get right into it.
You know, this image really nails the core idea. Over on the left, you see the master investor, who looks at a mistake and sees a lesson, a seed for future growth.
But then on the right, you've got the losing investor who just wants a quick fix, a band-aid. They're always searching for that magic bullet, jumping from one strategy to the next, and they never, ever stop to figure out why the last one blew up in their face. And look, this isn't just a tiny difference in style, this is the whole game right here.
I mean, think about it like this for a second. How would you teach someone to ride a bike? Would you hand them a textbook on physics and the principles of balance? No way, right? Of course not. You put them on the bike, you give them a little push, and you let them fall. And then you let them fall again. Because we all know deep down that real learning, the kind that actually sticks with you, comes from trying, from failing, and from getting back up.
So, here's the game plan for today. We're going to start with the winning habit itself, then we'll dig into the psychology of why we're so terrified of failure. We'll contrast that with the mindset of the masters, check out some incredible real-world stories, and then, and this is the important part, we'll give you a practical system you can use to learn from your own mistakes. Then we'll wrap it all up with a really powerful final thought. Okay, let's kick things off with the core principle. And this isn't just some clever little idea. This is about how our brains are literally wired to learn and to get better.
We are hardwired to learn this way. Think about a little kid touching a hot stove. They only do it once, right? The lesson is immediate, it's powerful. But here's the catch, and it's a big one. The simple instinctual reaction is, okay, all stoves are bad, stay away from all stoves. But that's not really learning, is it? That's just a reflex. Real learning demands analysis. It's figuring out that the stove isn't the problem, the heat is the problem. It's learning that it's perfectly safe to put your hand on a cold stove. That distinction, that's everything.
And you know who put this perfectly? Warren Buffett. He said, "Can you really explain to a fish what it's like to walk on land? I mean, you can spend 1,000 years in the water just talking about it, theorizing about it, but it's all just talk. That one single day of actually being on land, of feeling the ground under your feet, probably stumbling around a bit, that's where all the real learning happens. It's why experience, and all the mistakes that come with it, is the best teacher there is, period."
Okay, so if learning from mistakes is so natural, so wired into us, then why is it so ridiculously hard for most people? Well, the answer goes way back to how we were taught to think about mistakes in the first place. From the time we're kids, our school systems teach us the exact opposite of what the real world requires. You see that big red X on your test paper? That's not framed as, hey, here's a great opportunity to learn something. No, it's a punishment. It's a grade. It's a mark of failure. And we internalize that message so deeply. Mistakes are bad. And if you make them, it means you are bad, or dumb, or just not good enough.
So what happens when that conditioning gets out into the real world? Well, it's pretty devastating. When an investment goes south, that conditioned response kicks in. And it's not about analysis. It's about protecting our ego. We deny it was a real mistake, we dodge responsibility, we blame the market, we blame the Fed, we blame that guy on TV, we blame anybody but ourselves. And because we never truly own the mistake, there's absolutely no way we can learn from it. And that means we're pretty much doomed to do it all over again.
Okay, so that's the common reaction. Now let's just flip the script entirely and look at a totally different and way more powerful way of thinking. Let's look at how the real masters handle this stuff.
This slide just lays it out so clearly, doesn't it? On one side, you have the usual reaction, getting all tangled up in denial, blaming other people, and all the emotional baggage that comes with it. You try to mislead others to save face, but in the end, the only person you're really fooling is yourself. But then, you look at the master's reaction. It's the complete opposite. It's instant acceptance. It's taking 100% responsibility, and it's being brutally, painfully honest about the screw-up. It's a conscious choice to face reality instead of trying to run away from it.
And this quote from George Soros, I mean, wow, it turns everything completely on its head. For most people, being wrong feels shameful. For Soros, the shame isn't in making the mistake. The shame is in failing to see it and fix it. He actually takes pride in his ability to recognize when he's wrong. Now that isn't just a different strategy. That is a fundamentally different philosophy on what it means to be smart and effective.
But hey, this isn't just some high-minded philosophical debate, right? Let's see how this mindset actually works in the real world when the pressure is on and everything's on the line. We're going to look at two stories where near disasters became the defining moments for two absolute legends.
So let's travel back to 1962. A young George Soros spots what he thinks is a surefire bet, a classic arbitrage play in the car company Studebaker. The idea was simple: buy one class of shares, short another, and just pocket the difference. It looked like free money, so he went all in.
He went big. But here's the thing about the market. It doesn't care about your surefire bets. The trade went spectacularly wrong. The part he had shorted just skyrocketed, and the gap between the two shares got wider and wider, putting him in a truly terrible position. He was way over-leveraged, he hadn't thought about an exit plan, and suddenly, he was staring right into the financial abyss.
And this wasn't just about losing some play money. The stakes could not have been higher. This was personal. He'd borrowed money from his own brother, who was just starting a business and absolutely could not afford to lose it. Soros was literally facing total financial and personal ruin.
Okay, so here's the most important part of the story. Soros managed to survive the trade, but the psychological scar, well, that was deep. That mistake, that moment of near total wipeout, it forced him to tear down and rebuild everything he thought he knew about the markets. It became the bedrock, the foundation for the entire investment system that would one day make him a billionaire legend. You see, the mistake wasn't the end of his story. It was the beginning.
Now for another story, about a totally different kind of mistake. This one comes from the master himself, Warren Buffett. Back in 1988, he started buying up shares in Fannie Mae. He knew it was a fantastic business. He understood it inside and out. But as he was buying, the stock price just kept ticking up. He got frustrated, annoyed that the market wasn't letting him buy cheap, and in a moment of pure emotion, he just sold the 7 million shares he had already bought.
That one emotional decision, that silly move, as he later called it, cost him and his shareholders an absolutely mind-boggling amount of money. The opportunity cost is estimated to be around $2 billion. $2 billion. He fully admits he let his frustration take over, and he left an incredible fortune on the table. But you know what? The lesson he learned from that costly mistake was priceless, and it helped him avoid making the same error when he was buying Coca-Cola stock just a bit later on.
Okay, so these stories are incredible, but how do we actually do this for ourselves? How can we apply this? Well, the master investor doesn't just feel bad about a mistake. They have a system, a process for breaking it down.
This right here is a really powerful diagnostic tool. So instead of just feeling awful, you can pinpoint the type of mistake you made. Did you break your own rules? Maybe you got excited and bought a stock without going through your full checklist. Was it a simple oversight where you just missed one key number in a financial report? Or was it an emotional blind spot, kind of like what happened with Buffett and Fannie Mae? Maybe the entire market shifted from bullish to bearish, and you just failed to notice. And then there are the ones that hurt the most, the sins of omission, the brilliant ideas you had that you knew were right, but you just failed to pull the trigger. See, when you can categorize an error, you change it from this big, vague failure into a specific problem that you can actually solve.
And all of this brings us to the final, and maybe the most crucial, piece of the puzzle. It's about taking this whole process of self-analysis and making it a core part of who you are. I absolutely love this quote from Charlie Munger because it's so Munger. Rub our own noses in our own mistakes. Now, he's not talking about beating yourself up. This isn't about self-loathing. It's about not letting yourself off the hook easily. It's about forcing yourself to really feel the sting of the mistake so that the lesson gets burned into your brain and you never ever forget it. It's a commitment to being rigorously, unflinchingly honest with that person you see in the mirror every morning.
And really, that's the question this whole thing boils down to. Turning your mistakes into fuel for growth isn't something that just happens. It takes real courage. It takes humility. It takes a genuine willingness to look at your own decisions with a critical eye, especially when it hurts the most. So the question I want to leave you with is this. Are you willing to do the hard work of becoming your own most severe, but also your own most constructive critic? Because that, at the end of the day, is the only real path to mastery.
You know, when you think of the absolute legends of investing, a couple of names just pop right into your head, don't they? Warren Buffett, George Soros. They're like these mythical figures, right? It feels like they have this Midas touch, this innate genius for the markets that the rest of us can only dream about. And I mean, just look at these numbers. It's insane. For decades, they pulled in annual returns that are just mind-boggling. Buffett cruising at over 24%, Soros at a jaw-dropping 28%. You let that compound over a lifetime? Well, that's how you build the kind of wealth that's hard to even comprehend. It's the kind of performance that almost seems like it shouldn't be possible. So you have to ask, right? Was it just a gift? Did they just show up on day one, fully formed, with some kind of supernatural ability to just read the markets? It's a really tempting idea to believe in, but it's a total myth. Because the truth of the matter is actually a lot more down to earth and, frankly, a lot more useful for you and me.
Before all the fame, before the billions, before those legendary track records we just saw, there was a long, hard apprenticeship. Both Buffett and Soros spent almost 20 years in the trenches, making mistakes, learning, and just grinding it out to hone their craft. So to really get how they reached that level of mastery, we've got to deconstruct that journey. We'll kick things off by tackling this genius myth head-on. Then we're going to dig into their 20-year head start, look at a wild cautionary tale of what happens when you try to skip the hard work, and finally, really understand the true price of experience. So why do we even fall for this genius myth in the first place? Well, it's pretty simple. We want to believe that investing is an easy way to get rich quick. We see these stories online about some amateur who got lucky in a bull market, and heck, even the simplified advice from the masters themselves can make it all sound so effortless. It creates this powerful illusion that you can just show up, put your money in, and win. But, as the legendary hairstylist Vidal Sassoon once said, the only place where success comes before work is in a dictionary. It's so true. In the real world, and especially in the world of investing, the work always comes first. There are just no shortcuts. Okay, so what did that hard work actually look like for them? Let's really dive into those formative years, because this wasn't about, getting a business degree and immediately starting a fund. No way. This was a deep, practical, hands-on education that basically spanned their entire youth and early adult lives. Warren Buffett's journey, well, it started ridiculously early. At 5 years old, he's out there selling gum. By 11, he's buying his first stock. And by his mid-teens, he's basically a small-town business mogul. This was not some kid with a piggy bank. This was an entrepreneur in the making, learning about profit, customers, and operations long before he was even old enough to get a driver's license. What's so amazing is just the sheer variety of businesses he was running. These weren't just odd jobs for pocket money. They were businesses. He was arbitraging Coke prices from his grandpa's store, turning his paper routes into a subscription machine, creating passive income with pinball machines and barbershops. This hands-on experience gave him a business sense that, as he later said with disgust, was way better than what his professors at Wharton were trying to teach him. He was learning about competitive moats firsthand. Now let this number sink in for a second. $175 a month in the mid-1940s. For a teenager, that was an absolutely astronomical amount of money. It just shows you a level of seriousness and execution that was completely off the charts. He wasn't just working for some spending money. He was building capital from day one. And here's the proof that even the Oracle of Omaha started out making the same mistakes we all do. His very first stock, he panicked when it dropped, sold out of sheer impatience for a measly $5 profit, and then had to sit there and watch it rocket up to $200. A painful lesson for sure, but probably one of the most priceless ones he ever learned about patience. But you see, he learned. After he soaked up everything he could from his mentor, the great Benjamin Graham, he put those principles into practice. In just 6 years, between the ages of 20 and 26, he took that nearly $10,000 he'd saved up from all his childhood businesses and turned it into $140,000. That's a compound return of over 50% a year. He had already proved his system worked long before anyone had ever heard of the Buffett partnership. All right, let's pivot and talk about George Soros. His path was just as long, but man, it started in a completely different universe. He didn't dream about business and balance sheets. He dreamed of being a philosopher. But his grades just weren't good enough for an academic career. So he was kind of forced into the world of finance more out of necessity than any real passion. And it was not an easy start for him at all. As a Hungarian immigrant in London, he faced huge barriers. This quote from a managing director just perfectly sums up the old boys club he was trying to break into. He couldn't rely on who he knew. He had to rely on pure grit and talent, learning his craft the absolute hard way. And his path was anything but a straight line. He bounced between jobs, moved to New York, had his entire business strategy completely wiped out by a single change in tax law, and even took a 2-year break to go back to writing philosophy. It was only at age 32 that he finally committed full-time to investing, and it took another 6 years after that before he set up the fund that would eventually become the legendary Quantum Fund. That's 17 years from start to finish. So what happens when truly brilliant people think they can skip that long apprenticeship? Well, that brings us to the infamous, spectacular blow-up of long-term capital management, or LTCM.
On paper, LTCM was an absolute dream team. It was founded by the top traders from Salomon Brothers, and they had 2 Nobel Prize-winning economists as partners. They were, and I'm not exaggerating, literally considered the smartest guys in any room they walked into. What could possibly go wrong?
Well, their downfall followed a script you see time and time again. They had true mastery in one very specific niche, bond arbitrage. But that wild success bred a really dangerous hubris. They started to think their computer models were infallible, that they were magic, so they overreached. They took those models and applied them to totally different markets, like merger arbitrage, places where they had zero hands-on experience. They ignored all the warnings, and when a crisis hit, their whole house of cards just came crashing down.
And the end result was just catastrophic. After quadrupling their investors' money in a few short years, they vaporized 92% of it in a matter of months. All that genius, all those Nobel Prizes, it meant absolutely nothing without the hard-won experience in the new games they were trying to play. They tried to skip the apprenticeship, and they paid the ultimate price for it.
So we've seen the myth of instant genius, and we've seen the reality of the long, hard road. What is the one core lesson we can really take away from all of this? Well, it all boils down to understanding the price of experience and, more importantly, being willing to pay your dues.
And this really shows the fundamental difference. A master investor's returns actually get better over time because they learn from every single mistake they make. That experience becomes a compounding asset. The losing investor, on the other hand, doesn't even know they have to pay these dues. They just keep making the same errors over and over, blaming it all on bad luck until their account hits zero.
So what does paying your dues really mean? It's this process right here. It means making mistakes with real money on the line, feeling that sting, and then having the discipline to sit down and figure out what you did wrong without blaming the market or anyone else. When you do that, those painful losses stop being just losses. They become tuition. They're an investment in your future.
And this quote from Buffett just nails the mindset you have to have. You've got to be objective. Your feelings, your hope, your fear, your frustration, they are totally irrelevant. The market is impersonal. And to learn from a mistake, you can't take it personally. You have to take responsibility, find the flaw in your process, and fix it for next time.
Look, the journey to becoming a competent, successful investor is not a get-rich-quick scheme. It took Buffett and Soros, 2 of the greatest to ever do it, almost 20 years of trial and error. But knowing that you have to start at the bottom of that learning curve, that you have to pay your dues, that's not a disadvantage. It's the single greatest advantage you can possibly have.
You know, we're always told to collaborate, to share our ideas, to brainstorm. But what if the single most powerful strategy used by the world's greatest investors is the exact opposite? What if their biggest edge is just keeping their mouths shut? That's what we're digging into today, this incredibly counterintuitive and frankly powerful winning habit.
I mean, it doesn't get much more direct than this, right? A TV interviewer asks the legendary trader George Soros for a stock tip, and this is what he gets. I'm not going to tell you. No games, no coyness, just a brick wall. And you got to understand, this isn't him being rude. This is his strategy in its purest form. It really sets the stage for everything we're about to uncover. And then you've got Warren Buffett, who took this whole idea to an almost unbelievable extreme. His biographer said he was so paranoid about secrecy, he was actually afraid of talking in his sleep. Think about that. This isn't just about protecting a billion-dollar trade. This level of discipline was baked into his DNA right from the very beginning. And this quote from Buffett himself, wow, this just gets right to the heart of it all. It's about total, absolute self-reliance. The real masters of the game, they aren't looking for a committee to sign off on their ideas. Their validation comes from their own homework, their own reasoning, and a long, hard look in the mirror. Okay, so here's our game plan. We'll start with this fundamental vow of silence. Then we're going to crack open the vaults of both Warren Buffett and George Soros to see how they put it into practice. After that, we'll look at a cautionary tale of what happens when you talk too much, dive into the psychology of why it's so darn hard to stay quiet, and finally, show you how this can become your own secret weapon. All right, let's get right to the core principle here. When it comes to how they handle their investments, there is just a massive divide between the masters of the universe and pretty much everybody else. They are walking down 2 completely different roads. And here it is, the big one. Winning habit number 17 from our source material. Never, ever talk about what you're doing. For the best of the best, this isn't just a friendly tip. It is an ironclad rule. It defines their entire operation. And what's so interesting here is how it breaks down the two kinds of investors. So on one side, you have the master investor. They operate in total silence. They genuinely could not care less what other people think. All their conviction comes from within. But on the other side, you have the losing investor. And this person is always talking, always sharing. They're not really investing based on facts. They're testing their ideas, looking for somebody, anybody, to tell them they're right. And that, my friends, is the whole ballgame. So let's start with case study number 1, the Oracle of Omaha himself. For Warren Buffett, secrecy isn't just some quirky habit. No, it's the very foundation of his empire. And he laid that first brick on day 1.
Now, this is so crucial to understand. When Buffett started his very first partnership back in 1956, he wasn't the Icahn we know today. He was managing a tiny amount of money, about $100,000, but even then, his rule for his partners was absolute. He said, "I'll run this like it's my own money, and I won't tell you what I'm doing."
And you better believe he meant it. This story is just incredible. So a partner storms into his office and demands to know what the partnership is invested in. Buffett's in a meeting, he tries to put the guy off. The partner doesn't care, he insists. So Buffett excuses himself, disappears for literally 1 minute, comes back, and calmly tells his secretary, "Price that guy out. Get him out of the partnership." The rules were the rules, period.
Okay, so why was he so hardcore about this? It all comes down to this core philosophy. For Buffett, being right about an investment has absolutely nothing to do with how many people agree with you. Zero. The only thing that makes you right is that your facts are solid and your reasoning is sound. Everything else is just noise.
And here's the final piece of the Buffett puzzle. This isn't just about philosophy, it's smart business. He sees a good investment idea as a piece of property. It's his intellectual property. It's rare, it's valuable, and if he talks about it, other people can steal it. I mean, would Coca-Cola publish its secret formula? No way. For Buffett, a great stock idea is his secret formula. All right, now let's pivot from Buffett to our second master, George Soros. He operates on the exact same principle of silence, but because he's a global macro trader, the game is faster, the stakes can be even higher, and his methods for staying quiet are, well, they're next level. He plays an anonymous game.
Soros literally built a fortress of silence around his fund. His staff had a strict rule: you do not talk to the press, ever. His firm became legendary for its secrecy. To place trades, he didn't just call a broker. He had special direct phone lines to the heads of the firms. And to build these massive multi-billion-dollar positions without anyone noticing, his orders would be painstakingly broken up into tiny, tiny little lots. The goal was to move like a ghost and leave no footprints.
So we've seen how the masters practice silence. But what happens when you break that sacred rule? Well, let's look at a dramatic, real-world example where talking didn't just cost a little money. It was an absolute catastrophe. So let's play this out. What happens when a trader does the exact opposite of a George Soros? What if you bet millions that a stock is going to crash, and then you go out and tell everybody about it? This is just a perfect illustration of the danger. Back in 1978, a trader named Robert Wilson shorted a stock called Resorts International. Then he basically went on a victory lap, bragging about his position, and then he went on a round-the-world vacation. Big mistake. While he was gone, the market, knowing he was on the hook, pounced. The stock went ballistic, from $15 a share to $120. They finally tracked him down, and he was forced to buy back the shares at these insane prices, which only drove the price higher. He was literally squeezing himself into financial ruin. And here is where the pure genius of silence comes into play. By talking, Wilson painted a giant bullseye on his own back. He basically sent out an invitation for the market to crush him. But you know who else was short that same stock? George Soros. And Soros, being Soros, had kept his mouth shut. While Wilson was getting destroyed, Soros quietly covered his own short, and then he flipped and went long, making a profit from the very chaos that was wiping out the guy who couldn't keep a secret. I mean, you can't sum up the lesson any better than Soros did himself after that whole episode. It's so simple and so powerful. Talk is a liability. Your job is to analyze and act, not announce and advertise. Okay, so if staying silent is such a clear strategic advantage, why is it so incredibly rare? Why do most of us feel this overwhelming need to talk about our investments? Well, the answer isn't in a finance textbook. It's deep inside our own heads. This question, This is the one that haunts the average investor. It's a question that comes from a place of uncertainty, a place of anxiety. The moment after they click buy, this doubt just creeps in, and they start looking for reassurance, not from the data, but from other people. And check this out. This anecdote from the source material is just fascinating. An investment advice hotline did a study and found that more than half of the people calling in had already made their move. They weren't calling for advice on what to do. They were calling for confirmation that what they did was okay. They just wanted someone to pat them on the back and say, good job. It's a psychological need that guys like Buffett and Soros simply don't have. So let's bring this all home. We've seen Buffett's ironclad discipline, Soros's obsession with operational security, and the disaster that happens when you ignore these rules. The lesson from these titans isn't just some abstract theory. It's a real, tangible, strategic advantage that anyone can start using today. And so we're going to end with this one question, a question for you to really think about. Is your conviction, in your research, in your reasoning, strong enough for you to stay silent? Or do you feel that pull, that need for the validation of the crowd? Because true conviction doesn't need an audience. The answer to that question really tells you everything, a lot about the kind of investor you are and the kind you can become.
You know, when we think about the greatest investors in the world, our minds usually jump to stock picking or timing the market. But what if one of their biggest secrets is something we all do, every single day, often without a second thought? Today we're going to talk about the art of delegation. It's this hidden genius that really separates the masters from everybody else.
And Warren Buffett just sets the stage perfectly with this quote. Look, he's not just talking about hiring someone for a job. He is laying down the #1 rule for trusting anyone with anything, especially your money. Integrity, he says, is the one thing you can't compromise on. It's the bedrock. Keep that in your head, because it's the key to this entire discussion.
All right, so here's the game plan for today. First, we'll break down what this unsung genius really is. Then, we're going to look at two absolute legends who came at it from completely different angles. Warren Buffett, who is just a natural at it, and George Soros, who really had to learn it the hard way. After that, we'll see how this applies to you and me, before we wrap it all up with the mindset you absolutely have to have.
So, what is this winning habit we're talking about? Well, it's the skill of delegation. It's about looking past the numbers on a spreadsheet and getting that every investment you make is, at its core, an investment in people. The best investors, they aren't just brilliant analysts. They are world-class judges of character. And this is where you see the huge split, right? The master investor knows how to delegate pretty much all of their responsibilities by finding the absolute right people and then just trusting them. The losing investor, though, they often make bad calls, using the same broken logic to pick managers that they use to pick stocks. This is really the central challenge we're digging into.
Let's kick things off with a master himself, Warren Buffett. I mean, his success isn't just about buying great companies cheap. It's about his almost supernatural talent for buying great companies, run by great people, and then having the wisdom to just get out of their way. He is the poster child for a natural-born delegator.
This quote from another investing legend, Walter Schloss, just nails Buffett's unique genius. Think about it. Lots of people are good analysts. Some are good salespeople. A handful might be good judges of people. But to have all three of those skills at an elite level, that is incredibly rare. And honestly, that's the secret sauce that let Buffett build an entire empire basically on trust. So just how deep does this skill go? Well, let's get into a famous story that shows Buffett's intuition is almost spooky when it comes to character. It's one thing to be able to read a financial statement. It's something else entirely to read a person's character in a single meeting. Okay, picture this. It's 1978. There's this super charismatic guy, a credit union manager named Larry King, and he is the talk of Omaha. He's raising money from everybody. Seems like a pillar of the community, you know, the safest hands in town. He goes to pretty much every wealthy person in the city asking for an investment. But when Larry King came knocking on Warren Buffett's door, he got shut down. Flat. Buffett didn't need to see the books or do a background check. He said later that he knew instantly that King was a fraud. In fact, he was probably the only guy in the whole city King didn't even bother asking for money. So, why? And there's the punchline. For Buffett, the lack of integrity was as obvious as a giant flashing neon sign. While everyone else saw this charming community leader, Buffett just saw phony. And of course he was right. King was eventually convicted of fraud and sent to prison. That's what judging character at the highest level looks like. And what's the result of this genius for delegation? It's this number, 15.
That's roughly how many people work at the global headquarters of Berkshire Hathaway. A company with hundreds of thousands of employees around the world is run by about 15 people at the top. That's only possible because Buffett picks the right people to run things and then trusts them completely to do their jobs. It's the ultimate proof of his philosophy.
Okay, but not everyone is born with this skill. For an amazing contrast, we've got to look at George Soros. He was a brilliant, brilliant investor, no question. But when it came to judging people and letting go of control, he had to learn through a really painful process of trial and error. His story is great because it shows that this is a skill you can develop, even if it doesn't come naturally.
I mean, you have to admire the honesty here, right? Unlike Buffett, Soros was painfully aware of his own blind spot. He knew he was a genius with markets, with history, with geopolitics. But when it came to people, he himself admitted he was quite awful, and that weakness had real, painful consequences for his fund.
So this timeline really maps out his whole struggle. It started back in 1980. His famous partnership with Jimmy Rogers blew up because Soros wanted to expand the team and Rogers didn't. So Soros tried to do it all himself, which led to total burnout and his first ever losing year in 1981. His first real shot at delegating was this fund-of-funds idea, which just didn't work out well. It took him until 1988 to finally find Stanley Druckenmiller, who was, get this, his 9th try at finding a successor. And even then, he had trouble letting go until a massive world event, the fall of the Berlin Wall, basically forced his attention elsewhere.
This really shows you the complete transformation he went through. He went from trying to do absolutely everything, being both the captain steering the ship and the stoker shoveling the coal, to a totally new model. With Druckenmiller, he finally figured it out. They built this coach and player relationship where Soros could guide and mentor without getting in the weeds. It was a victory, but man, he had to fight for it.
So right about now, you might be thinking, okay, this is great for billionaires, but what does this have to do with me? Well, it has everything to do with you. Because whether you realize it or not, every single investment decision you make is a huge act of delegation.
Let's just walk through it. When you open an account at a brokerage, you're hiring them to take care of your money and execute your trades. When you buy into a mutual fund or an ETF, you are hiring that fund manager to make all the buy and sell decisions for you. And with every single stock you buy, you are effectively hiring that company's CEO and their entire management team to be good stewards of your cash. You are their boss, and you're trusting them to do a good job for you.
And that brings us to a really critical question. When you just sort of passively invest, or you trade based on fear and greed, you are basically delegating all control to Mr. Market. And as the great Benjamin Graham taught us, Mr. Market is a business partner with, let's just say, some serious emotional issues. He's euphoric one day and totally depressed the next. So let me ask you this. Would you knowingly hire a money manager like that? Probably not. So why are you letting him call the shots on your financial future?
Okay, this brings us to the last and honestly the most important part of this whole thing. It's the core mindset that separates the masters from everyone else. It's all about understanding the crucial difference between authority and responsibility.
This is the golden rule right here. A master investor delegates authority. They let other people make decisions or handle tasks to free up their own time and mental energy. But they never, ever delegate the ultimate responsibility for the final outcome. That always stays with them. This quote just says it all, doesn't it? If your fund manager loses a bunch of your money or the CEO of a company you own makes a terrible call, you can't just point the finger and blame them. The master investor gets it. The responsibility for choosing that person in the first place was theirs, and theirs alone. The buck always stops with you.
So we'll leave you with this question to think about. Every single day, with every dollar you put to work, you are placing your trust in somebody, a broker, a fund manager, a CEO. After seeing how the best in the world approach this, it's really worth asking yourself, who exactly are you trusting? And have you put as much thought into judging their character as you have into judging their balance sheet?
All right, let's dive right in. We're going to break down a financial principle that is so simple, so incredibly basic, that it's almost hiding in plain sight. Seriously, it's the foundation for some of the world's biggest fortunes, and it boils down to just 5 little words. Whatever you have, spend less. Sounds too easy, right? Well, let's unpack why that simple idea is one of the most powerful concepts in all of finance. So here's how we're going to tackle this. First, we'll look at the bedrock foundation of this whole idea. Then, we'll see how this one choice creates 2 totally different paths in life. We'll look at a couple of case studies, real heavy hitters, George Soros and Warren Buffett, to see how they put this into practice. After that, we'll get into the engine that this habit fuels. And finally, we'll uncover the surprising thing they were all really chasing.
Okay, Section 1, the foundation of wealth. And look, this isn't some brand new, complex strategy from a finance guru. This is an ancient truth, something that was captured perfectly by one of the greatest storytellers who ever lived.
Just look at this quote. I mean, it's from the 1800s, but it might as well have been written yesterday. Mr. Macabre is giving us the universal formula for financial life. He's showing us that the difference between happiness and misery isn't some giant mountain of cash. No, it's a razor's edge. It's 6 pence. It's that tiny but absolutely life-changing gap between what you bring in and what you spend.
And this slide just cuts right to the chase. You know, unless you get lucky with a lottery ticket or marry into a fortune, there's really only one legitimate way to build wealth from scratch. It's not sexy, it's not exciting, but it is the absolute bedrock of every single self-made fortune. You just have to live below your means. That's it. That's the starting line.
Which brings us to Section 2. Because this one simple decision to spend less than you make is a fork in the road. It literally creates two completely different financial destinies. This is where we see the clash between two core mindsets that will shape your entire life. And here they are. You've got the master investor who deliberately creates a huge buffer zone between their income and their spending. And then you have the losing investor, who's basically walking a tightrope, living right at or maybe even a little bit past their means. Day to day, it might not feel like a huge difference. But over a lifetime, it creates two completely different worlds.
And you know what? This stuff starts so young, doesn't it? Think about it. You've got the frugal kid carefully stashing away some of their allowance. They're laying the very first bricks for a life of freedom. And then you have the other kid, the one who spends it all on candy the second they get it and then asks for more. The scary part is these habits we form as kids often stick with us for life.
All right, so let's see this principle in the real world with Section 3, our first case study. The legendary and famously modest billionaire George Soros.
I mean, this quote tells you everything you need to know. Out of all the things $1 billion can get you, private jets, yachts, entire islands, what does Soros say is the best perk? A good tennis game. It's such a simple, down-to-earth answer. It shows you a mind that doesn't see money as a way to buy more stuff, but as a tool to craft a life he enjoys.
And his entire life was a reflection of this. I mean, think about this. The guy loved a specific painting by a famous artist, Paul Klee, but he actually returned it because he couldn't get over the price tag. He could have bought the entire museum. But that deep-seated habit of frugality was just who he was. He turned down fancy apartments because they were too big, and he'd rather take a taxi or the bus than have a private driver. This wasn't for show, it was his default setting.
Okay, so let's move to Section 4 and our next case study. This is a guy who takes this whole idea to an entirely different, almost extreme level. Warren Buffett, the one and only Omaha extremist.
Just like Soros, Buffett totally understands the real limits of money. He knows deep down that it can't buy the two things that actually matter in life, love and health. And that one simple, powerful belief is the engine behind his legendary thriftiness.
This story about the penny says it all. Picture it. Buffett, already a giant of the financial world, is in an elevator with a bunch of other executives. He sees a single penny on the floor. Now, everyone else, of course, they just ignore it. It's a penny. Who cares? But Buffett, he bends over, picks it up, looks at his shocked colleagues and says with a grin, the beginning of the next billion. See, it was never ever about the penny. It was always about the principle.
And this right here is the absolute key to understanding how Buffett thinks. He doesn't look at a dollar and see a dollar. He sees a seed. He sees what that dollar could grow into in 5, 10, 20 years. So for him, spending $1 today isn't just spending $1. It's killing off all the future dollars that little seed could have become. It's like cashing out a tiny future fortune.
And this isn't just a personal quirk, okay? This is his investing gospel. He actively seeks out companies run by people who are just as obsessed with cutting costs when business is great as they are when things are bad. To Buffett, being frugal isn't a raincoat you only wear when it's storming, it's the skin you live in, 24/7.
This story is just amazing. So Buffett's longtime partner, Charlie Munger, hears about a bank chairman who refused to use company money for a Christmas tree. He told an executive to just buy it himself. Now, most of us would hear that and think, wow, what a Scrooge. But Munger's reaction? He said, when we heard that, we bought more stock. That's how much they valued that extreme culture of saving money.
Okay, so this brings us to Section 5. Why? Why all this obsession with pennies and apartments, especially when you're already a billionaire? What is the point? Well, it's because every single dollar you save is another drop of fuel for the most powerful financial force in the universe, compounding. You see, in the beginning, this habit of saving is all about building your pile of capital. That's the grind. But once you've built it, the game totally changes. Now it's about defense. It's about protecting what you have. It's about never forgetting how hard it was to earn in the first place and how ridiculously easy it is to lose.
This whole discipline is what guards the master investor's #1 rule: preserve your capital. Don't lose money. Because by protecting what you have and constantly feeding it with the money you save by living below your means, you unleash the slow, quiet, unstoppable magic of compounding. You let it work for you, day and night, forever.
And really, the choice couldn't be more clear. It's black and white. If you live below your means, compound interest becomes this incredible wind at your back, pushing you forward. But if you live beyond your means and go into debt, that exact same force turns into a relentless headwind, fighting you every single step of the way.
So what's the end game here? Why go through all this trouble? Section 6 gets to the heart of the true motivation. And trust me, it has almost nothing to do with buying more stuff.
For most people, the dream of being rich is a dream of spending. It's a mental shopping list of cars, houses, and vacations. It's all about consumption. But the master investor? They're playing a completely different game. They're chasing a prize that you can't just go out and buy, but that money can definitely help you achieve.
And Charlie Munger just lays it all out on the table right here. The passion that drove him, that fire in his belly, it wasn't for Ferraris. He says he wanted independence, and not just kind of wanted it. He desperately wanted it. That's the real prize, the freedom, the ability to be the author of your own story, to wake up every day and do what you want, with who you want, where you want.
And so that's the big question this whole explainer leaves us with. Every single dollar we spend is a choice. Is that dollar buying a fleeting luxury, something that will be gone tomorrow? Or is it a down payment on lasting, genuine freedom? It's a question worth asking yourself every single day.
You ever wonder what really drives someone who already has everything? I mean, we all assume it's about the money, but for the world's greatest investors, well, the truth is way more interesting. We're going to dig into the real motivation behind these masters of finance. Okay, so right off the bat, you see this massive difference. On one side, you've got the master investor. For them, it's all about stimulation, about self-fulfillment. And then on the other side, the losing investor. They're just motivated by cash, by the dream of easy riches. And believe me, this one single distinction, it's the key to everything else we're about to talk about. So what does this actually look like in the real world?
So here's how we're going to break it down. First up, we'll tackle what's called the billionaire's paradox. Then we'll get into the two basic psychological forces that drive pretty much all of us. After that, we'll look at our two big case studies, Warren Buffett and George Soros. And finally, we'll see why for these guys, getting crazy rich was really just a side effect. All right, let's dive into this billionaire's paradox. Seriously, when you have more money than you could possibly spend in a dozen lifetimes, why would you keep working? Why not just buy an island and, sail off into the sunset? Wow. I mean, that's a pretty intense answer from Rupert Murdoch, isn't it? It just shows you this incredible, almost existential link to the work itself. For people at this level, it's clearly not just a job. It feels like it's a core part of their identity, maybe even their whole reason for being. So let's really focus this question on our two main guys here. I mean, these guys are famously frugal. They aren't exactly buying fleets of super yachts, right? So what's the engine that's pushing them day in and day out, year after year? It's definitely not about getting more stuff. The answer, it turns out, is deep in the psychology of motivation. So, to really get inside their heads, we need a simple framework. And it turns out, pretty much all human motivation boils down to two fundamental forces. You're either moving away from something you're afraid of, or you're moving towards something you really want. Think of it like this, okay? Away from motivation is all about escaping something bad. You work your tail off because you're terrified of being poor. But toward motivation, that's about chasing something good. You work hard because you're just passionate about building something or mastering a skill. One is basically fueled by fear, and the other is fueled by passion. This tiger analogy explains the limits of that away from motivation perfectly. Picture this. You see a tiger in the jungle. That fear is an unbelievable motivator. I guarantee you'll run faster than you ever thought you could.
But the second you make it to a safe village, you stop running. The motivation completely disappears because the threat is gone.
So, here's the bottom line. Motivation that's based on fear is finite. It has an expiration date. As soon as you escape the danger, that drive just fizzles out. It's great for getting you started, but it almost never keeps you going for a lifetime unless, of course, that fear was something truly life-changing.
And this is that exception. When an away-from event is powerful enough, and it happens when you're young, it can get burned into your brain for life. For Warren Buffett, it was watching his own father get completely wiped out in the Great Depression. For George Soros, it was something way more terrifying, surviving the Nazi occupation in Hungary. That experience created a lifelong obsession with survival that has defined everything he's done. This explains part of their drive, for sure, but it is not the whole story.
For the whole picture, we got to look at their toward motivation. And let's start with Warren Buffett because, honestly, his reason is just so simple and, well, fun. He's not really working. He's playing a game that he absolutely positively loves.
I mean, you can just feel it in that quote, can't you? Tap dance to work. Who says that about their job? Someone who isn't doing it for the paycheck. He's literally pulled toward his office every single morning by this incredible passion for the process itself, the puzzle, the people, the challenge of it all.
And that right there, that's the absolute key to understanding Buffett. The billions of dollars, they're not the prize. They are just the points on the scoreboard. He wants to win the game, and money is just how you keep score. It's like a great baseball player wanting a high batting average. Buffett wants to see his investments grow. The money itself, it's just a byproduct.
And if you need any more proof, this next quote says it all. He loves what he does so much that he feels like he should be paying them for the privilege of doing it. And what's wild is that, in a way, he kind of does.
So what does he get paid? Get this, $100,000 a year. That's his official salary to run one of the biggest, most successful companies on the entire planet. For a billionaire, that's not even a rounding error. But just wait till you see what he could be making.
Now look at this number. Just let that sink in for a second. If Berkshire Hathaway was just a regular fund that charged a standard 1% management fee, he'd be bringing home over $750 million every year. The difference between what he takes and what he could take is just mind-blowing. And it proves, without a shadow of a doubt, he is not in this for the money. Okay, so now let's completely switch gears and talk about George Soros. If Buffett sees investing as this super fun game, Soros sees it as something totally different. A laboratory, a place to test his deepest ideas about how the world actually works. Talk about a complete 180 from tap dancing to work, right? Soros basically says the exact opposite of Buffett. For him, investing is not about fun. It's this serious, tough, intellectually demanding, and often boring process. The joy for him doesn't come from doing it, but from what doing it allows him to prove.
You see, for Soros, money was never the goal. It was just the raw material. It was the clay. A sculptor isn't interested in just hoarding a bunch of clay. They're interested in what they can build with it. The financial markets, they were simply his lab, a place where he could shape and test his really complex theories about society and economics.
And that's where you find his real toward motivation, his true north. His ultimate goal was never to be the richest guy in the room. It was to be recognized as a great philosopher. He used his incredible success in the markets as proof that his ideas were valid in the real world, hoping it would earn him a spot next to the great thinkers he admired. His wealth was just a tool to get people to take his ideas seriously.
All right, so let's pull these two incredible stories together. You've got two totally different guys with two completely different approaches, and yet they both reach the same unbelievable level of success. And the thing they have in common is pretty fascinating.
This chart just makes it crystal clear, doesn't it? For Buffett, the driver is the pure fun of the game, and money's just the scorecard. For Soros, the driver is testing his philosophical ideas, and money's just the clay he uses to build them. Two wildly different paths, but for both of them, money's just a means to an end. It was never the end itself. And that's really the big light bulb moment here. Their legendary fortunes weren't the result of them chasing money. Their wealth was the byproduct, the unintended, absolutely massive consequence of just relentlessly pursuing a deep internal passion. One was chasing fun, the other was chasing ideas, and they both ended up as two of the richest people in history.
So it all kind of boils down to this final question for you, for me, for all of us.
Buffett found a game he loved so much he'd literally pay to play it. Soros found an intellectual puzzle that captivated him more than anything else. So, what about you? What's the game that you're so passionate about? The thing that gives you so much fulfillment that you would do it even if money was completely off the table? Finding the answer to that, well, that might just be the real secret to success.
So, what is it that really separates the absolute masters in any field from, well, everyone else? It's not just about raw talent, and it's definitely not just luck. It's a specific mindset, this core winning habit that completely redefines what success even means. Today, we're going to unpack that very habit, a way of thinking that applies way beyond investing to pretty much any craft you want to master. Okay, so here's our game plan. First, we're going to pin down exactly what this winning habit is. Then, we'll dive into what it really means to embrace the art of the process. We'll make it super tangible with a great sports analogy in keeping your eye on the ball, and then we'll see it in action with some lessons from the masters. And finally, we'll look at the day-to-day reality in the never-ending hunt. All right, let's jump right into our first section, the winning habit. This is where we're going to explore that foundational mindset that separates the best from the rest. We have to start with this quote from Warren Buffett, because honestly, it frames this entire discussion perfectly. I have enjoyed the process far more than the proceeds. This one idea, it's the key to everything. For the true masters, it's not about the prize at the end of the road, it's about the absolute love of playing the game itself. And this really gets to the heart of it. A master investor gets their satisfaction from the process, the analysis, the strategy, the execution. But a losing investor, they fall in love with their assets. And that is a crucial, crucial distinction, because the master loves the game, not the pieces on the board. They can walk away from any single investment. Their real fulfillment comes from the craft. And get this mindset isn't something that just shows up late in a career. It's there from the start. Think about it. Way back in 1956, one of Buffett's very first outside investors, a physics professor named Homer Dodge, drove halfway across the country just to hand this young guy his money. And why? Because Dodge saw something more than just a numbers whiz. He saw a uniquely talented craftsman who loved the process of investing. It was obvious from day one. Okay, so we know we need to love the process, but what does that actually look like? To really get it, let's try to reframe this whole thing and think about it as an art form. The master of any art, doesn't matter if it's a painter, a writer, or an investor, of course they have a vision for the final product, but their deep focus, their total absorption, is in the doing. They are completely consumed by their craft, by the feeling of the brush on the canvas, by the puzzle of forming a perfect sentence, by the deep dive into analyzing a business. This mental state actually has a name you might have heard of. It's called flow. It's a concept from the psychologist Mihaly Csikszentmihalyi. And it's that incredible zone you get into where you're so completely absorbed in what you're doing that everything else just melts away. Your sense of self, time, all the distractions, gone. Hours can feel like minutes. This is the state where true mastery is forged. And this just nails the idea. As John Treen wrote, succeeding in the process itself fascinates the greatest investors. It's like a chess grandmaster. They are driven to master the game itself. Becoming incredibly rich? That's just a side effect, a nice little bonus to the real reward, which is mastering the craft. Okay, I know this idea of flow can feel a little abstract, so let's bring it right down to earth with a high-stakes analogy we can all understand from the world of sports. This section is all about what it really means to keep your eye on the ball. Now, I want you to be honest with yourself for a second. Picture yourself in a really high-pressure situation. A big game, a crucial presentation, any moment where it all comes down to how you perform. Where is your mental focus? Let's use a tennis match to really break this down. Look at these two mindsets. If you're down in the final set and your focus is on winning the match, every single point you lose feels like you're falling deeper into a hole. You look defeated. But what if you shift your focus to just hitting the ball, the immediate process? Something amazing happens. The score doesn't seem to matter anymore. You're not winning or losing, you're just playing. Now, who do you think has a better chance of making a comeback? So we have the theory, we have the analogy. Now, let's look at the real-world proof. We're going to see how two of the greatest investors of all time, George Soros and Warren Buffett, are the living embodiment of this exact principle. First up, George Soros. He famously said, "That's really how I make my money, understanding the revolutionary process in financial markets." See, he doesn't see markets as neat and tidy.
he sees them as being in a constant state of chaos. For him, investing is this never-ending process of coming up with ideas and testing them to try and profit from that chaos. He's totally fascinated by the process of figuring it all out. And what was the result of this process-driven mind? Well, in 1992, the year of his legendary bet against the British pound, his quantum fund returned a staggering 68.6%. I mean, that is just an astronomical number. But here's the crucial part that almost everyone misses. They focus on that one spectacular outcome, that one home run. But if you take that single famous trade completely out of the equation, his fund would still have been up 40% that year. His incredible success didn't come from one lucky shot. It came from the consistent mastery of his overall process, day in and day out. All right, now let's turn to Warren Buffett. He basically reveals his entire philosophy in the very first question he asks himself when he's thinking about buying a business. He asks, do they love the money or do they love the business? He's trying to figure out if the owners are outcome-driven, just focused on the big payday, or if they're process-driven, truly passionate about the craft of running their company. Because like he says, if they only love the money, they're gone the day after he buys it. He wants partners who love the business itself. And that brings us to our final section, where we get down to the brass tacks. What does this process of investing actually look like, day to day? Let's explore the reality of what we're calling the never-ending hunt. You know, when most people imagine investing, their minds jump straight to steps 3 and 5, buying and selling, the thrill of the trade, right? But the true craft of investing is this entire cycle. Buying and selling, that takes just a moment. The real work, the real art, is in everything else. So where does the master investor find their flow? It's not in that fleeting moment of a transaction. Nope, they find real satisfaction in the parts that are literally never ending. The constant, relentless search for new opportunities and the meticulous monitoring of the ones they already own. For them, the joy is the hunt. And this isn't just some theory. It's exactly how they live. Just listen to Warren Buffett describe his typical day. He says, I tap dance into work, and then I sit down and I read. He spends his days reading and talking on the phone. He's not obsessively staring at a stock ticker. He is a craftsman who genuinely loves the daily process of searching, learning, and monitoring. That is his craft. So the single most important point we've built up to is that true masters are defined by their deep, genuine love for the process itself. And that brings us to one final big question for you to take away. Look at your own career, your own craft, your passion. In your life, are you focused on the process or the proceeds?
So what's the one thing that really separates the absolute giants of the investing world from, well, everyone else? You know, it's not some secret stock tip or a magic formula. Turns out, it's a habit. It's a mindset so total, so all-consuming, that it completely blurs the line between work and life. Let's dive in.
Okay, so get this. Imagine you're at a dinner party, and Warren Buffett is one of your guests. You just got back from this amazing, once-in-a-lifetime trip to Egypt, and you're all excited to show off your photos of the pyramids. But right as you're setting things up, Buffett says this. He tells you he'd literally rather go into your bedroom and read a financial report than watch your vacation slideshow. Now, for most of us, that would sound kind of rude, right? But you have to understand, for Buffett, this wasn't work. One of his colleagues once said that he just has a hobby that happens to make up a ton of money. Reading that annual report was his version of kicking back and relaxing. It's what he genuinely loves to do. And that passion, well, that's the whole key.
And that little story? It's the perfect setup for the core idea we're digging into today. This isn't just some funny quirk of Warren Buffett's. Nope, it's a fundamental trait that you see in pretty much all of the world's most successful investors. We're calling it winning habit number 22.
So what is it exactly? Here you go. Winning habit number 22 is the live and breathe investing 24 hours a day. And look, that's not an exaggeration. It's a description of a total, complete immersion that really is the fundamental difference between those who achieve legendary success and, well, everybody else.
So let's just break that down a bit. On one side, you've got the master investor. For them, this isn't a 9-to-5 gig. It's a 24/7 obsession. It's what they're thinking about morning, noon, and night. And then on the other side, you have the losing investor. Now, they might know what their goals are, but that all-in, total, unwavering commitment, it's just not there. It's really the difference between having a career and having a calling.
But here's where it gets really interesting. This 24/7 dedication,
it doesn't always look the same from the outside. This all-consuming obsession can actually show up in two very different, almost opposite ways. So let's explore these two very different paths that lead to the same destination.
So on one path, you have the relaxed investor type, like Buffett. For him, investing is just a joyful hobby. The only real stress is having too many great ideas and not enough money to invest in all of them. But then you have the other path, the intense trader, like a George Soros or a Michael Marcus. For them, it is a grueling, non-stop battle against the market, full of exhaustion, sacrifice, and sleepless nights.
This is a classic Buffett line from back in 1974, a time when the market was super cheap. I mean, this quote just perfectly captures his version of pressure. It's not stress. It's this incredible excitement of being surrounded by just endless, amazing opportunities. It's pressure from abundance, not anxiety. And now, get ready for some serious whiplash. This is trader Michael Marcus talking about his time in the 24-hour currency markets. No harems here, just pure exhaustion, constant pressure, and a huge personal cost. The contrast with Buffett could not be more dramatic. This is the other face of total dedication. And this is what that kind of intensity actually looks like. The most dedicated traders, they can never really unplug. Can you imagine needing to see the live market prices while you're taking a shower or brushing your teeth? That is the absolute definition of an all-consuming obsession. George Soros is the perfect example of this lifelong intensity. In 1957, he'd only been in New York for 3 months, hadn't seen his parents in 10 years, and he was too busy working to even go meet them at the airport. You fast forward almost 30 years to 1985, and he's spending a Sunday night at home on the phone making these massive trades because of a tip he got. This wasn't just a phase for him, it's just who he is.
And look, this obsessive drive isn't just a Buffett and Soros thing. It is a theme you hear again and again and again from the very best in the business. It's like a chorus of commitment. Let's listen in.
First up, Ed Sykota. He just puts it so plainly. I am not a casual trader. It is my life. For him, there's no question. He feels like he was born to do this.
Or how about Renee Rifkin, who said, I hate weekends because there is no stock market. For him, the market wasn't work. It was the most exciting game on the planet.
Then there's Richard Driehaus, who compares it to being a top musician or an Olympic athlete. He says it requires an addiction and a huge amount of time and practice. He reminds us all that success is 99% perspiration.
Laura J. Sloat shows us how that passion just completely erases the boundaries. I love what I do, so I do it 7 days a week. It's that simple. When you truly love something, the line between work and play just vanishes.
And this one is just fantastic. You've got the legendary Peter Lynch on vacation in Ireland, doing the whole tourist thing, kissing the Blarney Stone, and even in that exact moment, he's still thinking about the stock market. It's just a brilliant illustration of how, for these masters, their mind is always on the game.
And that story about Peter Lynch, it wasn't just a one-off thing. He was known as a fanatic worker. Whether it was him or Soros or Buffett, you see the exact same pattern. From the moment they wake up to the moment they finally fall asleep, their mind is on the market. This chorus of voices makes one thing crystal clear. This level of dedication is the common denominator of greatness.
Okay, so we've heard from all these legends who live and breathe this stuff 24/7. It's intense, it's maybe a little intimidating, and it definitely raises a pretty big question. What does all this extreme dedication actually mean for the rest of us? For you? This is probably the question bouncing around in your head right now, right? I mean, do you really have to install a quote machine in your bathroom or skip out on seeing your family just to achieve your financial goals? And the answer is no. You don't have to adopt their extreme lifestyle. But, and this is so important, if you want to achieve exceptional results in any field, you absolutely must emulate their spirit. You have to find that same relentless dedication to mastering your craft. And you know, this whole idea, it's so much bigger than just investing. This really powerful thought from Woodrow Wilson reminds us that persistence just beats everything else. The world is absolutely full of talented failures and educated derelicts. What truly separates the successful is their unstoppable determination to just keep going. And if that last quote was the whole explanation, this one is the mantra. Just 2 simple words from the ancient Icahn that capture the entire lesson. It's a short, sharp, powerful truth to carry with you. Perseverance furthers. So,
we'll leave you with this final thought. This isn't really about whether you want to be the next Warren Buffett or not. The real question, the one to really think about, is what in your own life, your career, a skill you're learning, a personal goal, what are you willing to be truly, deeply, and relentlessly persistent about? Because as we've just seen, that's where the real magic happens.
So what is it that really separates a legendary investor from, well, everybody else? It's not just about picking winning stocks. It turns out there's a simple, incredibly powerful philosophy they all live by. Today, we are diving deep into that core principle: eating your own cooking.
Here's the game plan. First, we're going to break down what eat your own cooking actually means. Then we'll get a peek inside the playbook of masters like Buffett and Soros. After that, we'll compare their approach to what our source material calls the investment guru. We'll see how this is all about a bigger idea called skin in the game. And finally, we're going to turn the mirror on you. All right, let's jump right into section 1. Eat your own cooking, a billionaire's motto. This is really a fundamental idea about wealth, confidence, and just pure conviction. This quote from George Soros, it just perfectly sets the stage. Think about what he's saying. He's not some detached manager just playing with other people's money. His own fortune is right there on the line, riding the exact same waves as his investors. It completely reframes investing from just a job into something deeply, deeply personal. The stakes are real because his stakes are real. And of course, here it is, the most famous version of this idea from the one and only Warren Buffett. Around here, we eat our own cooking. Now, it sounds like simple, down-to-earth wisdom, right? But it's actually this profound statement about alignment. It means his financial destiny is literally tied to the performance of his company, Berkshire Hathaway. He wins when his shareholders win. He loses when they lose. There is zero separation. So let's move on to section 2, the Master Investor's Playbook, putting your money where your mouth is. Let's look at what this whole principle actually looks like when the rubber meets the road. Take a look at this number, 99%. Let that sink in for a second. An absolutely incredible 99% of Warren Buffett's personal net worth is invested directly in Berkshire Hathaway stock. This isn't just, a vote of confidence. This is the ultimate commitment. His vast fortune isn't spread out all over the place in other people's companies. It comes from his own. Now hold that 99% in your head and look at this, $100,000. That's Buffett's yearly salary. It is the lowest of any CEO of a Fortune 500 company. It's barely more than what a brand new MBA grad might pull in. So here's the kicker. His salary isn't what makes him rich. It's the success of his investments, period. So you have to be asking, how does he manage? This just brilliantly lays out his mindset. Berkshire doesn't pay a dividend, so that $100K salary, that's it. That's all he takes out. If he needs more cash, he does what he does best. He invests in his personal account, often on opportunities that are way too small for a giant like Berkshire. He literally lives and breathes the life of an investor because he has to. His entire lifestyle depends on his investing skill, not some big, fat, guaranteed paycheck. And listen, this isn't just a Buffett thing. Before he started his massive philanthropic efforts, George Soros personally owned a staggering 40% of his own quantum fund. See the pattern? It's the same thing. The manager's personal wealth is completely intertwined with the fund's performance. It guarantees their interests are 100% identical to their clients. Okay, section 3. We've seen the ideal, so now let's explore the total opposite, the guru's fortune-telling, the critical difference. This slide from our source really draws a clear line in the sand. On one side, you have the master investor. Their own wealth is on the line. But on the other side, you've got the losing investor, who's funding their life and even covering their losses from other places. A salary, business profits, bonus plans. Their own money isn't truly at risk in the same way at all. Let's really break this down. The master investor is an investor. The guru, on the other hand, is what the source calls a fortune seller. Their business is selling opinions, maybe through newsletters, TV shows, or advisory services. The destiny of the master investor's wealth is completely identical to that of the people who trust them. But for the guru, well, what they do might be totally disconnected from the advice they're selling you. And it all really boils down to this classic and kind of troubling phrase, doesn't it? Do what I say, not what I do. I mean, if an advisor isn't following their own advice with their own money, why on earth should you? Their main goal might just be to sell you a good story, not to actually make you money. because their own financial well-being just doesn't depend on it. So in Section 4, let's zoom out to the bigger idea here: skin in the game, a universal principle of confidence, because this applies to so much more than just Wall Street. All right, here's a nice clean definition just to lock this concept in for good. Eat your own cooking is the principle that successful people have the vast majority of their personal wealth invested in their own main thing, their business or their investment strategy. It's really the ultimate expression of confidence in what you're building. And like I said, this is not just an investor thing. Not at all. Think about the great entrepreneurs. Bill Gates with Microsoft, Michael Dell with Dell Computer, Rupert Murdoch with News Corp. And it goes all the way down to the millions of small business owners all across the world. Their fortunes are directly tied to the success of their own companies. So why do they do this? The reason is twofold, and it's actually beautiful in its simplicity. First, it's expertise. They invest where they know they can make the most money, inside their circle of competence. And second, it's passion. It is simply what they love to do. And that combination, that is an unbelievably powerful engine for creating wealth. And that brings us right to our final section. What's your answer? Turning the mirror on yourself. Now, this is really the key takeaway from this whole thing. Before we get to that final question, just consider this statement for a moment. Your answer is the single best measure of your own confidence in your financial plan, your career, or your business. It just cuts through all the noise and shows what you truly believe. So, here it is, the big one. How much of your own net worth is backing your own investment strategy? Are you eating your own cooking? It's a tough question, for sure, but your answer reveals more about your real conviction than anything else possibly could. It is the ultimate test of skin in the game. So, what's your answer?
You ever look at the absolute titans of investing, people like Warren Buffett or George Soros, and just think to yourself, I could never do that. You've got to be some kind of genius. Well, it's a super common thought, and today we're going to dig in and really see if it's true.
So what does it really take? I mean, is it some kind of God-given, untouchable intelligence that you're just born with or you're not? Or could it be something else entirely? Something more about the habits you build over time? Let's find out.
Now, at first glance, the evidence for this whole genius theory seems pretty overwhelming. I mean, you've got a Nobel laureate, Paul Samuelson, calling Warren Buffett as near to a genius at investing as I have observed. Wow, that is about as heavy an endorsement as you can possibly get.
And hey, it's not just Buffett. People said the same thing about George Soros. His old partner, Alan Raphael, he put it really simply. It was just plain good for you to talk to Soros about an investment because, well, he was just that smart. He gave you an edge.
And just to really hammer this point home, another one of his business partners, Rich Santulli, says Buffett is the smartest person he has ever met, by a long shot. So, okay, case closed, right? You have to be a certified genius to win at this game. Well, not so fast.
Let's actually look at what's behind these claims, because these aren't just empty compliments. We'll start with what we're calling the hallmarks of genius, and explore why these guys are seen as true pioneers of profit.
See, they're considered geniuses because they were legitimate pioneers. They didn't just play by the existing rules of investing, they actually went out and created entirely new ways of doing things, and then applied them with just incredible success. You know, the source material compares them to inventors like Thomas Edison or Alexander Graham Bell, and that really puts into perspective the level of innovation we're talking about here.
Man, that all sets an incredibly high bar. It just feels like an impossible standard, doesn't it? So let's bring it back to us. For the average person, must you actually be a genius to succeed in this field?
The source material frames this question perfectly. You know, if this whole explainer is about uncovering the winning habits of investors, should we just add one more to the list? Habit number 24, be a genius. Yeah, that sounds pretty discouraging to say the least.
But here's where we get to the heart of the counter-argument. This next part introduces a really crucial distinction: the massive difference between inventing something and just using it.
Think about it this way. Thomas Edison, yeah, he had to be a genius to invent the light bulb, no doubt about it. But do you or I need to be a genius to walk into a room and flip a switch? Of course not. For us, all the hard work, the invention part, that's already been done. And this right here is the key insight for us as investors. The geniuses, the pioneers like Buffett and Soros, they've already blazed the trail. They've laid out the roadmap, the mental habits, the successful strategies. Our job isn't to reinvent the light bulb, it's to learn how to use it. And who better to bust this myth than the supposed genius himself? Warren Buffett is crystal clear about this. He says investing is not a game where the person with a 160 IQ automatically crushes the person with a 130 IQ. It's just not about raw brain power. It's about something else entirely. Okay, now get ready for probably the most surprising part of this whole story. This next section reveals something our two pioneers have in common that you would absolutely never expect. A standardized test that both of them, in their own way, failed to pass.
Get this, neither Warren Buffett nor George Soros has passed the standard securities industry exams that are required for most people who work on Wall Street. Just let that sink in for a second. The two greatest investors of our time couldn't or wouldn't get this basic qualification. So let's start with Buffett's story. Okay, picture this. It's 1991. He becomes the interim CEO of Salomon Brothers. Now, because of that new role, the regulations said he had to take the Series 7 stockbroker exam. Just a simple requirement for the new boss, right?
But listen to what he says himself. He admits he kept putting off the exam until he left the job because, and this is a direct quote, he wasn't sure I could pass it. Can you believe that? The Oracle of Omaha was worried about failing a multiple-choice test that thousands of entry-level brokers take every single year.
As incredible as Buffett's story is, the one about George Soros is maybe even more shocking. See, he didn't just worry about failing. Earlier in his career, he actually sat down and took a similar professional exam. And, well, according to the source material, he failed it miserably.
And his logic afterwards is just fantastic. He basically told his assistant to go take and pass the exam for him instead. He figured that in a few years he'd either be so successful that he wouldn't need the certificate, or he'd be such a failure that he also wouldn't need it. I mean, it just shows a completely different way of thinking, one that's focused purely on real-world results, not credentials. And this brings us to a really powerful question, doesn't it? If the two undisputed champions of the investing world either fail these professional exams or are literally afraid to take them, what does that say about the true value of those qualifications when it comes to achieving ultimate success?
So, if being a genius isn't the requirement and passing exams isn't the key, then what is? Well, in our final section, The Habits of Success, we're going to see that it all comes down to one thing: separating the signal from the noise.
Yeah, it's all about separating signal from noise. It's so easy to look at the superficial stuff, the noise. You know, both men live in the US, they both wear glasses, and fun fact from the source material, they were both married to women named Susan. But come on, none of that matters. The crucial similarity, the signal, is in their pioneering methods and their key mental habits. We're talking about things like temperament, patience, and a crazy dedication to lifelong learning. That's the real secret sauce.
So the path forward, then, isn't to try and become a genius. It's actually something much more practical and, honestly, achievable. It's a two-step process. First, follow their mental habits. And second, adopt the strategies that actually grew out of those habits.
And so that leaves us with a final, really important question. We've pretty much established what doesn't matter, we've busted the myth of genius, and we've seriously questioned the value of standardized exams. The real work starts now, figuring out and mastering these specific mental habits that actually do lead to success.
So, you want to know the secret to becoming a billionaire investor? Well, here's the thing. There isn't just one. Today, we're diving into the stories of two absolute legends who prove it. Both started with basically nothing and clawed their way to the very top of Wall Street. One was the raider, a predator who made corporate America tremble. The other? He was the hunter, a patient searcher of bargains all over the world. Their strategies were night and day, but their results were astonishingly similar. Let's get into how they pulled it off.
And right there, that quote, that tells you pretty much everything you need to know about our first guy, Carl Icahn. You see, he wasn't playing the game to make friends. He was there to win, period. And he built a whole empire on that one single-minded idea.
So here's how we're going to break this down. First, we'll get into the weeds of Carl Icahn's aggressive playbook, the Raider. Then, we'll do a complete 180 and look at the quiet genius of John Templeton, the Hunter. After that, we're going to uncover the really surprising habits that linked these two opposites. And finally, we'll pull out the big lessons you can take from their incredible careers.
And this really gets us to the heart of the puzzle, right? On one hand, you've got this relentless, in-your-face aggression, and on the other, you have this deep, almost spiritual patience. We're talking about two totally different paths that somehow led to the exact same mountaintop. How does that even happen? Well, let's find out.
And this is what makes their stories just so compelling.
We are not talking about old money here, not even close. Both Icahn and Templeton were 100% self-made. They built these massive empires literally from scratch. And that fact just makes the huge difference in their methods even more fascinating to look at. All right, first up, Carl Icahn. This is the man whose name alone was enough to send a shiver down the spine of corporate boardrooms all across America. He basically became the poster child for shareholder activism and the hostile takeover.
You know, Icahn's entire philosophy was basically born from an absolute disaster. Back in 1962, a market crash didn't just sting him, it completely wiped him out. He lost everything. He had to sell his car just to eat. And that pain, well, it burned a lesson into his brain that he would never ever forget. Following the herd gets you slaughtered. He swore he would never do it again. Instead, he would become a hunter, looking for the market's hidden flaws and exploiting them for everything they were worth.
So, what exactly is a corporate raider? Just think of it as the complete opposite of being a passive, quiet investor. A raider, like Icahn, doesn't just buy some shares and hope for the best. No, he buys a massive chunk of the company so he can force his way into the room, get a seat at the table, and start shaking things up to unlock all the value that the lazy management is just leaving on the floor.
Now, Icahn didn't just go around picking fights for fun. He was a predator with a very specific checklist. He was on the hunt for two things. First, companies that were kind of drifting, with no single person or family in control. And second, companies where the stock price was way, way lower than its breakup value. And all that means is, if you sold off all the company's assets, the factories, the patents, the trucks, the pile of cash from the pieces would be worth a lot more than the whole company's stock price. He saw free money just sitting there, waiting for someone to come and take it.
And this was his move, his four-step attack that he played like a master poker player. Step 1, he'd quietly buy up shares, not making a sound. Step 2, he'd play nice, acting like a friendly investor, lulling the board into thinking he was on their side. Step 3 was the tell, the moment he'd show his hand, demanding a seat on the board. And if they still didn't listen, Step 4 was the all-in move, a proxy battle. That's where he'd go right over the CEO's head and appeal directly to the other shareholders, convincing them to vote the old management out.
And believe me, this was not him just making it up as he went along. It was a complete, repeatable system he called the Icahn measures. This framework covered every single step of the attack. Exactly what kind of company to buy, the price he was willing to pay, how to systematically turn up the heat, and, this is crucial, his precise exit strategy. He never ever walked into a fight without knowing exactly how he was going to win it and walk away. And the result of that very first big test on the Tappan Stove Company? A cool $2.7 million profit in less than a year. His system worked. And that was just the warm-up act. That victory launched a legendary career of corporate raids that would make him a billionaire many times over.
Okay, now let's take a deep breath. We're going to leave the loud, brutal battlefield of corporate takeovers and travel to a completely different investment world. We're shifting gears from the raider to the hunter, the quiet, deeply patient, globe-trotting bargain seeker, Sir John Templeton.
This quote right here is the master key to understanding how Templeton's mind worked. While every other investor saw a stock market crash and ran for the hills, Templeton saw a once-in-a-lifetime sale and ran towards it. For him, widespread fear and panic wasn't a warning sign. It was a giant blinking buy signal. It was the moment of maximum opportunity.
Templeton built its entire legendary career on this one simple, powerful idea. You buy when things look the absolute worst, at the point of maximum pessimism. He would literally search the globe for situations where the news was terrifying, where blood was in the streets, and everyone else was selling in a blind panic. Because he knew that's when you could buy quality companies for pennies on the dollar. And he didn't just talk the talk, he walked the walk with unbelievable courage. I mean, get this. It's 1939. The Great Depression is still devastating families, and Hitler is marching into Poland. The world is on the brink of total war. At this moment of pure terror, what does Templeton do? He borrows $10,000 and buys shares in 104 different companies that were considered worthless, trading for less than $1. People thought he was absolutely insane, but just 4 years later, he'd quadrupled his money. The results over the long haul were just mind-blowing. For almost 40 years, his Templeton Growth Fund returned an average of 15.5% a year. The rest of the market? A measly 5.8%. He didn't just beat the market, he absolutely crushed it year after year after year. That is the incredible power of being patient and betting against the crowd. And his strategy wasn't some old-fashioned relic.
Fast forward to the year 2000, the height of the dot-com bubble. At 87 years old, Templeton saw the opposite of pessimism. He saw maximum irrational optimism, another inefficiency. He founded Trigger, something called insider lockups, which is the time when company founders aren't allowed to sell their stock. He bet against or shorted 84 of these tech stocks, predicting that the second those lockups ended, the insiders would stampede for the exits to cash in. And he was dead right. The stocks collapsed, and he walked away with an $86 million profit. Genius.
Okay, so we've got the raider and the hunter, aggression versus patience, forcing the action versus waiting for the action. On the surface, you couldn't find two investors who were more different. But if you start to peel back the layers, you find something amazing. You find out they were secretly operating from the exact same mental playbook.
I mean, the contrast in what they actually did day to day is just so stark. On one side, you have Icahn's toolbox, proxy fights, high-stakes negotiations, and brute force, all meant to create value right now. And on the other side, Templeton's toolbox, quiet analysis, a passport, and endless patience, all designed to just wait for value to show up on its own. Their actions, total polar opposites.
But their mindset, how they thought about the world, was identical. They both believed, deep down, that markets are emotional and often wrong, which is what creates bargains in the first place. They both had a disciplined system that they followed with almost religious faith. They both demanded a margin of safety, which just means they would only buy something if it was on a massive sale compared to its real worth. And maybe, most important of all, they both had the guts to completely ignore the crowd and think for themselves.
So, after breaking down these two incredible opposing legends, what's the big takeaway? What are the lessons from the raider and the hunter that we can actually use?
Look, if there is one single thing to learn from all this, it's this. There is no magic formula. Their success wasn't about some secret they discovered. It was about building a strict, rigorous system that was a perfect mirror of their own personality. Icahn was an aggressive, poker-playing fighter, so he built a raider system. Templeton was a calm, patient philosopher, so he built a hunter system. The real lesson here is not which system to copy, but to build one that fits you, and then have the discipline to stick with it through thick and thin.
And really, it just boils down to this. Icahn's big idea was find something undervalued and then use a crowbar to force the value out. Templeton's big idea was find something undervalued and then patiently wait with a key for the world to come to its senses. One used a crowbar, the other used a key. Two totally different tools, but they both unlocked the exact same treasure chest.
Which leaves us all with one final and really important question. Both Icahn and Templeton became who they were by seeing the cracks in the system that everyone else was blind to, from complacent CEOs to waves of irrational panic. So we have to ask ourselves, what are the biggest market screw-ups of our time? Where are the hidden bargains today? And will the next legend who finds them be a raider or a hunter?
All right, let's talk about something really important for anyone who's investing their money. We're going to dig into a huge question. Are you just practicing investing, or are you actually getting better at it? You know, the answer to that, it changes everything. So let's jump right in.
You know, this whole idea really clicks when you hear this one story. So there's this investment expert, right? And he's taking a tennis lesson. His coach, out of the blue, points to the court right next to them and asks him this simple question. And believe me, the answer is, well, it's pretty eye-opening.
So he looks over and guesses, I don't know, maybe a few years? But the coach just shakes his head and says, try 15 to 20 years. Can you believe that? That's the crazy part. These folks have been out on the court for decades, but they were still making the exact same mistakes as a total beginner. Why? Because they never actually learned the right way to play. They were just practicing bad habits over and over. The coach even said a new player who'd had just a few lessons on proper technique could probably wipe the floor with them.
And that right there, that's the whole point. Investing is exactly the same. You can spend years, literally decades, buying and selling, moving your money around, and not get any better at it. You just keep making the same mistakes. But if you actually learn the techniques, the habits of the greats, the Warren Buffetts, the George Soroses, your results are going to get better. It's almost inevitable.
So that's our first big idea here. The huge difference between just practicing something and actually improving at it. It really is like swinging a tennis racket for 20 years versus learning how to hit a perfect serve on purpose.
Okay, so that's the million-dollar question, right? How do you stop just going through the motions and start getting better?
How do you make sure all that time you're spending in the market actually leads to real skill and, better profits, instead of just making the same dumb mistakes over and over? Well, the answer starts with taking a good, long, honest look in the mirror.
And that leads us right to the very first step you have to take if you want to improve. You've got to take inventory. It's simple, really. You can't figure out how to get to your destination if you don't even know where you are on the map right now.
I mean, think about it. What's the very first thing a good coach does? Whether it's tennis, golf, whatever. They just watch you. They look at your swing, they figure out what you're doing right and what you're doing wrong. We have to do that for ourselves. We need to become our own investment coach and look at our history to figure out, okay, what are my good habits and what are my really bad ones?
And if you want to see just how important this is, let me tell you about a guy named Jeff. His financial advisor did a deep dive on his entire investment history and came back with this absolutely brutal conclusion. Jeff would have been $5 million richer if he just left his money in his savings account and never invested a single dime. Just let that sink in for a second. He lost so much money that doing nothing at all would have been the best move he could have made. Yeah, negative $5 million. That says it all, doesn't it? And this wasn't just, one bad trade or a bad year. This was a pattern, a whole history of destructive habits that just kept repeating because he never ever stopped to look at what he was actually doing. That right there is the real cost of just practicing without ever getting better. But here's where it gets really interesting. When Jeff finally sat down and analyzed everything, the patterns were crystal clear. It turned out he consistently made a ton of money whenever he invested in real estate, using his own research and buying what he called screaming bargains. And where did he lose money? Consistently. Every single time he followed a tip from someone else, especially with stocks, or when he invested with a partner. The answers were right there in his own history the whole time. He just never looked. And that brings us to what might be the single most powerful thing you can do for your own investing. It's a really simple but incredibly powerful exercise. It's called the winners versus losers exercise.
Okay, so how does it work? It's super simple. Step 1, you take every single investment you have ever made, and you physically or digitally sort them into 2 piles. One for the winners, the ones that made you money, and one for the losers, the ones that lost you money. Then, for step 2, you just look at each pile. You're looking for what your winning trades have in common, what your losing trades have in common, and maybe most importantly, what's different between the two.
Now, to really get something out of this, you have to ask yourself some tough questions for every single one of those investments. I'm talking winner or loser. You got to ask, why did I get into this? Was it my own idea, my own research, or was I just following a hot tip? How did I feel when I bought it? Was I confident or was I nervous and full of doubt? Did I even have a plan for when to sell before I bought it? And look, you have to be brutally 100% honest with yourself here. No excuses.
When you do this, when you actually go through this whole process, it does something amazing. It gets rid of all the guesswork. You stop having these vague feelings about how you're doing, and you get a real, data-driven picture of who you are as an investor. You'll see it right there in black and white. This is what works for me, and this is what absolutely does not.
But it's not always just about habits and actions. As Jeff's story showed us, sometimes the root of the problem goes even deeper. We have to start looking at what we truly believe about ourselves and our money.
And this was the belief at Jeff's core. He told his advisor, I'm a loser. And even losers get lucky sometimes. Think about that. Even when he was shown clear evidence of his own success, those amazing real estate deals, he just couldn't accept it. He had so completely bought into this identity of being a loser that he just chalked up his actual wins to blind luck. A belief like that, it'll wreck any strategy, no matter how good it is.
Here's the thing, though. We often think our beliefs are set in stone, but they're not at all. I mean, think back. When you were 5, you probably believed in Santa Claus, right? At 10, maybe the Tooth Fairy. Do you believe in them today? Probably not. Your beliefs change. And the same is true for those more complicated beliefs we have about ourselves, about money, about success. They can change too. Just look at the difference here. On one side, you have Jeff's belief, I'm a loser. It's totally self-defeating. And on the other side, you have the kind of beliefs that drive the greatest investors in the world. They believe things like, I deserve to succeed, and, this one is huge, I am in control of my own destiny. Now that's not being arrogant. That's a fundamental mindset you need to have to win.
And here's the really good news. You don't have to spend years on a therapist's couch to fix this. For most people, the best way to change a negative belief is actually to change your experiences. When you start consistently using winning habits,
You start creating new evidence. You're proving to yourself with real results that you can succeed. And that new evidence, it slowly starts to rewrite that negative story you've been telling yourself. So, this all leads to the ultimate goal of this whole process. And it's not what you might think. It's not just about fixing what's broken. It's about finding what's already working, discovering your unique strengths, and really dialing in on your personal winning zone.
And that's a really big shift in how to think about this, right? The winners versus losers exercise isn't there to beat you up about your mistakes. The whole point is to put a giant spotlight on the things you're already good at so you can do more of that and do it with way more confidence.
And this is the big concept we're building towards. It's called your circle of competence. What is that? It's that specific area. Maybe it's a certain industry, maybe it's a type of stock, maybe it's a particular strategy where you are a consistent winner. It's the area where you're not just hoping for the best. You actually truly know what you are doing.
So let's circle back to Jeff one last time. Turns out he wasn't a loser at all, was he? He had a very well-defined circle of competence. It was real estate. But there was that one crucial rule. It only worked when he trusted his own judgment. So the real work for him wasn't to stop investing. It was to figure out how he was thinking during those winning real estate deals and learn how to apply that same mindset to other investments.
And that leaves us with the single most important question, the one this has all been leading up to. After you do the work, after you take that inventory and analyze your wins and your losses, what is your circle of competence? Because finding the answer to that question, well, that's the foundation for everything that comes next.
All right, welcome everyone. Today, we're not just going to talk about investing, we're going to build something from the ground up. We're talking about your personal investment blueprint. We're moving past all the noise, all the hot stock tips, to construct the solid foundation that every single great investment strategy is built on. So let me ask you something right off the bat. Are your investments built on dreams or are they built on goals? Now, this isn't just a word game. This is often the actual dividing line between success and failure. It's about shifting from just wishful thinking to a deliberate, really powerful strategy. Okay, so this is the game plan, our blueprint. We're going to walk through 5 essential steps, starting with why you're even doing this, all the way to finding a mentor who can really accelerate your learning. So let's start laying that foundation. The very first piece of our blueprint is, without a doubt, the most important one, your why. You know, before a master investor even thinks about what to buy, they have this unshakable understanding of why they're investing in the first place. It all starts by clarifying your ultimate purpose. So you gotta ask yourself, what is your purpose? Is it all about creating that bedrock of security for retirement? Or maybe you're chasing total financial independence, like Charlie Munger wanted. Perhaps it's about securing a really bright future for your kids. Or, hey, maybe, like a lot of the greats, you just find deep intellectual satisfaction in playing the game itself. Understanding this is everything, because your financial goals, they're just the tools you use to serve this higher purpose. And this brings us right back to that critical distinction we talked about. A dream is passive. It's something you'd kind of like to have, but a goal is active. It's something you are willing to roll up your sleeves and work for. The real difference here is commitment. You don't have to be completely obsessed, but you do have to be dedicated to putting in the necessary time and energy. Okay, so you've figured out your purpose. Now it's time to build a foundation that it's all going to rest on. And this foundation, it's built on 2 incredibly simple, totally non-negotiable rules of creating wealth. Rule number 1 is absolute. Preserve your capital. I mean, it sounds so obvious, right? But it is the single most critical principle in all of investing. Losing money makes your goals impossible. How can you build security if your pile of money is getting smaller? You can't. Protecting what you have is always rule number 1. And the second rule, well, this is the engine of the whole thing. This is what makes wealth creation possible. Live below your means. Spending more than you earn just eats away at your capital, or, even worse, sends you into debt. It is only by living below your means that you can build capital in the first place, keep what you have, and then, most importantly, add to it. These 2 rules together, that's the mental attitude that really sets the wealthy apart. So, with that foundation secure, now you can find your niche. And this is one of the biggest secrets of the masters, from Buffett to Soros. They don't know everything. They specialize. They operate inside something called a circle of competence, and your job is to define yours. So what in the world is a circle of competence? Think of it as your home turf in the massive world of investing.
It's the area where you have a genuine, hard-won advantage. And the ironclad rule is you make your moves inside this circle and you resist that temptation to wander out into territory you just don't understand.
Okay, so how do you find your circle? Well, it really starts with 3 simple questions. First, what genuinely fascinates you? Second, what expertise do you already have? Maybe you're a doctor who understands healthcare, or a software engineer who gets tech. And third, what are you willing to put in the work to truly master? I know a guy who built a fortune investing only in rent-controlled New York real estate. Why? Because he knew the ridiculously complex laws inside and out. Everybody has a potential edge. You just have to find it. Warren Buffett put it perfectly. He said, the game isn't about knowing everything. It's about being brutally, ruthlessly honest about what you don't know. That self-awareness isn't a weakness. In investing, it's a superpower. So once you've defined your circle of competence, you need an anchor, something to keep you firmly planted right there, especially during stormy markets. And that anchor is your core investment philosophy. This is the step where you take all your gut feelings about the market and you forge them into a concrete set of rules. A strong investment philosophy, it really answers 3 key questions. First, what's your take on how markets actually work? What truly moves prices? Second, what's your personal theory of value, and how do you spot it in the wild? And finally, this all boils down to one simple thing. What is your crystal clear definition of a good investment? And here is the most crucial takeaway. There is no single right answer. Just look at the masters here. Buffett is hunting for future earnings power. Soros is betting on shifts in market psychology. Icahn is looking at a company's breakup value. And his mentor, Benjamin Graham, he just wanted a massive discount to what a company was worth today. The lesson? Your definition doesn't have to be like theirs, but it absolutely has to be just as clear. And it has to be personal to you. This brings us to the final and, I'd say, the accelerating piece of our blueprint, choosing your style and finding your mentor. This is where you align your strategy with your actual personality and then stand on the shoulders of giants to really fast-track your progress. So, who are you as an investor? Are you the analyst, the type who loves patiently buying and holding great businesses for the long term? Are you the trader, someone who's comfortable with the fast pace of short-term market moves? Or are you maybe the actuary, treating investing like a game of probabilities? Look, there's no right answer, but you have to choose the style that fits your own temperament like a glove. Once you know your style, you can find a mentor. And there are really 2 main paths. You can follow the Buffett model. He found Benjamin Graham, adopted his entire proven system, and only later adopted it to fit him. Or you can take the Soros path. He took the philosophical ideas of Karl Popper and spent years building a brand new system from scratch. I gotta tell you, that first path is a massive shortcut.
Buffett put it so simply. The best thing I did was to choose the right heroes. Finding someone who has already perfected a method that really resonates with you, that's not cheating. It is the single most powerful way to accelerate your own path to mastery.
Buffett's advice on this is legendary. The key in life is to figure out who to be the bat boy for. Finding your master and dedicating yourself to learning their craft, whether it's in person or just by devouring every word they've ever written, that is the ultimate strategic move for any aspiring investor.
So there you have it, the 5 parts of your investor's blueprint. Your why for motivation, your foundation for security, your niche to give you an edge, your philosophy as an anchor, and your style and mentor to accelerate your journey. The plans are in your hands. The only question left is, are you ready to start building?
Today, we're going to tackle a question that, honestly, could completely change how you think about investing. It's the one thing that really separates the pros from the amateurs, and it separates pure luck from a process you can actually repeat. The question is simple. What are you going to measure?
And this quote from Meg Whitman, it's everything. This is the foundation for our entire conversation. It's about making that essential shift, moving away from emotional decisions, based on some hot tip or a vague gut feeling, and moving towards a disciplined, systematic approach. See, without measurement, you're really just a passenger along for the ride, but with it, you get to take the wheel.
All right, so here's our game plan for today. First up, we'll look at the pure chaos of investing without any kind of map. Then, we'll dive into the detailed blueprints the masters use. After that, we're going to get practical and actually build the core of an investment system, then figure out how to protect it from market storms. And finally, for those who want a different path, we'll check out a really powerful pre-built alternative.
For so many of us, this is exactly what investing feels like, right? It's just a messy jumble of news headlines, tips from your friends, and every single click is driven by either fear or greed. It's kind of like trying to build a house by just grabbing random boards and nailing them together wherever they seem to fit. There's no plan, there's no blueprint, and you know what happens? The first big gust of wind is going to knock the whole thing right over. That's the problem with random, unmeasured decisions.
This is where your investment criteria come in. They are the absolute critical bridge between your big picture philosophy and what you do day to day. So before you even start looking for things to invest in, you have to define in really specific detail what a home run actually looks like for you. What specific, measurable things must an investment have for you to even give it a second look?
And what's so fascinating is that there isn't one single right answer. I mean, look at two of the greatest investors of all time, Buffett and Soros. They measure completely different things. Buffett is meticulously analyzing a business, its management, its competitive edge. Soros, on the other hand, is constantly testing a theory he has about the market against what's happening in real time. The point isn't what you measure, it's that you are measuring something consistently.
Okay, so if random investing is like building a house with no plan, the master investor operates like a master architect. They have a complete, detailed blueprint that accounts for almost every single possibility before $1 is ever put on the line. Let's take a look at what that blueprint actually involves.
This list really shows you just how detailed that blueprint is. A real investment system has a predefined rule for everything. It's not just about what to buy and when. It covers how much to buy, how you'll watch it, and, critically, your exact rules for when to sell. It even has backup plans for when you mess up, when the market crashes, or even for when your whole system seems to be broken. Nothing is left to an emotional, in-the-moment decision.
Now, holding all 12 of those elements together is one core, unshakable principle: margin of safety. And this is not just some catchy phrase. It's the load-bearing foundation of the entire structure. Its number one job is to preserve your capital, and it's how an investor builds risk control into every single rule of their system.
And just like their core measurements, the masters apply this principle in totally different ways. For Buffett, his margin of safety is all about the price he pays. His goal is to buy $1 of value for 50 cents. Simple as that. Soros' margin of safety. It's all about his speed. The second his theory is proven wrong, he's out. Sell first, ask questions later. You see? Two different architects, two totally different techniques, but they both build a fortress that's made to last.
Okay, so theory is great, but let's get practical. This next part is all about the key decisions you have to make when you're designing the core of your own system. These are the non-negotiables, the questions you absolutely have to answer before you get started.
This one really comes down to position sizing. You know, Wall Street is constantly telling us to diversify, spread your money super thin across tons of stocks. But a lot of the master investors, they do the exact opposite. When they find that one rare investment that checks all their boxes, they buy as much of it as they possibly can. They actually aim for a concentrated portfolio because their conviction is so deep. And that conviction only comes from having a really robust, well-defined system in the first place.
Leverage, investing with borrowed money, it can be an incredibly powerful tool, but it's also a double-edged sword that can wipe you out in a heartbeat. Both Buffett and Soros use it, but, and this is a big but, they are first and foremost cash rich. So focus on the cash rich part. Use leverage sparingly, if you even use it at all, and make sure your system guarantees you will never, ever have to meet a margin call.
Oh, this is a huge one, and honestly, it's often completely ignored. Master investors are obsessed with their long-term rate of compounding. And a massive part of protecting that rate is structuring their system to legally put off or reduce taxes and transaction fees. I mean, getting this right can literally add percentage points to your annual return without you having to take on a single ounce of extra investment risk.
Here's something to think about. Unless you're literally on the floor of the stock exchange, you're delegating something. Just opening a brokerage account is an act of delegation. You're hiring someone to hold your money and make your trades. So it's crucial to think really carefully about who you delegate to, from your broker to your accountant to any advisors you might use.
Let's be clear, you are going to make mistakes. It is 100% inevitable. A strong system doesn't pretend mistakes won't happen. It plans for them. And the rule should be simple. When you realize you've made a mistake, either by breaking your own rules or just missing a key fact, you have to admit it, get out of the position immediately, and only then do you analyze what happened so you don't repeat it.
So you've built the core of your structure. Now it's time to stress test it. Every single system, no matter how well designed it is, will eventually face a storm. The real question is, will yours still be standing when that hurricane finally hits?
Just let that sink in for a second. The history of financial markets is a history of so-called 10 sigma events. These are market shocks that statistical models say are basically impossible, like things that shouldn't happen in billions of years until they do. That infamous firm, Long-Term Capital Management, it blew up because their models completely ignored this fact. A master investor, on the other hand, starts with the assumption that the impossible can happen and eventually will happen, and they build a system that's tough enough to survive it.
And here are their primary defenses. It all starts with that mindset, that anything is possible. From there, the protections are super practical. Large cash reserves are crucial. Why? Because when markets crash, cash is king. It gives you the power to act when everybody else is being forced to sell. Low leverage means you can't be forced out of your best ideas at the worst possible time. And by ignoring that Wall Street mantra to always be fully invested, it means you always have dry powder ready for those once-in-a-lifetime opportunities that are always born out of a crisis.
Now let's be honest. Becoming a master investor, an architect of your own system, that's a life's work. It takes a ton of time and energy. So for those who decide that's not for them, there's another path. It's kind of like buying a prefabricated military-grade fortress, a system that was already designed by an expert for one main purpose: survival and the preservation of your capital.
Let me introduce you to Harry Brown's permanent portfolio. The logic here is just simple and incredibly elegant. He identified 4 major economic conditions, right? And then he chose one asset class that thrives in each one. Stocks do well when there's prosperity. Gold does great during high inflation. Long-term bonds are your friend during a recession when interest rates usually fall. And cash. Well, cash gives you stability, and it actually gains buying power during a deflation. So with a quarter of your assets in each, something should always be working for you. The proof here is pretty compelling when you look at it. Over this 32-year stretch, the total return was amazingly similar to the S&P 500. But look at the journey. The S&P 500 is this gut-wrenching roller coaster of massive peaks and absolutely terrifying valleys. The permanent portfolio? It's a steady, gradual climb. You're basically trading slightly lower absolute returns for a dramatically smoother ride and, I'm guessing, a lot more nights of peaceful sleep.
And here's maybe the biggest trade-off of all. Becoming a master architect like Buffett requires this intense, full-time, lifelong focus. But managing the permanent portfolio, that takes just a few hours per year. All you do is check the 4 asset classes once a year and rebalance them back to 25% each. That's it.
So, at the end of the day, it really comes down to this fundamental choice. Do you want to be the master architect, that active system builder who dedicates their life to the craft, aiming for those superior returns? Or do you want to be the fortress owner, the passive, intelligent diversifier whose #1 goal is peace of mind and preserving what you've already built? Both are completely valid paths.
And that's really the question I want to leave you with. There's no right or wrong answer here, but you do have to choose. Understanding your own personality, your goals, and how much time and energy you really want to commit, that's the first and maybe the most important measurement you will ever make. So, which one are you?
Welcome to The Explainer. Today, we're going to dig into something that's maybe the final and most crucial step for any investor. It's about moving from just knowing the rules to, well, to acting on pure instinct, especially when the market is doing its best to test your nerve. This whole journey is about reaching what's called unconscious competence.
You know, it's funny. The Roman poet Ovid absolutely nailed the heart of what we're talking about today, and he did it over 2,000 years ago. See, true mastery in anything, especially investing, isn't about one single brilliant idea. It's about the relentless, grinding power of habit. It's about methodically replacing your old, emotional, reactive habits with new, disciplined ones until they become as natural as breathing.
So, here's our roadmap for today. We've broken this journey down into 5 key stages. First, we'll talk about what this leap to mastery even looks like. Then, we'll get into how to proactively hunt for investments. Third, and this one's huge, is learning to trust your own research. Fourth, we'll cover a specific pre-investment ritual to lock in that discipline. And finally, we'll see how it all comes together to make you a master investor.
All right, Section 1, the leap to mastery. This is all about closing that final and honestly, the most challenging gap in any investor's growth. It's that moment where raw knowledge gets forged into real, instinctual skill.
So here's the real test, right? You can learn a system, you can memorize all the rules, but what happens when the market goes haywire? What happens when that little voice of fear or greed starts screaming in your head? That's the moment your old bad habits love to come roaring back and just sabotage all your best intentions. So the real work isn't just learning the system, it's making it stick when it counts the most.
This slide really gets to the heart of it. There's a huge difference here. Most investors, they get stuck at what's called conscious competence. They know the rules, sure, but actually applying them takes a ton of active, stressful thinking. Their system is fragile. But the goal is unconscious competence. This is where your actions are just second nature. Your system is rock solid under pressure because you don't just know what to do, you embody it. It's like the difference between your first driving lesson with white knuckles on the wheel and just effortlessly cruising down the highway years later.
Okay, so how do we actually put this into practice? That brings us to Section 2, Hunting for Investments. This is all about making that mental switch from just passively waiting for ideas to fall in your lap to actively going out and hunting for great opportunities. Just think about the average investor for a second. They're totally reactive, right? They're waiting for a tip from their buddy or they hear about some hot stock on TV. A master investor, though, they are the complete opposite. They are proactive. They aren't just sitting around waiting. They are constantly out in the field, always searching for investments that perfectly match their own predefined criteria. So, how do you become that proactive hunter? Well, it really boils down to these habits. First, you got to know where to look. You have to define your own personal hunting ground. Then, you make the search a constant process, a daily discipline. And this next one is key. When you get discouraged, and you will, because nothing seems to meet your standards, you don't stop. You just keep looking. And finally, no matter where an idea comes from, you always do your own homework and check it against your personal criteria.
You know, that last point about personally checking every single idea, it's so critical that it gets its own section. So Section 3, Trust Your Own Research. This is all about breaking free from that need to get approval from some guru, and instead developing a kind of bulletproof self-reliance.
Let me tell you a quick story about a trader named Maurice. He had a system, he'd done his homework, and he found what he was pretty sure it was a fantastic idea. But he was a little unsure. He just needed that final push of validation. So he asked an expert he really looked up to, and that expert basically just dismissed it. So Maurice did nothing. And then he had to just sit there and watch as that investment soared, doing exactly what his own research predicted it would. He missed out on a fortune, all because he trusted a guru more than he trusted himself.
So why was that expert's advice so terrible for Maurice? It's simple, really. That expert's judgment was filtered through his own method, his own goals, and his own personality, not Maurice's. You see, even the best advice in the world is totally useless if it doesn't fit your framework. After you've done the work, after you've done the deep dive research, you are the world's foremost expert on that investment for your portfolio. You have to start acting like it.
And you know what? This is how you really learn. This is how you get good. When you rely on your own work, you own the results, good or bad. You make your own mistakes, you take full responsibility for them, and most importantly, you actually learn from them. If you just blame some guru when things go south, you learn absolutely nothing. True mastery is forged in the fire of your own decisions.
Okay, now we're getting to the absolute centerpiece of this whole discussion, the pre-investment ritual. And this isn't some vague suggestion. It's a hard and fast, 6-step checklist that acts as your final line of defense against making emotional mistakes.
Think of this as the final barrier between a disciplined, well-thought-out investment and a pure emotional impulse. If you cannot clearly and quickly answer the next 6 questions, you simply are not ready to risk your money. Period. End of story.
All right, let's walk through this ritual. Step 1, you have to solidify your thesis. Write down exactly why you are buying this thing at this specific price. This is your anchor. Step 2, predefine your exit. You have to know the conditions that will make you sell before you even think about clicking buy. Step 3, envision success. Write down exactly what you expect to happen if everything goes perfectly.
Now for the really crucial second half. Step 4, what if you're wrong? Brainstorm all the other things that could happen, from the price going sideways to the absolute worst case scenario. And then step 5, and this might be the most important one of all, pre-plan your reaction. For every single one of those scenarios you just listed, write down exactly what you will do. This turns fear into a simple plan. And finally, step 6, define how you're going to monitor it. How often will you check in? What specific data will you be looking at?
This quote from the legendary trader William Icahn just perfectly captures the whole mindset of Step 5.
It is probably the most powerful mental shift you can make as an investor. Just stop trying to predict what the market's going to do. You can't. It's a total waste of energy. Instead, focus 100% of your energy on the only thing you can control, your reaction. Have a plan for what you will do if the market goes up, down, or nowhere at all.
And of course, Warren Buffett has a perfect, simple name for this way of thinking. He calls it the Noah Rule. Predicting rain doesn't count, building arcs does. You see, it's easy to say, the market looks a little shaky. What really matters is doing the hard work to prepare for it. This 6-step ritual we just went through, that is your arc. You build it, piece by piece, before you ever set sail on a new investment.
And that brings us to our final section, becoming a master investor. This is where we pull all the pieces together, the mindset, the habits, the rituals, and really understand what that ultimate state of investment mastery looks and feels like.
Look, there are no shortcuts to this. It's a process of paying your dues. That means actually deploying your system with real money on the line, meticulously documenting every single decision, facing your mistakes head-on, refining your process, and then doing it all over again, and again, and again, until discipline finally becomes pure instinct.
All of this work, the hunting, the deep research, the rituals, it's all designed to forge one final ultimate habit. This is the true sign, the final proof that you have finally achieved unconscious competence.
And here it is. This is the summit. This is the top of the mountain. You know you've truly arrived when your conviction in your system is so deep, so completely earned, that you could commit your entire net worth to it without a single ounce of fear. Now that's not arrogance. That is the quiet, unshakable confidence that only comes from a process you have personally forged, tested, and mastered.
So I'll leave you with this final thought to chew on. Forget all the theories and hypotheticals for a minute. If you have a system and you genuinely believe it's been proven through your own tough, rigorous work, ask yourself this one simple question. Are you truly ready right now to invest your entire net worth in it? Your honest answer to that question will tell you exactly where you are on the path to mastery.
Have you ever looked at the track records of investing legends and just thought, how do they do it? Is there some kind of secret formula? A crystal ball, maybe? Well, today, we're going to pull back the curtain on what it really takes to get those kinds of extraordinary results. We are diving deep into the 23 winning investment habits that separate the absolute masters from the rest of the crowd.
And let's just start with this idea from Warren Buffett himself. What he's saying here is so powerful. The key to incredible success isn't some huge, spectacular, once-in-a-lifetime move. It's not some impossibly complex strategy. Nope. It's about the daily grind. It's about consistently practicing simple, powerful habits. And when you think about it that way, well, suddenly those extraordinary results feel a whole lot more achievable, don't they?
You know, when you really boil it down, investing is all about a choice. Every single decision you make puts you on one of two paths. You've got the path of the master investor, which is built on discipline and a really clear mindset. And then there's the other path. The path of the losing investor, which is totally paved with emotion and inconsistency. Throughout this whole explainer, we're going to break down what it takes to consciously, deliberately choose the master's path. So here's the game plan. We'll start at what we're calling the investor's crossroads. Then we'll build this thing from the ground up. We'll lay the foundation with your mindset, create a personal blueprint or system, then we'll get into the nitty-gritty of practice and execution, reach for mastery through discipline, and finally pinpoint your very first winning habit you can start using today. Okay, so this fork in the road, it's not some big one-time decision. It's a choice you make thousands of times. Every single day in the market, you're standing right there. And the path you end up on, well, it has almost nothing to do with luck. It's all about the sum of your habits and your choices over a long, long time. Now, I know this slide is just packed with numbers, but it perfectly shows you what happens when you choose the master's path year after year. These are the actual track records for Warren Buffett and George Soros over decades. You don't need to get lost in the details of every single year. Just look at the overall trend. This isn't about having one or two lucky years. We're talking about decades of consistent world-class performance. This is what winning habits actually look like in the real world.
Let's just zero in on this one number for a second. 23.4%. That was Warren Buffett's compounded annual return over 47 years. Now, that might not sound as exciting as a stock that doubles overnight, right? But when you compound that kind of return consistently for almost half a century, that's how you create legendary wealth. That right there is the mind-blowing power of habit. So, the big question is, how do you even begin to build a track record like that? Well,
Returns like those definitely don't happen by accident. They start with a rock-solid foundation. Long before you ever click buy or sell, you have to build the right mindset, because everything you do, all of your actions, are just a reflection of your core beliefs about money and risk. And right here, we see the first huge split in the road. For the master investor, priority number one always is preserving capital. Their first rule is simple: don't lose money. The losing investor, though, they're driven by a completely different goal: to make a lot of money. Now, that might seem like a tiny, subtle difference, but trust me, it is everything. One is playing defense to win the long game, the other is just swinging for the fences and, more often than not, striking out. And that make a lot of money fast mindset, it leads directly to these classic mistakes. You start to believe that to get big profits, you have to take on huge risks. You don't have a personal philosophy, so you end up like a ship without a rudder, just chasing every hot tip that comes along. And this all leads to the most tragic result of all. You often fail to even keep the money you do manage to make.
Okay, so you've got the mindset dialed in. Fantastic. What's next? You need a blueprint. A winning mindset is kind of useless if you don't have a repeatable, tested, and this is key, personal system for making decisions. This is how you turn a philosophy into a practical tool you can actually use.
And this right here is a massive, massive difference maker. The master investor has put in the hours, the sweat to develop and test a system that actually fits their personality and their knowledge. The losing investor, they either have no system at all, or, and this can be even worse, they just copy someone else's. And a copied system is like a borrowed suit. It just never really fits right, and you're going to ditch it the very first time you feel uncomfortable. A personal system is tailored to you, so you'll actually stick with it when things inevitably get tough.
A strong blueprint is really built on habits just like these. It means you stay in your circle of competence. You only invest in what you truly, deeply understand. It gives you the conviction to just say no to opportunities that don't meet your super strict criteria, and crucially, it forces you to do your own homework instead of just following what some so-called expert or broker tells you to do. All right, now we're moving from planning to practice. See, having a great system is one thing, but actually executing it under pressure, that's a whole different ballgame. And this is where we run into a really fascinating paradox that truly defines the elite performers. And here is that paradox in action. It's wild. The master investor can wait forever. We're talking months, even years, for that one perfect pitch. But when that opportunity finally shows up, they act instantly, decisively, no hesitation. The losing investor is the complete opposite. They have this constant itch, this need to be busy, to always be trading. But when a really big decision needs to be made, they freeze up, they procrastinate.
And the psychology of execution goes even deeper. A master investor is absolutely ruthless about cutting their losses. The second they realize they made a mistake, it's gone. But with their winners, they are incredibly patient. They let them run. The losing investor, again, does the exact reverse. They hang on to losing stocks, just praying they'll get back to even, while they sell their big winners for a tiny little profit, completely missing out on those life-changing gains.
But here's what might be the most encouraging part of this entire thing. You don't have to be perfect. This is a direct quote from the author of our source material. He's openly admitting, hey, I'm far from perfect at this stuff. And yet, look at that result. It's incredible proof that perfection isn't the goal. Progress is.
This little story from the author just makes the point perfectly. So he owned a stock that paid a huge dividend. Awesome, right? But then the company cut the dividend. His system was screaming at him, sell. But he was busy, he was distracted, and he procrastinated. He ended up selling for a much lower price. He totally broke his own rule. And yet, his overall system was so strong that he still achieved amazing returns. It's the best possible proof that you should be aiming for progress, not perfection.
And that brings us to the final stage, mastery. These are the habits that, when you practice them over a lifetime, are what forge good investors into the truly elite performers. This is where it all comes together through deep, unshakable discipline.
Now, these habits demand some serious commitment. Paying your dues means you get that there are no shortcuts to real experience. Never talk about what you're doing is all about protecting yourself from other people's opinions and all the noise. Living far below your means is what gives you the dry powder, the capital to seize opportunities when they come. And finally, putting your net worth on the line, well, that shows the ultimate conviction in your own research and decisions.
But what really drives someone to this level of discipline? You know, it's not just about the money. For the master investor, it's about the intellectual challenge. It's the process of solving the puzzle. They genuinely love the game itself. The losing investor, though, is only motivated by the outcome, the idea of easy riches. And that kind of shallow motivation just isn't enough to sustain you through the tough times, which are guaranteed to come.
Okay, we have covered a ton of ground, and it might feel like a pretty daunting list of 23 habits. But here's the really good news. Getting started is so much easier than you think.
Remember this number? The author's 24.4% average annual return over a 6-year period. This is the definitive proof. He got this world-class result not by being some perfect, flawless investor, but by adopting enough of the right habits to give himself a massive edge, even when he made the occasional mistake.
And this, right here, is the single most important thing to take away from all of this. Please don't try to become Warren Buffett overnight. The goal is not to perfectly master all 23 habits by tomorrow morning. The goal is to just pick one, or maybe two. Pick the ones that really speak to you, and just start practicing them. Just by doing that, you will immediately, I promise, begin to see an improvement in your investment results.
So that brings us to the final question, and this one is for you. After seeing this whole framework, the mindset, the system, the execution, which one of these habits really stood out? Was it doing your own research? Is it about being more patient? Maybe it's finally cutting that losing investment you've been hanging on to. So, which winning habit are you going to start practicing today?